Let's start our CMA Inter Financial Accounting Marathon. This is December 2024. December 2024. Set 2 now. We are solving. Question number 5. As always, partnership. A and B were partners of a firm sharing profits and losses in the ratio of 2:1. The balance sheet of the firm as at 31st March 2023 was as under. Capital account we have A and B. Then we have reserves, creditors, bills payable. Plant and machinery, building, sundry debtors, stock, cash. Clear? This much we have. They agreed to admit P and Q into the partnership on the following terms. The firm's goodwill to be valued at 2 years purchase of the weighted average of profits for the last 3 years. The relevant figures are as under. What they gave, they have asked you to calculate goodwill. Goodwill they have not given, they have asked you to calculate. Now it's basically they agree to admit P and Q. Two people are getting admitted. Now 3 years profit they gave, they said weighted average profit. So yeah, you have to put 1, 2, 3 and multiply. Yes. So let's see if they have done it. Yeah, see here 37, 40, 45. Weightage they have given 1, 2, 3. Multiply, you will get the product. Divide, you will get the weighted average profit. How many years purchase? They said 2 years purchase. So 42,000 into 2, 84,000 should be your goodwill. And goodwill will be based on your sacrificing ratio. Clear? So now, goodwill part clear. We have 84,000 as a goodwill. Value of stock and plant and machinery to be reduced by 10%. They asked you to prepare memorandum revaluation account. So whatever you do, it's going to get reversed. So now, plant and machinery is right now 5 lakhs, so 50,000. See, revaluation account debited to plant and machinery 50,000. Okay, whatever you do over here, it's getting opposite effect over here. Next, stock is 3 lakhs, so 10%. 30,000. 30,000 loss, then it's getting reversed, so it is profit. Next, building was to be revalued at 10 lakh 11,000. Right now, building is at 9 lakh. So 1 lakh 11,000 increase. So revaluation profit. Can you see by building over here? It will get reversed 1 lakh 11,000. Clear? There was an unrecorded liability. If there is unrecorded liability, it's a loss, right? So revaluation account debited 10,000. Then that gets reversed here 10,000. So these are the 3 points they had. A, B, P, Q agreed to share profits and losses in the ratio of 3:2:1:1. They have given the new profit sharing ratios. Old ratio was 2:1. So whatever profit you get over here, revaluation profit, 21,000, balancing figure, it is distributed between A and B in the ratio of 2:1. 14 and 7. Now this 14 and 7 should be in the partner's capital account also. Can you see 14,000, 7,000? Now after that everything got reversed. Earlier you got profit. Now you should get loss obviously. So now this 21,000, 3:2:1:1. So can you see 3:2:1:1? It is in the ratio. And this will be in the partner's capital account. 9,000, 6,000, 3,000, 3,000. Clear? Sorted till here. Now after that. Okay, after this. The value of reserves, the value of liabilities and value of assets and other than cash were not to be altered. Can you see reserve is there in the balance sheet 5,25,000. So now if you see partner's capital account, by reserves, first these two people are going to share the reserves. Then we should not alter it. So we create reserve again. All the people are going to share the reserves. Reserves point up. Then reserves will be distributed. Only other assets and liabilities will be keeping at same values. They said memorandum revaluation account, right? So whenever they tell memorandum revaluation account, it will get reversed. It has to get reversed, whatever revaluation you're doing. Okay, if they would not tell this point, reserves would just be distributed till here, only this much. Now, actually reserve was there. We distributed to A and B. Reserve went from balance sheet. Now you have to create reserves. So you do the opposite. In the 3:2:1:1. New profit sharing ratio. Clear? After that, P and Q will bring capital equal to their share of profit considering B's capital as base after all adjustment. We have to make capital proportionate, but for that whose capital we are keeping as base? B's capital as base. P and Q will bring new partners. Okay, now if you check this, no. B's capital after adjustments, not now. Okay, now we can't do it after adjustments. So now we have to calculate, wait, this thing. See, old ratio, new ratio. You got the sacrificing ratio. Sacrificing ratio, can you see it is in the ratio of 5:1. Okay, but these people, okay, 5:1, that means 5/21 and 1/21. Here it is 1 by 7. If you multiply into 3, this will become 3 by 21 and 3 by 21. So these people are going to give equally, but these people are going to get in the ratio of 5:1. Sacrifice is in the ratio of 5:1. Gain is in the ratio of 1:1. So now 84,000 into 5 by 21. No, it's 35,000, right? 84,000 into 5 by 21. Yeah, 20,000. So it is 20,000 and 84,000, 4,000. Clear? So who is going to get this? A and B will get it. So you should see this in A and B's capital account. 20 and 4 should be there. 20 and 4. Can you see they got 20 and 4? But this 20 and 4 totals up to 24,000. Who is going to give it? P and Q. 12,000, 12,000. Who is going to give it? P and Q. 12,000, 12,000. Is it clear? So this is the distribution of goodwill. Now after this is the opening balance from the balance sheet only. 8 lakh, 4 lakh. Okay, now listen. Now they told keeping B's capital as base, we have to do it. B's capital. Now if you check B's capital, 4 lakh plus 7,000, 1,75,000 plus 4,000 minus 6,000 minus 1,50,000. 4,30,000 is there. You have to keep B's capital as base. 4,30,000. 4:3:1:1, right? New ratio. 3:2:1:1. So 2 by 7. So this is 2 by 7. How much is 1? What is the capital? 15 lakh 5,000. 15 lakh 5,000. So this should be the new capital, keeping B's capital as a base, and it should be distributed to all the partners. So 15 lakh 5,000 into 4 by 7. Sorry, not 4 by 7. It is 3 by 7, right? 15 lakh 5,000 into 3 by 7. Oh, actually, I got confused. Actually, here they said no, P and Q were to bring capital. They didn't tell anything to be done with A's capital. A, let it be like that only. See here, P and Q are to bring capital equal to their profit sharing ratio, considering B's capital as the base for all adjustments. So, A's capital we are not going to change. A's capital is just balancing figure. For these two people, they'll bring money, no? So to bring money, 15 lakh 5,000 into 1 by 7. So it should be 2 lakh 15. Their capital should be 2 lakh 15. But they have to give again for goodwill also, not 12. Their goodwill share is also there, no? Goodwill share, their revaluation, loss share, all that is there. See, memorandum revaluation, whatever loss share, everything is there. All this they have to bring. So 2 lakh 15,000 they have to bring for capital. 12,000 is their loss share. 75,000 is their reserve share. 3,000 is their revaluation share. All this total, if you see, they have to bring 3,05,000. This is the money to be brought in. Is it clear? When you have memorandum revaluation, it becomes a little tricky. Otherwise, it's simple. Okay, what money has to be brought in? Now, balance sheet is going to be absolutely straightforward because balance sheet, everything is book value. All these items are book value. Clear? 5 lakh, 9 lakh, 2 lakh, 53 lakhs. You can see the balance sheet existing. 5 lakh, 9 lakh, 2 lakh, 53 lakh. All are book value. Only cash will be different. Cash, what happens? 1 lakh 50 we already had. Plus 3 lakh 5. The new money that is brought in by the partners. That makes it 7 lakh 60,000. Clear? If you see liability side, reserves, same like before. Creditors and bills payable, same like before. See the existing balance sheet. You have reserves, creditors, bills payable, all same. Capital account, whatever balance, right? It's there over here. This balance only will come to balance sheet. This balance will come to balance sheet. And that should be your balance sheet. Done. Finished. They asked it for 14 marks. Easy. Clear? Now let's look at the end of the paper. If there is another question on partnership. Yes. 8th one C. S and N are partners sharing profits and losses in the ratio 5:3. They admit J into partnership for 3/10 share in the profits. in which J acquired 1/5 share from S and 1/10 share from N respectively. Calculate the new profit sharing ratio. I think this was there in one of the earlier questions also. 1/5 if you are acquiring, see over here. Directly minus 1 by 5. 1/10 minus 1 by 10. You will get these two numbers. We know the new partner share. Just bring it to same terms. It becomes 17:11:12. I think one of the earlier mock test papers also we had. So with that we are done with set 2 December 2024. Now I'm going into set 1 December 2024 set 1. Fifth question again partnership as always. Partnership firm was dissolved on 30th June 2024. Its balance sheet on the date was of dissolution was as under. Whenever you see a dissolution question, right, first step what you do, empty the balance sheet. Transfer everything to realization account. Okay. But here they didn't ask realization. What did they ask? Memorandum of distribution of cash which was realized as follows. Partners shared profits and losses. Okay. They have not told which method. So we are assuming that it is they have used proportionate capital method. Okay. Remember we had two methods. Maximum loss method and higher relative capital method. Higher relative capital method is nothing but proportionate capital method. Let's see if they have done the calculation. Yeah. Short statement for higher relative capitals. Now you have to take the actual capital 38, 24 and 18. This was step 1. We had discussed the step 1. Okay, 38, 24 and 18. Can you see 38, 24 and 18 over here? Step 1 was divide by the profit sharing ratio. What is the profit sharing ratio? In the question 2:2:1. So write 2:1 over here. Profit sharing ratio. Divide it. Divide means not in the ratio and all. 38 divided by 2, 19. 24 divided by 2, 12. 18 divided by 1, 18. Done. Step 1. Now you see who has the least figure. Who has the least figure here? B. Keep B's capital as base and calculate the capital. B's capital is how much? 24,000. And 2 by 5. How much is 1? 60,000 is the capital. Now divide that 60,000 in the profit sharing ratio. Okay. So 2:2:1. That becomes 24,000, 24,000 and 12,000. Can you see this fellow's capital is 38,000 but his required capital is only 24. That means 14,000 is excess capital. Higher relative capital. This fellow is just 24,000. It's 24,000. It has to be nil only. 18,000 here. His capital required is 12,000. 6,000 is higher relative capital. Okay. Now, two people are there. If money comes, whom to give first? Again, we have to do higher. We have to repeat these steps. We'll write the profit sharing ratio. 2:1. No. Between Atrik and Rupa, it is 2:1. So divided by 2, it became 7,000. Divided by 1, it became 6,000. Who is least in this? Rupa. So you will keep Rupa's capital as the base. 6,000 is 1 by 3. How much is 3? 18,000. Sorry, how much is 1? 1. How much is 1? 18,000. So 18,000 is the capital. It will be divided in the ratio of, what is the ratio? 2:1, right? Yeah. 18,000 is the capital. It will be shared in the ratio of 2:1. Can you see it became 12,000 here and 6,000 here. So now this fellow's capital was 14. 12,000 is required. This is high relative capital. This is 6. 6 minus 6 becomes 0. That means whenever money comes, see, whenever money comes, right, first you have to give to this partner 2,000. Then you will give 12,000 and 6,000 to the two partners, higher relative capital. After that, everything will be distributed in their profit sharing ratio. See here, 2,000 to Atrik, 12,000 and 6,000 to Atrik and Rupa. Then whatever comes, it will be in the ratio of 2:1. Now, let's try to understand the distribution here. Okay, first, you write all the balances. You write balance due. Balance due, what you will do? You will take loan is there, Sunday creditor is there, and the partner's capital. See, Mohit's loan, creditors, Atrik, Mohit, Rupa. Write all the balances from the balance sheet. Then, see over here, assets were realized in installments and payments were made on the proportionate capital basis. Creditors were paid 14,500 in full settlement of their account. Expenses of realization were estimated as 2,700, but the actual amount was only 2,000. This amount was paid on 15th September. Draw up this thing. First on 5th July, what you got? 12,600 you got. In the question, do you already have cash? Can you see cash is already there, 5,400. This cash and this cash, you will distribute now. So now if you see here, cash paid, 5,400 was already there. From that 2,700 you are removing for what? Realization expense. Whenever you have to keep money aside for realization expense, remove that 2,700 you will give to outsider. First what you have to settle? Outsider's liability you have to settle, then you will settle the insider's liability. 2,700. Now you have your balances. First installment gave you how much? 12,600 in the first installment. Okay, whom will you give 12,600? You have to give to creditor first. Creditor 15,000 was the balance, but they said it is settled at 14,500. So 14,500 only. Balance unpaid. See 500. It is written off. Okay. So 12,600. You will give the creditor first. If you have extra money, you will give it to Mohit's loan. After that, you got your balances unpaid. You have one more installment now. Third installment, how much? Sorry, second installment, how much you got? 30,000 you got. When you got 30,000, okay, second installment, when you got, when you got 30,000, what will you do with this 30,000? See, when you get 30,000, first to whom will you give? 4,200. This 30,000, see. First, what will you do with this 30,000? 4,200 you will give to Mohit's loan, because Mohit's loan only 800 we paid last time. Then what will you give? You will give 2,000 to Athrik because of higher relative capital. Then you give 12,000 and 6,000 to Athrik and Rupa, higher relative capital. Then what will you do? Whatever remaining money is there, if you take 30,000 in your calculator, remove 4,200, remove 2,000, remove 12,000, remove 6,000. How much you have? 5,800 you have. 5,800. All the higher capital was paid off. Now you will distribute this in the ratio of 2:2:1, 2,320, 2,320 and 1,160. Done. Clear? This is your situation here. Okay. Now you have the total. Just put this total into the distribution sheet. Can you see they have put that same numbers over here? Distribution sheet. Clear? Now you will have balance due. Now you don't have to worry also. After this, if you get some money, right? After this, the next installment, 40,000. Now it's not 40,000. 40,000 plus 700. From where this 700 came? I kept 2,700 for this thing. No. Realization expense. But actual amount was how much? Only 2,000. Only 2,000 was the actual amount. So what happened now? 700 remained. So totally 40,700 is there. Now this 40,700. See, they told over here. It was estimated to be 2,700, but actual amount spent on this account was 2,000. This amount was paid on 15th September. So 15th September, you will have 700 rupees remaining. So 40,700, nothing. All higher relative capital is paid off. Now that 40,700 is distributed in the ratio of 2:2:1. Yes. So the last part, you just have to, whatever unpaid balance is there, it will be considered as the loss of the partners. Clear? So third installment, because already higher relative capital was paid, complete amount was taken as distribution. Clear? This is the high relative capital method which was asked in that set. Let's see if there is any other question. Yes. There is. They just told examine the applicability of section 37 of partnership. Remember, we discussed section 37 of Partnership Act, retirement of partner, death of a partner. If at all partner's money is not given, he can ask interest at the rate of 6% per annum, or he can get the share in the profit. Let's see. C. Yes. There is no contract to the contrary of the option, section 37. Okay. Example, they have explained with the example. Unsettled capital of 52,000, date of retirement. Okay. Net profit, interest on unsettled capital, 6% you can give, or profit earned. Okay, profit earned out of unsettled capital. So basically what you will do, unsettled capital you will keep in the numerator, denominator you will take other people's capital plus unsettled capital, and then you will divide. Remember, we had done this, we had discussed this in the concept. Section 37. Where is it? Piecemeal distribution. Yes. Yeah. Section 37 of Partnership Act. What will you do? Interest at the rate of 6% per annum, or share in the profit. Share in profit will be how much? How? Profit into retiring partner share divided by total. Total capital plus loan. Loan is the retiring partner share. Okay, that's how you are going to distribute that. So that should be it with that particular paper. December attempt. Now we go into set 2 of June 2025. Set 2 June 2025. Obviously, there's a partnership question. X and Y share profits and loss in the ratio 5:3. They admit Z for 1/5 share in the profits. He pays 80,000 as capital but does not contribute anything towards goodwill, which is valued at 60,000. The capital of the partners are fixed. All the adjustments are to be made through partners' current account. Their balance sheet on 31st March 2024 is as follows. Okay. Capitals, current account balances, general reserves, sundry creditors, plant and machinery, investments, sundry debtors, stock and trade and bank. All this information is there. Additional information. See, what did they ask us to prepare? Prepare revaluation account, capital and current account, bank account and balance sheet of the new firm. Clear? First, plant and machinery is valued at 46,000. Go and check how much was the plant and machinery. 50,000. So it is a loss of 4,000 to plant and machinery. Then stock is 96,000. What is the stock value? 90,000. That means there is a profit of 6,000. Then they said one creditor of 6,000 is dead and nothing is likely to be paid to his account. 6,000 you don't have to pay. Creditor value reduces, liability reduces profit. So 6,000 you can see over here by creditors. So now you have 6 plus 6, 12. 12 minus 4, 8,000. 8,000 profit will be shared in their profit sharing ratio of 5:3. So it becomes 5,000 and 3,000. Clear to the partners. This should go to partners current account because they are following fixed capital method. So directly you will put into partners current account by revaluation 5,000 and 3,000. 5,000 and 3,000. Clear. Next, after that, what do we have? The capital account are to be proportionately adjusted on the basis of Z's capital and his share of profit through current account. Partners decide to maintain the general reserve in the books. That means general reserve which is there, it is not going to be distributed. So first what we will do? Okay, first we will distribute the general reserve between old partners in the ratio of 5:3. Just like we did in one of the earlier questions just now. And then we'll recreate the general reserve 30, 18 and 12 in the new profit sharing ratio. What is the new profit sharing ratio? They haven't given. But you know 5:3. Let's see if they have shown the calculation. Yes, they have shown the calculation here, but I will show it again. X. Okay. X and Y, right? See, usually we do it like this. X, Y, Z. Okay, 5/8 and 3/8. And what are we giving to the new partner? New partner, we are giving a share of 1/5. So if 1/5 is given to new partner, if you are giving 1/5 to new partner, that means how much is remaining? 4/5. 4/5 is remaining into 4/5. Give it to the others. 4/5, 4/5. This becomes 20/40 and this becomes 12/40. If you bring this to same terms, this will become 8/40. So this becomes 20:12:8. That becomes 10:6:4. That means 5:3:2. 5:3:2 will be the new ratio. Can you see? That's why this reserves in the ratio of 5:3:2. It is recreation of reserves. Okay. Now, whenever you do like this, now sacrificing ratio will be. Whenever you do like this, sacrificing ratio will be same. Okay, that will be 5:3 only. You'll see, can you see sacrificing ratio? They wrote 10:6. 10:6 is nothing but 5:3. Whenever you create new profit sharing ratio in this pattern, that time you don't have to do sacrificing ratio again. If you do it also, you will get same ratio as old ratio. Sacrificing ratio and old ratio will be same. Now, what you have to do? One more thing. Goodwill. Okay, go and check over here. How much is the goodwill of the firm? They said 60,000. 60,000 into 1/5. That gives us how much? 12,000. So 12,000 has to be given. 12,000 has to be given. Given by whom? By Z. Z is a new partner. It will be given in what ratio? 5:3. So you can take your calculator. 12,000 into 5/8. You will get 7,500. And 12,000 into 3/8 will give you 4,500. This is given by Z. To whom? X and Y. Can you see everything is in the current account only because it's fixed capital method? Now you can go to the question and see what is their capital balance. They said 80 and 60. That will be there in the partners capital account. 80 and 60. What is their current account balance? 5 and 6. This will be there in their partners current account. Can you see the current account balance? 5,000 and 6,000 to start with. Yes, done. Then after that you see what they have asked. Okay, making capital proportionate with Z's capital as base. What is Z's capital in this case? Z's capital is 80,000. He brought 80,000. So you will keep 80,000 as the base. So 80,000 is the capital. 80,000 is for 1 by 5 share. What is 1? So total capital should be how much? 4 lakh. 4 lakh. So that will be in the ratio of what? New ratio. That is 3 is to, no. New ratio was what? 5 is to 3 is to 2. Okay. So can you see half of 4 lakh is 2 lakhs? 1 lakh 20 and 8. It's in the ratio of 5 is to 3 is to 2 only. This should be their capital. But can you see existing capital of A is 80,000. If he has to increase it to 2 lakhs, he has to bring money. But they said make the adjustment through partner's current account. Okay, make the adjustment through partner's current account. That's why you're seeing 1 lakh 20 over here. 1 lakh 20 is adjusted in the partner's current account. Here, this fellow's capital requirement is 120. How much he has right now? 60. So another 60 should be added to capital. So 60,000 will be there in partner's current account. 60,000 will be there in partner's current account. Is it clear? Due to that adjustment. Otherwise, you would have written over here by bank. They have to bring money. That time there won't be partner's current account only, because if it is fluctuating capital method. So that's it. This is your situation, and here whatever balance is there, balance carried down. Partner's current account, balance will be carried down, and that same balance will go to balance sheet also. They have asked bank account, shouldn't be a problem. You are just going to post the entries, and balance sheet also from the existing situation. You can prepare the balance sheet as well. That should be it. 8th one C we have a the same type. XYZ are partners in the ratio of 3:2. W is admitted for 1/6 share in future profit. Z would retain his original share. Calculate the new profit sharing ratio. Z would retain his original share. That means what is going to happen now? See, X, Y, Z, W. Correct? Now W share is given 1/6, and they told Z will not change. So Z is also 1/6. Okay, now what will happen is 3/6 and 2/6 was given to X and Y. Now that 1/6 which we are giving, no, it's going to be shared between whom? X and Y. So 1/6 is given, that will be shared between X and Y. So in the ratio, in their ratio only, their existing ratio 3:2. So 3/5, 2/5. Whatever you get over here, that is going to be 3/30 and 2/30. That you reduce from their existing share. Whatever they are getting over here, no existing share, from that you reduce what you are going to give to the new partner. That time you will get 12/30 and 8/30. Didn't get it? See, X, Y, Z, W. W is getting 1/6. Z will not change. He is also getting 1/6. X and Y were getting 3/6 and 2/6. Now who will give this 1/6 to W? It has to be given by X and Y in their ratio. In what ratio they are giving that 1/6? In their ratio of 3/5 and 2/5. So that makes it 3/30 and 2/30. What we are giving to X and Y, that X, what are we giving to W? X and Y are going to lose. So minus 3/30 minus 2/30. So LCM is 30. 6 5s are 30. So 15 minus 3 is equal to 12/30. Here also LCM is 30. Okay, so this becomes 10 minus 2 is equal to 8/30. And here, if you bring this to same terms, it becomes 5/30. If you bring this to same terms, it becomes 5/30. So 12:8:5:5 is the new profit sharing ratio. Can you see 12:5:8:8? Yes, that should be it with that particular model test paper. Let's go further to June 2025 set 1. June 2025 set 1. Obviously, fifth question will be partnership only. Small question, huh? Okay. P, Q and R sharing profits and losses equally. That means 1:1:1 should be their profit sharing ratio. Correct? Had been trading for many years. R decided to retire on 31st of March 2024, on which date balance sheet of the firm is as follows. Okay, R is retiring. So it's a retirement question. Okay, so R is the partner who is retiring. Then value of goodwill was agreed as 93,000. Land and building increased in value. It being agreed at 1,05,600. How much is land and building right now? 75,000. So 1,05,600 minus 75,000. 30,600 is profit. So building account debited to revaluation account. Can you see 30,600 here? Yes. Next, plant and machinery was revalued at 1,05,000. How much is plant and machinery right now? 120. So 120 minus 1,500,000, you're getting 19,500. You're reducing the value, loss. 19,500 here, to plant and machinery account. Next, and it was agreed to provide 6% in respect of debtors. 6% we are going to provide for debtors. See the debtors over here, 74,000. 74,000 into 6%, 4,440. So you're going to write two provision for bad debts, 4,440. Clear? Now you can see that clearly there is a, what do you say? There is profit, 30,600. If you see profit will be shared between P, Q and R. Equally they said, so 1:1:1. Can you see 2220, 2220, 2220? Okay, this will go straight to the partner's capital account. Can you see 2220, 2220, 2220 in the partner's capital account? Done. So revaluation is done. So now what we are supposed to do? P, Q and R, they have capitals, right? 120, 85, 75. See the capital account, 120, 85 and 75. Goodwill. Okay, goodwill. How much is the goodwill here? 93,000. 93,000 is a goodwill. 93,000 goodwill, one person is going into 1/3. Into 1/3 will be what? 31,000. So the partner who is going, 31,000 we have to give goodwill. Who will give? Other partners. In what ratio? Equal. Everything is equal here. Okay, in equal ratio. Can you see? Yeah, 15,500. 15,500. Can you see 15,500? 15,500 here? This should have come little down. 2R, it should be here. They have put the slash, that alignment issue has happened. So 15,500, 15,500. Can you see R is getting 31,000? Anywhere in the question they didn't tell that R is going to be settled today only. So the entire amount what is there in R, this is the balancing figure. Entire amount will go to R's loan account. Can you see R's loan should be shown in the balance sheet as 108,220? Okay, now nothing, no amount is paid, so cash will be same. Go to the old balance sheet and see what is cash. 36,000. Same amount over here, 36,000. Now debtors, 4,440 we created provision. 69,560. Stock, they only gave us the new value of stock. No, stock they didn't revalue. Stock is same as old balance sheet only. So 160,000. Then plant and machinery, they told us the new value, 1,500,000. So take the 1,500,000 directly. Land and building also they told us a new value, so just take that value, done. Okay, that time we will get that. And creditors, we know 85,000. So this will be your partner's capital straight away coming from partner's capital account. You can see partner's capital account, balance. Clear? Done. Easy 14 mark question. Let's see. 8th one C. Do we have one more question? Yes. A and B are currently partners in a firm. Profits and loss in ratio 4:3. New partner is admitted. And after his admission, new profit sharing ratio is 5:3:2. Calculate sacrificing ratio. Okay, I don't think we have to do anything about it. Old ratio minus new ratio. Okay, you know to do this. 4/7 minus 5/10. Can you see earlier this fellow's ratio was 4:3. So 4/7 and 3/7. Now ratio is 5:3:2. So 5/10 and 3/10. And 2/10 for the next person. You will get this. This is a very regular adjustment. I think you should be able to do it. Done. Sacrificing ratio is coming to 5/9. 5:9. So with that, we are done with set 1 as well. Now we are left with our exam, that is December 2025 exam questions. Question number 5. 14 marks. Wow, what a beautiful question. Just now we solved this. What a beautiful question. We just solved this. So P, Q and R sharing profits and losses equally. See the goodwill value also 93,000. Land and building, same thing. So you can just refer that question. We just did it 3 minutes back. If you go back in this video, you'll find it. Okay. Yes. So I think that is it. And then we'll see if there is one more partnership question. We'll solve that. Yeah. There is a partnership question. Wow. AB currently partners 4:3, 5:3:2. Sacrificing ratio. You can just go 2 minutes back in the video. You can find this. So with that, we are done with this model test paper. We'll go into the one more model test paper that is there. That is set 1. December 2025 set 1. Okay. 5 mark. Fifth question, which is for 14 marks. 14 marks. Following is the balance sheet of X and Y, who are partners in a firm sharing profits and losses in the ratio of 2:1. Clear? X and Y 2:1. We can see it over here. Then all the assets are also given. Z is admitted as a partner on 1/4/2024 for 1/5 share of the following terms. Let's go straight to the end of the question and see revaluation account, partners capital account and balance sheet. Admission question. Okay, so straight away I'm going and starting with this question. This is our December 25th. December 2025, set 1, right? And question number 5. Okay, what did they ask us? Revaluation account. Revaluation account. Partners capital account. Okay, who is the partner here? XY, and the new partner who is going to be admitted is Z. So X, Y, Z, X, Y, Z. Did they ask you balance sheet also? Yes. They asked balance sheet as well.
So there's no fixed capital, so there is no need of capital.
No need of current account, yes. Balance sheet, this is after admission. Here, now let's go further and start. Z is admitted for 1/3 share. Okay, earlier the share was 2:1. So let's get ready. X, Y, Z. X was getting 2/3, Y was getting 1/3. And Z is admitted for what share? 1/3 share. So Z will be 1/3. So total profit, if you take total profit as 1, okay, and Z share is what? 1/3. That means what is the remaining profit? Remaining profit will be 2/3. This 2/3 will be given to whom? X and Y in their old ratio into 2/3 into 2/3, because their old ratio is 2:3 and 1:3. So this becomes 4/9, 2/9. If you take this to same terms, this becomes 3/9. So 4:2:3 is the ratio. 4:2:3 is the new profit sharing ratio, NPSR. You guys can try it at home if you want. Sacrificing ratio with this, your sacrificing ratio will come to 4:2. 4:2, which is nothing but 2:1. When you have a similar working, no, always when you have something like this, when they tell you that new partner is admitted for this share, that time whatever the old ratio is there, that same ratio will be the sacrificing ratio. Can you see old ratio was 2:1? Sacrificing the ratio will also come to 2:1. Okay, if you want, I'll do it for you guys. X, Y, Z. What is the old ratio? 2/1. Sorry, 2/3, 1/3, and 0. Z was not there that time. New ratio is 4:2:3. So 4/9, 2/9, 3/9. So LCM is 9. Okay, so 6 minus 4 is equal to 2/9. Here 9. So 3 minus 2 is equal to 1/9. Can you see this fellow is minus 3/9. Sacrifice, gain. Can you see this ratio is in the ratio of 2:1, 2/9, 1/9? Yes, that's what I was telling. It will be same. Okay, so now let's begin and try to understand. First they said Z is to bring 20,000 as capital. First we'll put this capital into the existing partners, X and Y. Go to partners capital account and write by balance brought down 46,000 and 34,000. Clear? Then after that we have Z is to bring 20,000 as capital. So what is the entry for that? Bank account debited to capital account. So we'll write over here by bank Z is bringing 20,000. 20,000. Next, an amount of 2,000 included in debtors is to be written off as no longer receivable. Debtors, so you'll write bad debt, so you'll write directly to debtors. 2,000. Loss. Next, investments are taken over by Y at their market value of 3,000. How much is the investment value right now? 3,600. They are taken over by Y. But for it to be taken over by Y, what we should do? First, we should make it 3,000. So to make it 3,000, you should reduce the investment. So you'll write over here two investments. 600. Investment value went down. So when investment value went down, after that investment is taken by Y. So what will you write? Y's account debited to investments account 3,000. Y is taking over that investment. Next, after that they said stock is to be increased by 3,100. By 3,100, that means stock account will be debited to revaluation. So we'll write over here by stock account 3,100. Then plant and machinery should be decreased by 10%. How much is it? 35,000. So you'll write 2 plant and machinery, 3,500. So if you see over here, that should be it. Prepare evaluation account, partners capital account, balance sheet. Now, do we have anything? Now, the best part is what they have not told anything about goodwill. Did they tell us anything about goodwill? So, over here, let's stop at this. 2,000 plus 600 plus 3,500 minus 3,100. 3,000 is the loss. So, you'll write by partners capital account loss. We have X and Y who will share this loss. 3,000 into 2 by 3. 3,000 into 1 by 3. That makes it 2,000 and 1,000. So, you'll write 2 revaluation account. 2 revaluation account 2,000 and 1,000. Now they have not spoken about goodwill anywhere, correct? But there is a concept called as hidden goodwill. There is a concept called as hidden goodwill. Now this partner brought money. Okay, how much money he brought? 20,000. So Z's capital is 20,000. Z's share. How much is Z share? 1 by 3, right? 1 by 3. Therefore, what is the total capital that is required? Total capital should be 60,000. Total capital should be 60,000. So now, what was the existing capital when he came? The existing capital when he came was, these two partners had how much? 46,000 and 34,000. 46,000 plus 34,000. 80,000. There's no goodwill, guys. Existing capital is 84,000. Required capital is only 60,000. Therefore, you can see there is no concept, no hidden goodwill. 80,000. Existing capital is 80,000. Okay. So, based on his share, what we are getting? 60,000. So, actually, there is no goodwill in this question. They have not told anything about goodwill. Imagine over here, when I did this, if I would get 90,000. So existing capital is 80,000, but he brought for 90,000. That means 10,000 will be goodwill. Clear? So now they have not told anything about goodwill. So what we'll do now? Partners capital will close and we'll write 2 balance carried down. Exit is 44,000. Why it is 30,000 and this one will be 20,000. So directly you can write in balance sheet itself capital X, Y, Z. X is 44,000, Y is 30,000 and Z is 20,000. Z is 20,000. Yes. Now wait. Now we have to go into the other things. Creditors. Did you make any change to creditors? In revaluation? Nothing. Creditor directly 20,000. 1,14,000. Now let's go and check the other side. 1,14,000. Now land and building. Did we do some revaluation to land and building? No, we didn't. Land and building was 30,000. Land and building 30,000. Next, after that, next one is plant and machinery. Plant and machinery, what we did, we reduced it. So plant and machinery will now be 31,500. 35, I did 31,000. So stock is how much? Stock is 12,000. It is to be increased. So stock will be 15,100. Then debtor is how much? 11,400. But there was something bad, right? 2,000 was written off. Debtors will be 9,100. Oh, sorry, 9,400. 2,000, no bad debts. Investment what gone? Bank 8,000. Bank was 8,000 plus new partner brought how much money? 20,000, 28,000. 1,14,000 selling. Yes, this should be your balance sheet, guys. So this is your easy question which they have asked in the model test paper. Revaluation account, partners capital account. Okay, and this is your balance sheet. These are your ratios if you want any ratio calculation. And goodwill is not there. We checked even the hidden goodwill route. There is no goodwill there, so we can ignore that part. Done. We'll check if there is one more question there. Usually at the 8C. I think this question also we have seen. S and N are partners sharing profits and loss in the ratio 5:3. They admit J into partnership 3/10 share, in which J acquired 1/5 share from S, 1/10 share from N. Calculate the new profit sharing ratio. I hope you remember this question. S, N and who is the third person? J. J is getting what? 3/10. Okay, S was getting 5/8 and 3/8. From S they are taking 1/5, from J N they are taking 1/10. So this is basically 40. 8 5s are, so 25 minus 8 is equal to 17/40. This will be again 40. 8, 15 minus,
So 30. No, yeah, 30 minutes. No.
no, 15 minus,
So 12 minus.
15 minus 4 is equal to 11/40. So this is 3/10. So that makes it what? 12/40. 17 is to 11 is to 12. Correct, no? 28, 12, 40. Yes. 17 is to 11 is to 12. This should be the question that they've asked for 4 marks. Okay, with that we are done with the model test paper 1 also. Okay. So with that we are actually concluding partnership. So basically chapter 1 done, chapter 2 done, chapter 3 done, chapter 4 done. So major chapters which cover majority of the marks is done. So let's go into the next chapter. Okay, so next chapter we'll go into is departmental accounts, and departmental accounts will solve, we'll go through the concepts first and then we'll go into the questions. Okay, departmental accounts. Okay, so basically usually what we do, we prepare financial statement of the entire company or entire business. Till now we were seeing entire business, we were seeing on balance sheet, entire business P&L and trading account was there. Now imagine I tell you, for example, there is Ram and Co. Okay, he is doing a business, mobile, TV and AC. Mobile business 5 crore profit, TV business 1 crore profit, AC business 4 crore profit. If I hide this information from you and I tell you that Ram and Co is having 2 crore profit, you'll be happy only. 2 crore profit is there. But if I disclose this information to you, then I know that 5 plus 1 could have been 6 crore. Because of this loss, right now this loss got set off and I have only 2 crore profit. I have only 2 crore profit. So basically departmental accounts is looking into the business from a micro angle. Looking into the business from what? From a micro angle. So that if I correct this situation here, that time I can get 6 crore profit. How much ever loss I can reduce over here, the overall profit of the company keeps increasing or business keeps increasing. Clear? So now, imagine capital of 1 lakh and profit for 2024 is 2 crores. You would have been very happy. But capital of 1 lakh could have gotten you profit of actually 6 crores. That would have been even better. Now, distribution of expenses. Now, you will have to prepare in this chapter, very simple chapter. You will have to prepare departmental trading account, departmental P&L account. Okay, balance sheet will not be departmental, it will be together. Now, departmental, when we are solving this, okay, rent. Okay, rent, always it is distributed on floor area. Whatever floor area is there, distribute the rent and floor area. Electricity will be lighting points or units consumed. Sometimes they'll give in the question called as lighting points, or they might give it as units consumed. In that ratio, you are going to distribute. Clear? Advertisement. Advertisement will be done on the basis of sales ratio. Advertisement is done for the purpose of sales. So in the ratio of sales only, advertisement will be apportioned. Carriage inwards. Carriage inwards means what? Carriage which is paid when the truck is coming into your factory. That means it is for purchase. That means carriage inwards you will apportion on the basis of purchases. Carriage outwards. Carriage outwards will be on the basis of sales. Carriage outwards will be on the basis of sales. Discount allowed. Discount allowed. Discount allowed, you have to understand one thing. It will be done on the basis of credit sales. It will be done on the basis of credit sales, because discount is given to the people when we are selling goods, and it's not for cash discount, it's for credit sales, or it's on the basis of sales. Now understand why credit sales or sales I have written over here, because if it is for credit customers, then credit sales. If it is for overall customers, it is sales. Okay, usually we give discount for only people who make payment on time. That means if time period was given 90 days and they pay in 30 days, that time we are going to give discount to them. Discount received on the basis of credit purchases or on the basis of purchases. Salary and wages which we have, it is on the basis of number of employees. Number of employees in each department they will give you. On that basis you just distribute the salary and wages. Stock reserve is a very, very important concept. Stock reserve will be part of this unit, as well as when we discuss branch accounts also, we will have to see stock reserve. Now, stock reserve, if one department transfers goods to another department at invoice price. If one department transfers goods to another department, we are not going to talk about stock reserve. But if one department transfers goods to another department at invoice price, that means profit is included. That time we are going to talk about stock reserve. And the receiving department still has these goods. Now, see over here. Department A is there. Department B is there. Department A and Department B. Now, Department A has transferred the goods, cost was 100, it has transferred at selling price 120. Now, the person who has sold, he is taking it as sales. Person who has received, he is taking it as purchases. And the person who has received, if he has not utilized it, for anything, or if he has not sold it, it will be still sitting in his closing stock. If it is sitting in his closing stock, for the business, what happens? Profit is recorded because Department A has sold and profit comes into the business, and Department B is still showing it as closing stocks. For the business, stock has not gone anywhere. It has just gone from Department A to Department B. Department A and Department B both are part of the business only. Therefore, when this happens, profit of 20 will be there in the business, but stock is still sitting over here. Imagine I removed the stock from one hand and put it to another hand, and I'm telling 20 rupees profit. If I remove the stock from one hand and throw it outside and tell 20 rupees profit, that makes sense. I gave it to somebody. I remove the stock from one hand to another hand, 20, and I transfer it to somebody outside. That gives me profit. But I just transferred from one department to another department, and I'm telling profit. But for the business, it is not profit because Department A and Department B both are same for the business. So whenever it happens like this, one department transfers goods to another department and the receiving department still has these goods in closing stock. That time we have to calculate stock reserve. Stock reserve is nothing but unrealized profit. Stock reserve is unrealized profit. So what we will do, 20 will be taken as unrealized profit and we will reduce it from profits. Reducing from profits, how we can do? Reducing from profit means how we can do it? P&L will be debited. Reducing from profit means P&L will be debited. And we have to reduce it from stock also. So in the balance sheet, you will show it as minus from stock. So actually, its journal entry for this is P&L account debited to stock reserve. P&L account debited to stock reserve. When P&L is debited, profit reduces. When stock reserve is credited, it is reduced from the stock as well. Now, if half the goods are still in Department B, till now what we were talking about, if full goods are there in Department B. Now, what if half the goods are there in Department B? If half the goods are there, that means half the profit is unrealized profit. So, 20 into half, 10 will be shown as unrealized profit. If I tell in the adjustment, 25% of the goods are sold by Department B, 25% of the goods are sold, that means 75% of the goods are not sold. That means 75% of the profit is unrealized profit. So 15 will be shown as unrealized profit. Now stock reserve entry, see P&L account debited to stock reserve, and this stock reserve will be shown as liability in the balance sheet. But what we will do for better presentation, we'll bring it to the asset side and reduce it from the stock itself. Previous year stock reserve, last year we have created stock reserve, that means last year it was unrealized profit, that means this year it is realized profit. So remove the stock reserve and transfer it to P&L, reversal of previous year unrealized profit. And with that we are done with the discussions of departmental accounts. Okay, let's go into the questions of departmental accounts. The departmental accounts questions, the first one, we'll solve the question number 6 from study material. The following details are available in respect of business of a year. You have X, Y, and Z, 3 departments. They have given you opening stocks. They have given you purchases. They have given you sale units and selling price, both. The total value of purchase is 1 lakh. This is the total cost. They have spent 1 lakh. It is observed that the rate of gross profit is same for each department. Each department's gross profit rate is same. Prepare departmental trading account for the above year. Departmental trading account. So now here, it's a very small question, but it's tricky. So now this is the departmental trading account. Now if you see, only the sale we know directly. Correct? Sale is directly given. Now what we can do is sale 1020 units, 1920 units, 2496 units. We know the sale units, correct? And we know the purchase units. Purchase price we don't know. So what we will do is, we'll take the purchase. Okay, we will assume that whatever is purchased, if it is sold, whatever is purchased, if it is sold, what will be the sale value of the purchases? So selling price per unit we have. So multiply the purchased value, purchased quantity into the value, that I will get the sale value. Sale value of goods purchased. Now sale value of goods purchased is giving you 1,25,000. And cost value of goods purchased was already given in the question as 1 lakh. So now this is 1 lakh. So now what is the profit then? 25,000. So 25,000 divided by 125, 1,25,000, you got gross profit ratio of 20%. Moment you got the gross profit ratio, everything is solved. See, selling price, gross profit, you got cost. Selling price, gross profit, you will get cost. Selling price, gross profit, 20% when you take, you will get the cost. When you get the cost, opening stock units are there. Multiply opening stock into all the costs which you got. Purchase units are there. Multiply the purchase units into the cost what you have. Done. Closing stock, we don't have units, but we can get the closing stock units. Opening stock plus purchases minus the units sold. That time you will get the closing stock. Once you get the closing stock units, just multiply into the cost. You will get, everything is supposed to be at cost only. Now that time you will get the balancing figure. In fact, this also is not balancing figure. Sales into 20%. Sales into 20%. That is the question. Only thing is you have to crack that gross profit percentage. Once you get that gross profit percentage, it is solved. Now, we'll go and check the departmental questions of June. I think in June, they haven't asked any departmental question. Correct? If you notice, till question number 4, almost we have finished everything. Branch is there, insurance claim is there. Yes, there is no departmental question in June. Now I am going into December 2024. December 2024 also looks like there is no departmental accounts question. Next, we go into June 2024. June 2024 also you don't have departmental accounts question. Next, we go into December 2023. December 2023, if you check, there also they have asked branch accounts only. There is no departmental accounts question. Back to back, they have not asked. That means they can ask any moment. Mock papers. Let's look at the mock papers. Consignment, hire purchase, NPO, partnership, branch. See, branch is like very consistently asked. Insurance claim, AS. No departmental accounts question in that. Yes. Now June. Going into June. Yeah. There we do only one, no man. Remember, it is same. December 23 we'll do only one. Yes, finally we found one departmental accounts question. It is 6A. 6A in June 2024, set 1. Now, Mithil Mukherjee sells 2 products manufactured in her own factory. The goods are made in 2 departments, X and Y, for which separate set of accounts are maintained. Some of the manufactured goods of Department X are used as raw material by Department Y and vice versa. From the following particulars, you are required to ascertain the total cost of goods manufactured in Department X and Department Y. Now, we have total units manufactured, total cost. It's almost similar like the one which we just saw. Total cost we have and total units. Department X transferred 2,50,000 units to Department Y and the latter transferred 1 lakh units to the former. Now, simple question, 7 marks. Now, suppose A is the total cost of Department X and B is the total cost of Department Y. Why they have kept A and B? Because they asked you to calculate, ascertain the total cost of goods manufactured in the Department X. We know what? Total units manufactured, total cost of manufactured goods. Now they want you to find out total cost of goods manufactured. So here have a look at this. 10,000 is the cost, correct? Plus 1.5B. What is 1.5? They said that 2,50,000 units were transferred to Department Y. 2,50,000 units were transferred to Department Y and then 1 lakh units were transferred to the former. Now understand this. They are taking, instead of X and Y, they are taking A here. A is the total cost of Department X and B is the total cost of Department Y. Clear? Now, what is this 1.5 and what is this 1.4? Okay. What is this 1.5 and what is this 1.4? Now, 1.5 is, see, Y transferred, okay, later transferred 1 lakh units to the former. So 1 lakh out of 5 lakhs, 1.1 by 5, and 2,50,000 out of 10 lakh units, 1 by 4. So they have transferred 1/5 of their goods to us, okay, and we have transferred 1/4 of our goods to them. Okay, so 10,000 plus 1.5 of whatever their cost is there, 5,000 plus 1.4 of whatever their cost is there. When you substitute all this, you are getting A as 11,579, B as 7,895. Clear? You just have to substitute A in B or B in A. Okay. Now see, 10,000 plus 1.5B and 5,000 plus 1.4A. Now what will you do? See, you just have to put 10,000 plus 1.5, 1.5B, right? B is what? 5,000 plus 1.4A. So substitute this. This is full B which is given over here. Substitute it, and then when you substitute, you'll get A as 11,579 and B as 7,895. When you substitute, when you solve that equation. Now, total cost of goods manufactured. See, cost which is already given, 10,000 and 5,000, cost was given in the question itself. Add the cost of goods transferred. We got the cost of goods transferred. Difference, 11,579 was total. Cost of goods transferred was 1,579. 7,895 was the total. So cost of goods transferred is 2,895. So when you got that, let's transfer to the department. Okay, this one and this one. When you put it, you will get the cost of goods manufactured. Clear what we have done? Cost which is already given, to that we add the goods which we have transferred. Okay, that time we will get our total cost. Now from the total cost, what we will reduce is what goods came from that department. What goods came from that department, if you subtract, remaining cost is of the goods which were manufactured in this department. This is our solution. Is this clear? Yes, this is one question which we found in June. Then we go into set 2 of December. Do we have any departmental accounts question? Yes, there is a departmental accounts question, 6A. Now, the firm has two departments, raw material and manufacturing. The finished goods are produced by manufacturing department with raw material supplied by raw material department at selling price. Now, finished goods department will be selling. Raw material department will be supplying goods, and raw material department will supply goods at their selling price. Prepare departmental trading and P&L account by using the following information for the year. Now, opening stock. Things, see, in departmental accounts, things which are given direct. Okay, it's like fill in the blanks. Opening stock 120 and 20, correct? See the departmental account, 120 opening stock, trading account, you'll find this. 120 and 20. Next, purchases, 8 lakhs, 6,000. Directly you'll write 8 lakhs and 6,000. Next you have sales, 8 lakh 80, 1 lakh 80. Directly you will put 8 lakh 80 and 1 lakh 80. Next, manufacturing expense, 0 and 24,000. So directly you will write 0. Sorry, not that one. 0 and 24,000. Now, selling expenses, 1,600 and 800. Selling expense should go to P&L. So in P&L you will find 1,600 and 800. Next, raw material transferred to manufacturing department. Raw material transfer. Who is transferring? Raw material department. So for raw material department, this is like sales. For manufacturing department, this will be purchases. Raw material department transfer to manufacturing department. So one department it is sales, other department it is purchase. So can you see under raw material department it's on the credit side, under manufacturing department it's on the debit side. Yes. Then closing stock directly given 80,000, 24,000. Closing stock 80,000, 24,000. Now cost of closing stock of the manufacturing department consists 25% of the manufacturing expenses and 75% of raw material. So what they are telling is in closing stock of manufacturing department, 75% is raw material and 25% is their own material. Now why they are telling that is because you have to calculate your stock reserve. To calculate stock reserve, they are telling you this. In the preceding year, raw material department earned gross profit at the rate of 10%. Last year, they earned a gross profit of 10%. Salary of 5,000 and insurance premium of 1,600 are allocated between two departments on the basis of their sales ratio. So, salary 5,000, we will distribute in what ratio? Sales ratio. See the sales ratio 180 and 180, sorry, 880 and 180. Now, if you see, if you do 8,80,000 plus 1,80,000, you get 10,60,000. 8,80,000 divided by 10,60,000 into 5,000. If you do, you will get 4,150. And same way, 1,80,000 divided by 10,60,000 into 5,000, you will get 850. Now, no need to do 44:9. Why? You have calculator, right? Full number. Why to simplify? Full number you take sales 880 and 180. In that ratio, just distribute. Insurance premium also, they said the same thing. Insurance premium is 1,600. So what will you do for insurance premium? Same thing, 1,600 in the sales ratio. So 1,600 into 880 divided by 1060, 1328. So the other one will be 272. Clear? So everything is sorted till here. Now if you see, from here what you are doing? Just finding the gross profit balancing figure. And that gross profit will go here. This will be a net profit. This will be a net profit. But the only problem is to calculate stock reserve. See, the net profit fully will come here. If you total this these two net profits are here. Only thing is what? Calculating stock reserve. Now, stock reserve you have to understand. Whose closing stock will have stock reserve? The receiver. Receiver is who? Manufacturing department. What is his closing stock? 24,000. What is his closing stock? 24,000. Now, how much did they tell was part of that? 75%. 75%. So what will happen now? 24,000 into 75% is equal to 18,000 is what we received from other department. What we received from other department, in this whose profit is there? Other department's profit is there. Now you have to see the closing stock of receiver. Receiver is the manufacturing department. Manufacturing department has this closing stock. In this profit is included. But full whatever is there over here is not what came from there. 75% is what came from raw material department. Raw material department has made profit in this. Raw material department has made how much profit? If you look at the trading account, you will find out. Raw material department 1,60,000 divided by 10 lakhs. 16%. 1,60,000 divided by 10 lakhs. First you have to understand why is this 10 lakhs. Sales is 880 and transfer is 120. To the other department also they sold at selling price. That's why there is stock reserve. If they would not sell at selling price, there would not be stock reserve itself. So now what will you do? Into 16%. 18,000 into 16%. 2,880 is the stock reserve that you require. Now, same way in the opening stock also, can you see opening stock here? In this also there is goods which has received from other department into 75% is equal to 15,000. But on the opening stock, they did not make 16% profit. They told in the question that last year gross profit rate was 10%. Into 10% gives you 1,500. So now 2,880 minus 1,500, 1,380 is what stock reserve you have to create. P&L account debited to stock reserve, balance everything will go to capital. Done. They have also shown the calculation here, you can have a look at it. Yes, then we go into December 24th at 1. Do we have any departmental insurance claim? Branches. So if they give branch, they don't give departmental. After that, 4. Do we have departmental here? Here also they have given branch. I don't think there is any departmental. Next. Here also they have given branch. So there is no departmental. Now we'll see our recent model test paper. Here also 6A is branch. Then we have here also branch. Wow. Departmental, guys, it's a very, what do you say, a rare question. Okay, because of its rarity only, they might just ask in the exam also, because it's not asked for a very long time. Yes, with that we are done with departmental accounts. Now we'll go further to insurance claim. Insurance claim is a very common question. How rare departmental accounts is that much common insurance claim is there. Okay, students, let's go into insurance claim. Next one. This one is a commonly asked topic. So let's proceed. Insurance claim. Now, when we are talking about insurance claim we can receive from life insurance is there, vehicle insurance is there, health insurance is there, marine insurance is there, transit insurance is there, fire insurance is there. All these insurances are there, but here what we talk about is only fire insurance. Now, when we go to fire insurance also, there can be loss of stock, loss of assets, loss of people. Obviously, people also can be burnt in the fire. Loss of profit, but they are not talking about loss of assets and loss of people because it's easy to compute or there isn't any complication. They're mainly talking about loss of stock and loss of profit. So we have two parts in our insurance claim, that is loss of stock and loss of profit. Both of them are easy and very commonly asked in the exam. Okay. So first we go into loss of stock. Loss of stock when I'm talking about. Now, first step, prepare memorandum trading account. Now, memorandum trading account. First of all, you have to understand why did we use the word memorandum here. Memorandum is used because this is not our trading account at the end of the year. This is our trading account just to find out how much goods were there on the date of fire. To find out what? How much goods were there on the date of fire. Clear? So, memorandum trading account you will prepare from. Now you have to think, when did I prepare the trading account before this? I prepared last year. So, last year end till the date of fire. So, from the date of previous year end till the date of fire, for this period you will prepare your memorandum trading account. Clear? Purpose you have to understand, to find the closing stock on the date of fire. Now, opening stock will be the closing stock of previous year. Previous year closing stock will be the opening stock because we are starting from previous year end. Now, purchases till this year till the date of fire. Obviously, this will be given in the question, purchases from this date to this date. Now, direct expenses also this year till the date of fire. Sales this year till the date of fire. All this information will be given in the question. May have some small twists here and there, but will be given in the question. Now, gross profit we have to find. Usually, if I prepare trading account, gross profit is balancing figure in our final account chapter. But here, I have to find gross profit because closing stock is balancing figure for me. Now you can't tell, sir, can't we get the closing stock? Boss, closing stock was there on the date of fire. That is burnt. Now we don't know how much was there on the date of fire. So gross profit if you find, you will get the closing stock on the date of fire. Now, simple. If the question they gave gross profit, then take the gross profit percentage, okay, directly multiply into sales, finished. If gross profit percentage is not given in the question, then what you will do? Prepare trading account of previous year. Previous year trading account will prepare normally and you will find the gross profit percentage. Previous year trading account, you take the gross profit divided by sales into 100 you will get the gross profit percentage. Clear? Now, after that, step 2. Once you find the closing stock on the date of fire, the next step what you are going to follow is computation of loss of stock by fire. This much stock was there. That doesn't mean that much stock is lost, right? Now you have to find how much stock is actually lost. closing stock on the date of fire minus stock salvaged. Stock salvaged means stock saved. Something was kept in one corner, that nothing happened to that. That is saved from the fire. Stock salvaged minus savings, if any. It was getting burned. Suddenly fire department came. They started putting the water, and because of that some stock got saved. So that is also not damaged. Minus additional expense. Fire department came. We have to pay them money. That is an extra expense for me. Add. When you do this, you'll get the loss of stock by fire. Loss of stock by fire. Now you have to see computation of claim. You got to know how much stock was there on the date of fire, but that much is not lost because of savings. It got reduced, and this is the loss of stock by fire. Now computation of claim. Now computation of claim, what you're going to do is average clause. Now average clause will always be there. It's not a clause which is there because of accounting. It's there. It's a clause which is there in insurance contracts. Now applicable only if there is under insurance. Average clause is applicable what? When there is only under insurance. And what is under insurance? Under insurance means you took a policy for a lower amount. So insurance policy amount is less than the closing stock on the date of fire. Imagine closing stock on the date of fire was 500, but your insurance policy amount is 400. That means to save the premium, you have actually taken a policy for lesser amount. So now what insurance company is telling, boss, you took policy for lesser amount, I will give you on an average based on this proportion itself. So if at all insurance policy amount is less than the closing stock on the date of fire, that is considered as under insurance. That time the claim will be like this. Loss of stock by fire into policy amount divided by closing stock. Imagine your closing stock on the date of fire is 500 and you took policy also for 500. So 500 divided by 500, 1. So you will get full amount. Whatever you lost, you will get the claim. But imagine your closing stock on the date of fire is 500, but you took policy only for 300. Then you will get only 300 divided by 500. Whatever 300 divided by 500 is there of the loss, that much only you will get. Is this clear? Now, if no under insurance is not there. That time claim is loss or policy, whichever is less. Imagine you lost 500, but your policy is only 400. You will get 400. Imagine your loss is 200, but your policy is 500. You will get 200. You will not get 500 because you lost only 200. This is your loss of stock. So what is first step? You have to prepare memorandum, trading account. For what purpose? To find the closing stock on the date of fire. Second, what you have to prepare? Loss of stock. You have to find the loss of stock by fire. Savings, salvage minus, add the additional expense. Then check whether there is under insurance. Under insurance is what? Closing stock on the date of fire. You compare it with this thing. What is it? Policy amount. Policy amount higher. Okay, no problem. Policy amount lower. Under insurance. Clear? If under insurance is there, loss of stock by fire into policy amount divided by closing stock on the date of fire. You might have different formula and all, but ultimate answer will be same. Clear? Use this formula itself. Now, next you go into loss of profit. Now you are like, sir, on the date of fire, we had stock that got lost. For that, there is loss of stock policy. Correct? Now, what is this loss of profit? What is this loss of profit? On the date of fire, stock was there damaged. But on that, after that, next day onwards only, can you start doing your best business? No, you will require some time to recover from that fire. You have to repair things, all those. You will put your energy into that. So that is when we take the loss of profit policy. Okay, insurance company compensating for loss of profit during the period affected by fire. After the fire is over, some period will be affected by fire. That period, whatever you lost, that amount is compensated by the insurance company. Clear? Now, computation of claim for loss of profit. Now you have to just follow steps. Follow these steps. It's a cakewalk. Okay. Step 1. Identify the period for claim. Now you have to see period affected by fire, 6 months. Indemnity period as per policy. As per policy, they had already decided that is showing 5 months. Now how much claim you will get? Only for 5 months. Imagine period affected by fire is 6 months. But as per the policy, the indemnity period is 8 months. So good, you will get it for 6 months. Clear? The period affected by fire or the policy period, indemnity period as per policy, whichever is less. Step 2, compute the gross profit percentage. Now gross profit percentage normally we'll do like this. Gross profit divided by sales into 100. This is not that. Here it is net profit of previous year. Take the net profit of last year plus insured standing charges. What is this? Yeah, recurring expenses. Expenses going to be compensated by the insurance company. When you are opening the policy on, we are sitting and discussing, okay, these are the expenses which will be there. Even if fire is there, this will keep recurring. There are some expenses, if fire is there, these expenses will not be there. Insurance company is like, what cannot be avoided, I'll give you. What can be avoided, I'm not going to give you. So, net profit of previous year plus insured standing charges divided by sales of previous year, that time you'll get the gross profit percentage. Now, gross profit percentage calculated under loss of profit policy and loss of stock policy are not same. Remember this, the gross profit percentage of loss of stock policy and loss of profit policy are not same. Here we are looking from a different angle altogether. Clear. Step 3. Compute the standard sales. Standard sales means what? This is like you studying. You're like every day you're studying for 7 hours. This is my standard study time. Correct? Standard sale is same thing. Sales what you did during the previous year, during the same period of current year which is affected by fire. Imagine this year, fire occurred on 1/7. Okay, and affected period is from 1/7 to 39. So July, August, September, 3 months I was affected by fire. So last year same time. Last year same time is called as standard sales. Clear. Step 4. Compute short sales. Compute what? Short sales. What is short sales? Last year same time, boss, I did this sale. Okay, this year during the affected period I did this sale. So if I talk, obviously it will be less, it is called as short sales. So last year I made 1 lakh sales during the same time. This year I made only 80,000 sales during the same time. So that means 20,000 is your shortage of sales. Short sales. Now, they are not giving you money for shortage of sales. They are giving you money for what? Shortage of profit. The policy is not loss of sale policy. It is loss of profit policy. So whatever sales you have shortage over here, short sales into gross profit percentage which you computed in step 2, you will get loss of profit. That is your loss of profit. Clear? Step 6 is additional expenses claim. Step 6 is what? Additional expenses claim. Now, because of policy, because of fire, you are badly affected by fire and you could not do anything. Now, you could not sell anything actually, but you spent some extra money and hired 2-3 people. Because of that, you are able to sell something. That is this additional expenses they are talking about. Here you have to see whichever is less. First one is actual, which is given in the question only. Second one is gross profit percentage into additional sales due to additional expense. They can give language like this. They might tell additional expenses 10,000. If not for this expense, the sales would have been only 50,000. Sales would have been only 50,000. Right now, the sales during the affected period is 2 lakhs. That means 1,50,000 you made just because of this additional expense. Did you get this? So, additional sales due to additional expense. Multiply the gross profit percentage. And the last one is one formula which you have to remember. Additional expenses into gross profit on annual turnover divided by gross profit on annual turnover plus uninsured standing charges. Okay. Now, annual turnover means not last year sales. Annual turnover means fire occurred on 1st July. Yeah. Before 1st July, 12 months. Annual turnover means last 12 months before fire. Not last year sales, not this year sales, nothing. Fire occurred on 15th February. Before 15th February, 12 months. That is your annual turnover. Clear? Step 7. Total claim. Now, whichever is less in this, that you will take it as additional expenses. Okay. Now, step 7, total claim will be loss of profit, which you got in step 5, additional expense, which you just calculated in step 6, and savings, if any, which will be given in the question. If you minus, you will get your total claim. Now, note, if there is a trend, standard turnover and annual turnover must be adjusted for the trend. Trend means what? Last year sales is 1 lakh, but this year market is better. Actually, we would have made more. So 1 lakh was last year. This year, if there was no fire and all, I would make 1,10,000. Correct. So when you're taking standard sales over here, if there is trend in the question, you have to add or minus the trend. And when you're calculating annual turnover over here, that time also you have to add or minus the trend, whatever is given in the question. With the turnover value. Turnover only you take at higher value if it is trend 10%. Standard sales also here you take with the trend. If trend is there, add 10% and take the standard sale. Okay. Yes. Now under insurance, we have to check here also. Under insurance means what? Here the policy is for loss of profit. So policy amount is less than gross profit on annual turnover. Annual turnover is what? Last 12 months sales. When you're taking annual turnover, what you have to do? You have to adjust it for the trend. Clear? Now claim is equal to total loss into policy amount divided by gross profit on annual turnover. Same for formula we had there also. There we used loss of stock into policy amount divided by closing stock on date of fire. Okay, now here it is policy amount divided by gross profit on annual turnover. Total loss into policy amount divided by gross profit on annual turnover. Under insurance check you have to always do, because if there is under insurance, you will always be having our average clause applicability. If there is no under insurance, it's pretty straightforward. This is the concept of insurance claim. There are a lot of questions. I feel that when we solve all those questions, all the concepts will again get rebrushed. Okay, June 2025. Yes, let's go into the problems. Okay, before we go into the problems, we will solve one question from the material on public demand. Yes, question number 10. A fire occurred on March 15, 2023 in the premises of Omega Limited. A loss of profit policy was taken by Omega Limited for 80,000. That means they already had a policy for 80,000 loss of profit. The indemnity period is 3 months. Okay. Net profit for the year ending 31st December 2021 was 56,000 and standing charges. When did the fire occur?
15th March.
15th March 2021. Okay. Now, amounted to 49,600. Determine insurance claim from the following amounts available for quarterly sales tax return. 2019, 20, 21, 22. They have given the last 4 years, every quarter sales. Clear? Now, sales from 16th March to 31st of March. They have given. Now, here you have to understand one thing. Okay. Indemnity period was 3 months. That means they are affected for what period? 16th March 2023, April, May, June. That means 15th June 2023. This is the time period, 3 months they're affected. Now, have a look at this. Period is 15th March to 15th June. Okay. 16. You can take it as 16 because next day, or doesn't matter. 15th only you can take it, no issues. 3 months basically. Clear? Now, gross profit percentage, we discussed the formula that time. Gross profit is what? Net profit of previous financial year. Previous financial year net profit was given to you 56,000. 56,000. Okay, year ending was 56,000 plus standing charges 49,600. Now, 56,000 plus 49,600 divided by sales of previous financial year. Previous financial year, what is the sale? Can you see the previous financial year here? 130 plus 40 plus 1 lakh plus 1 lakh. Sorry, 130 plus.
Sir, it is 528.
528. For 2021 now. Because they gave you gross profit of 2021. Okay. So 5,28,000. You will get gross profit rate of 20%. Step 2 done. Step 3, standard sales. Standard sales, you have to be a little careful. Now, standard sales, you understand one thing. Okay, you are calculating from 16th of March 2021 to 15th of June 2021. Last year, 3 months. This is our indemnity period. So, same, if you replace it with 1 and 1, it will become last year. Now, we don't have for this period. So, what we will do? 16th March to 31st March 2021. They have given here. 16th March 2021. I think there are some date issues, right?
Because it's not 2023, from 2022.
Yeah, so it should be like this. See, 2019, 20, 21. This should be 2020, 2021, 2022, and 2023. That should be the years. That's why we took 2000.
22 as
Yeah, this is 21 given in the question. It should be 2022. This is the year 2022. From here they have given everything properly. So now 2022 last year 16th March to see we need for which period? We need for 16th March 2000. Okay, it's written as 21 here, but 22 it is 16th March 2022 to 15th of June 2022. Now the thing is, okay, what you have to understand is we don't have like this broken period. We don't have. We have every quarter. Every quarter. So here in March, how many days I need? only 15 days. But that period is given, see, 28,000. 28,000. So this is the 28,000. Then next quarter. Okay, next quarter is April to June. We know already April to June is how much? 1 lakh. But 1 lakh, in that I don't require the last 15 days. Last 15 days they have given. Can you see 16th June to 30th June is 24,000. So remove the last 15 days. That time we'll get 76,000. This is your standard sales. This is your standard sales. But at the end of the question or anywhere, now can you see there is actually every year there is increment. Can you see the total sales once? They have not given us any turnover and all, but you have to check. 120 plus 80 plus 1 lakh plus 136, 436. This is 4,36,000. If you see next year 134,
80, 520.
80 and 528. So 480 minus 436. Are you sure it's 436?
Yes, 480, 480 and 436.
480 and 436. Now if you see from last year to this year, and 480 to 528, there is a 10% increase. There's a 10% increase. If you add 10%, you'll get that. So we are assuming that that same continuation of 10% would have happened here also if there was no fire. If there was no fire. So now what happened over here? Whatever standard sales I found out, to that I'll add 10%. This will be my standard sales. I told you trend, whenever you see trend, you should add the trend. So this will be your standard sale. Now short sales will be, standard sales we know 1,14,400 minus whatever we have incurred, whatever sales we have made during the affected period. What is the affected period? 15th March 2022 to 15th June 2022, 23. So now if you see over here, 15 days 0 as soon as fire happened. After that, if you see in this quarter, how much I made in this quarter? 40,000. But out of that 40,000, I don't require the last 15 days sale. So remove 6,000. So you made only 34,000. When you subtract that 34,000, you will get your short sales. To the short sales, directly apply the profit percentage. You will get loss of profit. Additional expense, in the entire question, they have not spoken about any additional expense. So total claim will be loss of profit only. Now claim, average clause you have to apply. Okay, average clause to apply. See, annual turnover we need. Annual turnover, what we are going to do? March, 16th March till 15th March, last 12 months. So 16th March 2021, we knew that it was 28,000. Then every quarter you take the sale. Every quarter you take the sale, add 10% to that. Why you are adding 10%? Because last year to this year 10% increase. Add 10% to that. Then take this quarter sale, first quarter sale of 2022, take the first quarter sale, remove 0. What is 0? The 15 days sale. From the date of fire till the end of March, 15 days sale. Date you forget. We have taken 21, 22. 20, whatever you see as 21 is 22. Whatever you see as 22 is 23. Okay, this is last year, previous year. You take all previous year numbers, add 10% to that. But here you are going to take only 15 days. And this 15 day sale is given in the question itself here, 28,000. Now here, we have to stop at this part and add 10% to that, because last year sale to this year, 10% increase is there. Add 10%. Then this year, first quarter when you are taking, it's already increased number only. From that, remove the fire affected 15 days. In March, after March 15, there is a fire affected 15 days. Remove that. There we made 0 sale actually. Remove 0. You add this, you will get your gross profit. You'll get your annual turnover. On annual turnover, apply the percentage. You got 117,080. Policy is only 80,000. That means under insurance is there. Directly apply the formula, you will get the claim. Is it clear? Yes. Next, let's go into exam questions. Insurance claim. Now, on 30th March 2025, fire occurred in the premises. Third question only they have asked for 7 marks. Usually they ask, very often they ask insurance claim. Okay, so third. 3A. Yes. Their presentation might be missed. Now we'll have to solve if the presentation is not proper. Now, first of all, you go and check. You are required to compute the amount of claim to be lodged by to the insurance company. Okay. Fire occurred in the premise of Rajesh and Co. Concern has taken insurance policy of 1,20,000 subject to average clause. From the books of accounts, the following particulars are available to regarding the period 1st January to 30th March. 1st January to 30th March. Now, stock as per the balance sheet. Now, when you see stock, that means what they are talking about? Loss of stock. No, loss of stock. Stock as per balance sheet. When did the fire occur? 30th March. We want to know what stock was there on 30th March. What is the stock on 30th March? So, what we will do? We have to prepare memorandum trading account from 1st January till 30th March. Starting of the year till 30th March. Clear? Now, they said that stock as per balance sheet. That means last year closing stock is this year's opening stock. 1,91,200. Then they said purchases, including purchase of machinery. We don't want purchase of machinery. We want only purchase of stock. So from this 340, remove the 60,000. You will get only 2,80,000. That will be your purchases. 2,80,000. Next, wages, including 6,000 for installation of machinery. I don't want installation of machinery or wages. Remove that. You will get 94,000. Wages will be 94,000. Okay. Then sales, including goods sold on approval basis amounting to 99,000. No approval has been received in respect of 2/3 of the goods sold on approval. So now goods we have sold 99,000. So understand this. Our sale is how much? 5,50,000. Yes, 99,000 into 2 by 3. Okay, no approval has been received in respect of 2/3. If 2/3, if you have not received approval, that means that has to be removed from sale and it has to be taken as closing stock. So 99,000 into 2 by 3 is 66,000. Yes, 5,50,000. Remove that 66,000. You will get 4,84,000. Clear? Now 66,000 is the closing stock. Okay, and gross profit is 20% on sales. Remove 20% from that 66,000. You are getting 52,800. Can you see 52,800 here? Why you remove 20,000? Because 20%, because closing stock should always be shown at cost. So that's why you're removing the 20%. So with that, it is done. Now what you are going to do? 20% average gross profit is already given. So on this 484, directly apply 20%. You should get 96,800. And this closing stock on the date of fire is the balancing figure. 125,200 was there. And last line they gave that value of stock salvaged 24,600. So 125,200, from that you remove stock salvage. This is your actual loss of stock. Now 125,200 was there on the date of fire. What is your policy amount? Policy amount is 120 under insurance. You are not checking the loss of stock. You are checking the closing stock on the date of fire. 120. So now what you will do? Okay, I will use my formula only. So 120 is the policy divided by 125,200 into what was the loss? 1,06,600. So 120 divided by 421 point something it should be. So 422. Yes, this is your solution. 7 marks. Easy. Okay, June 2025. Next, June done. We'll go into December 2024. December. They asked bills of exchange, that we saw. Higher purchase they have asked. I think they didn't. They asked insurance claim. Always. 6B. On 10th December 2024, a fire occurred in the premises of Chandu. All stock except to the extent of 28,800 were destroyed. All stock except to the extent means what? This 28,800 is your stock salvaged. 28,800 is what? Stock salvaged. Now, Chandu values the stock at cost less 10%. Stock was insured for 1 lakh. 1 lakh is the policy amount. From the following information, ascertain the amount of claim to be lodged by Chandu. Now, anywhere in the question, they have not given you the gross profit percentage. That means we have to calculate the gross profit percentage and come back. Now, 6B. 6B. See, can you see? They are preparing trading account of previous year. Why they are preparing trading account of previous year? Because gross profit percentage is not given. We have to prepare the trading account of previous year and find the gross profit percentage. Now, you can see over here, when did the fire occur? 10th December 2024. Now, 1st April 2023 is last year opening stock, 1,44,000. But they said value stock at cost less 10%. I want the cost. So 1,44,000 is cost less 10%. I don't want cost less 10%. I want exactly at cost to know how much was there. So can you see over here, 1,44,000 is not there. How will you get that reversal now? 1,44,090. How much is 100? You cannot just add 10%. Just because they told that they have reduced 10%, you cannot add 10%. 1,44,000 is 90. How much is 100? 1,60,000 you should get. 1,60,000 is your opening stock. Purchases less returns. Last year's purchases 5,60,000. Then sales less returns. Last year's sales 8 lakhs. Then closing stock 90,000. Again 90,000 is 90%. How much is 100%? 1 lakh. You'll get balancing figure of 1,80,000. Now see 1,80,000 divided by the sales of 8 lakh into 100, you should get 22.5%. Now you got the gross profit percentage. Now you can go ahead and prepare memorandum trading account. Memorandum trading account, what did I tell you? It will always be prepared from the starting of the year till the date of fire. Starting of the year is 1st April 2024. Date of fire was 10th December. So what you will do now? Last year, whatever was the closing stock, that will be the opening stock this year. 1 lakh. Now you have to search. Can you see purchase less returns from 1st April to the date of fire? 584. Directly 584. Then sales less returns 6,40,000. Directly 6,40,000. Now 6,40,000 into 22.5%. 1,44,000. Now the balancing figure is closing stock. Balancing figure is closing stock on the date of fire. What is your policy amount? 1 lakh. Obviously we have under insurance. Now what will you do? From the 1,88,000, remove 28,800. First line only I told you that there is stock salvage. So your loss of stock is how much? Only 159,200. Now what you are going to do? Amount of claim. 159,200 into policy amount was 1 lakh divided by 1,88,000. 84,681. Done. This is your claim. Are you getting 84,681? Yes. Easy 7 marks, guys. You shouldn't lose insurance claim, whatever marks are there. Yes, that should be it. We'll go into the next paper, June 2024. June 24 also, I think insurance claim should be there. Is it there? Yes. Yes. 6B. And they have solved it huge. 2 lines. Huge 2-line solution they have given. Okay. Now we have to follow our steps. Remember the steps we used to use? Okay. This is loss of profit. That's why they didn't solve only. See, from the following information, ascertain the consequential loss claim. Consequential loss claim means what? Loss of profit policy. Now, financial year ends on 31st March with sale of 25,000. That means last year sale. Date of fire was 1st September. Following period of interruption was 1st September to 1st February. September, October, November, December, January, February. 6 months. And indemnity period is also 6 months. Okay. Step 1. I'm going to do here itself. Step 1. What do we do?
Indemnity period and period of affected by fire.
Yes. Period affected by fire is 6 months. And what is that period? 1st September to 1st February. Okay. 19212. Second one. What is our second step? Gross profit percentage. Is it gross profit percentage? Yes. Gross profit percentage. What is the net profit? See, net profit they have given 2,75,000 plus insured standing charges of 3 lakhs. So 2,75,000 plus insured standing charges 3 lakhs divided by last year's sale. Last year's sale is 25 lakhs.
%.
23% is your gross profit percentage. Now, in the question they have told, can you see the question here? Increase in the rate of gross profit 2%. So, add 2% to this. This becomes 25%. This becomes 25%. That is your step 2. Step 3 is what? Standard sales. What is step 3?
Standard sales.
standard sales. That means you have to find last year same time. Uninsured standing charges is there. Sum insured is there. 6,16,000. Standard turnover for corresponding months. 1st September in the previous period. They only have given 7,50,000. Standard sale 7,50,000. But I can't take 7,50,000 because if there is any trend, I have to apply the trend. And they told increase in turnover, standard and annual 10%. So plus 10%, that makes it 8,25,000. 8,25,000 is your standard sales. Next, what do we need? Actual sales. What is actual sales during the affected period? That also should be given directly. Turnover in the period of interruption, 2,25,000. Everything what you require is given as a line item, 2,25,000. Now you will get what? Short sales. 8,25,000 minus 2,25,000 is equal to 6 lakhs. Is 6 lakhs your short sales? Yes. Next, annual turnover they have given. Last 12 months sale which we wanted, that also they have given. Incurred additional expenses amounting to 50,000 with the saving of insured standing charges of 14,000. Now, reduced turnover avoided during through additional expenses 1,50,000. Everything is there. Now, short sales we need loss of profit. Huh? Shall we write separately?
No, we can write the order.
Can, no? But additional expense also will be there, no later. You might not have a space, I think, right?
Also,
Which exam is this?
June 24.
June 24. Yes. Just take it. Whichever they feel it's like too much to solve, no? They just ignore it, right? Only answer they give. June 2024. Question number 6B. Now, we know till short sales. Next thing after the short sales, after short sales, we need loss of profit. Loss of profit is 6 lakh into 25%, which we 1,50,000 is our loss of profit. Now to loss of profit, what should I do? Additional expenses. Additional expenses. Actual additional expense which is there, that is given, right? They have told that incurred additional expense of 50,000. So additional expense actual is 50,000. Then the next thing is the GP ratio. GP is 25% on, reduced turnover avoided through additional expenses 1,50,000. So 1,50,000 into 25%. 37,000. Yes. After that we have next thing. Next thing is additional expenses 50,000 into gross profit on annual turnover. What is the annual turnover? They have given annual turnover is 28 lakh 80, but we cannot take 28 lakh 80 like that. Plus 10%.
30 lakh 80.
Sorry, 28 lakhs plus 10%. 30 lakh 80,000. 30 lakh 80,000 into gross profit rate was 25%. 7 lakh 70,000. So 7,70,000 divided by 7,70,000 plus uninsured standing charges. What are the uninsured standing charges? Uninsured standing charges was 50,000. 50,000. So 770 divided by 820 into 50. How much is it? 46,951. Whichever is less. Which is less in this? 37,500 only is less. So 37,500 will be your additional expenses claim. Now, loss of profit. That is not there in this formula. Insured standing charges we have used here to get the gross profit. Yeah. Loss of profit. Okay. Total loss of profit 1,50,000 plus the additional expenses of 37,500 minus savings. How much did they tell was savings? Savings in standing charges of 14,000 minus 14,000 187,500 minus 14,000, 1,73,500. See, total loss 1,73,500. Now, after that, you have to apply the average clause because gross profit on annual turnover was 7,70,000, but our policy was only 6,16,000. So 173,500 into 6,16,000 divided by gross profit on annual turnover 7,70,000. 616. What? 1,38,800. Can you see 1,38,800 was your amount of net claim? Yes, this should be it. Yeah. Things were given directly in this question. Now, December 2023, the last examination paper that we're going to see. Insurance. Yes, there is. Every single attempt. 6B. 4 out of 4 attempts they have asked insurance claim. Amount of claim of loss by fire is this. Oh, nice. You have to solve it. Yes. December 2023. B. Now, let's have a look at this question. First of all, the value of stock salvaged and policy amount and all that. So they're obviously talking about amount of claim for loss by fire. That is stock only they are talking about. Now, on 1st April 2023, the stock of Mr. Hari Prasad was destroyed by fire. 1st April only, but sufficient records were saved from the following records. Now, stock at cost 1st January 2022, last year. Gross profit percentage is not given. That's why they have given last year's stock. Purchase of last year, sales of last year, purchases from this year till the date of fire, sales till this year till the date of fire. In valuing the stock on the balance sheet date on 31st December 2022, 4,600 had been written off on certain stock, which was a poor selling line having cost of 13,800. 4,600 written off means 4,600 is reduced. We have to add it back. A portion of these goods were sold in March 2023 at a loss of 500 on original cost of 6,900. Remainder of this stock was now estimated to be worth its original cost. Subject to the above exception, gross profit remained at a uniform rate throughout the year. Value of stock. This is a very important, nice question which you have to understand. First, what we will do, trading account of last year. We need gross profit rate, no? Trading account of 2022. Correct? Yes. Opening stock 1,47,000. To opening stock 1,47,000. By the way, this kind of question is there directly in the study material itself. Closing stock 159,200. So you will write by closing stock 159,200 plus, remember the stock which is written off 4,600 written off plus 4,600. 159,200 plus 4,600, 163,800. 163,800. Next, you have purchases 7,96,000. 7,96,000 purchases. Then you have sales 9,74,000. 9,74,000 is your sales. 974,000 plus 163,800 minus 147,000 minus 796. Are you getting a 194,800 is your gross profit. So 194,800 divided by 9,74,000 into 100. 20%. Are you getting 20% as the gross profit rate? Yes, 20% is your gross profit rate. Now you have to prepare what? Memorandum trading account. Memo trading. Yes, opening stock is 1,63,800. Now directly, purchases during the affected period 3,24,000. Sales during the affected period 4,62,000. 4,62,400. Sales during the affected period. Now you have to be a little careful. Okay, you need one thing, that is gross profit. If you get gross profit, you will get the closing stock. Closing stock is obviously the balancing figure. Now sales is how much? 4,62,400. Whenever you have this kind of situation, you will divide the sale into abnormal sales and normal sale. You can't directly apply the percentage 20% because some abnormal sale is there. So what did they tell that a portion of these goods were sold in March at a loss of 500 on original cost of 6,900. Original cost of 6,900. They sold it at a loss of 500. So now what will you do? Abnormal sale is 6,900 minus 500 is the loss. That means abnormal sale is 6,400. If abnormal sale is 6,400, 4,62,400, remove the abnormal sale in that 6,400. How much are you getting? 4,56,000 is normal sale. On normal sale, we made normal profit of 20%. So 4,56,000 in 20%, 91,200 is your profit. But here, how much we made? We had a loss of 500. So this loss and this profit, 90,700 is your profit. So this 90,700 you'll put over here 90,700, 163,800 plus 324 plus 9,700 minus 4,62,400. Are you getting 1,16,100? 163,800 plus 324 plus 9,700. 1,16,100. That is the closing stock on the date of fire. Now go and check what is the policy amount. What is the policy amount? Policy was 1 lakh. That means obviously underinsured. Okay, policy is 1 lakh. So underinsured. So stock salvaged is 11,600. So what will you do now? Closing stock on date of fire.
If it is less than the closing stock, it is underinsured.
Yeah, it is underinsured. 1,16,100 minus stock salvaged. Minus stock salvage 11,600. 1,04,500 is your actual loss of stock by fire. So 1,04,500 into policy amount is 1 lakh divided by closing stock on the date of fire is 116,100. So 1 lakh divided by 116,100. What? 90,009, huh?
8.6.
Yeah, 90,009. I think that only was the answer, no? I said 90,009. Clear? With that, we are done with your exam questions. Now we go into your model test papers. Is there an insurance claim question in this one? Yes. Due to flood, business of Mr. Singh was dislocated from 1st April 2002 to 31st of August 2021. 5 months. From the following details suggest the amount of claim to be lodged for loss of profit policy. Loss of profit policy they have a 6B. Okay. They've solved it luckily. Now, policy amount is there 125. Turnover from 1/4/2000 to 31st. This is the turnover during the affected period. Actual turnover. This is standing charges they have given. Turnover during 1/4/2000 to last year sales. Last year sales is this one. Gross profit ratio 10% on sales. They have given the gross profit ratio directly. Standing charges for 2021 84,000. Now turnover for the period 2021-22 was anticipated to be increase of 10%. 10% is nothing but the trend which I keep talking about. 10%. Now standard sales. See this. Standard turnover for 2021 1 lakh. How did we get 1 lakh? Because turnover during what they have not given last year. They have given entire year. Entire year turnover was this one, this much. Now let's see what they have done. Okay, per month they have taken per month. Now what has happened over here is, see, this is the sale, no, last year. 21-22 was anticipated to be increased by 10% over the turnover for the preceding period. This is 21-22 sales. 2021 sales. And here the affected period is 1/4/2021. Next day onwards. So what they have done is, they have divided by 12 months. Now they got 1 lakh sale per month. Per month sale is 1 lakh. Now can you see, divided 1 lakh. Yeah. So they have done what? Plus 10% trend. So 1,10,000 is your expected turnover per month. Standard turnover for the period of dislocation will be 5,50,000. How 5,50,000? Because see, April, May, June, July, August, 5 months. Okay, they could also have done like this. 12 lakhs. Last year sales. 12 lakhs into 5 divided by 12 plus 10% if you had 5,50,000. Instead of doing month by month, they could also do like this. See, they did month by month. No, they could have done 12 lakh was the total sales. We want for 5 months, 5 divided by 12. You will get 5 lakhs. Correct? Plus, no, not into, plus 10%, you will directly get 5,50,000. Clear? Actual turnover during the period of dislocation. That is given actual turnover, 2,40,000
Yes.
this year. When standard sales minus actual sales will give you short sales. On short sales, percentage of gross profit is directly given into 10%, you get 31,000. Plus increased cost of working capital. Increased cost of working capital they have given a. Okay. Now see, standard charges for the period of dislocation is 7,000 into 5, 35,000. How did we get the 7,000 again? See over here. Standing charges for last year 84,000. 84,000 divided by 12 months. That means per month the standing charges is 7,000. Okay. So what they have done, 7,000 into 5, 35,000 is the additional charges that we have to incur. Now actual standing charges is 60,000. Increase in cost working capital during the period of dislocation to 25,000. Clear? 60,000 we have incurred. 35,000 was the normal. This year extra additional expense how much? 25,000. Additional expense directly they have to give. In other questions they should give additional expense directly. Now here they have not given additional expenses directly. Now what do you have to do? 60,000 minus 35,000 is equal to 25,000. How did we get 60? Here only they have told. What is actual expenses incurred? 60,000. Last year what did they incur full year? 84,000. 84,000 they incurred in full year. That means for 5 months how much is it? 5 divided by 12. 84,000 into 5 divided by 12. 35,000. That means last year full year 35,000. This year just for these 5 months 60,000. Additional expenses 25,000. Okay. Add these two. You'll get 56,000. That's it, done. You don't have to do that 3 steps for additional expense because we don't have that much information. Okay. So that's it. This is your claim to be lodged. This is your model test paper. Now next. Yes. Next question. On 20th July, the godown and business premises of merchant were affected by fire. From the following record salvage, the following information is made available. Stock of goods on 1st April. Whenever they tell stock of goods, that means they're asking for calculation of closing stock on the date of fire and loss of stock policy it is. So 6B. You can see, can you see trading account is prepared first? Because anywhere in the question they have not given you the gross profit percentage. So stock of goods on 1st April, 1 lakh. So you will take that 1 lakh and put it into last year's trading account, 1 lakh. Then after that, next, stock of goods at 10% lower than cost on 31st March 2023. We have done it already 10% lower. That means 1,08,000 is 90. How much is 100? Is it coming to 120? Yes, 120. So closing stock is 1,20,000. Next, purchase of goods last year 4,20,000. So directly we will write 4,20,000. Then after that, sales for the same period 6 lakhs. So directly we will write 6 lakhs. Done. After that, purchase less returns. This is this time period. Okay, so we can ignore that. We don't need it. That is for the affected period. So now if you see, everything is there. Okay, closing stock we have. So basically 6 lakhs plus 1,20,000 plus 1 minus 1 lakh minus 420. 2 lakh is your gross profit. 2 lakh divided by 6 lakhs, that means basically 33.33% you are getting. 33.33% or 1 by 3 on sales. Okay. Now, next we have to prepare memorandum trading account. Memorandum trading account, let's see what they have given information. Purchase less return, sales less return, but they said sales up to 20th July included 40,000 for which goods have not been dispatched. If goods are not dispatched, no problem. Actually, it is not sale. But for us, goods are not dispatched means goods are still here. We want to know, so we'll take full 3,10,000 as sale. Can you see over here? Oh, they have removed that. Huh? Okay, my bad. See, now what they have done is goods are not dispatched, but it's sitting in sales. Yes, that's correct. What the material they have done is correct. 3,10,000, its goods are not dispatched. That means it is sitting in sales. If I remove from sales this 40,000, okay, that time this 40,000 will go and sit in what? Closing stock. We want it to be in closing stock now because goods are not dispatched. Normally, if bill is done overdone, it's considered as sale. Yeah, even if we didn't make the delivery, it is considered as sale. But here what has happened? Goods are not dispatched, so it will be sitting here itself. So this will go 40,000 to closing stock. So now 3 lakh 10 minus 40, you will take 270 as the sale. 270 as a sale. And whatever you got closing stock here, that will be the opening stock for the next period. Next, after that, purchases up to 20th July did not include 20,000 for which purchase invoice had not been received from supplier, though the goods are received. Goods are received. Okay, goods are received. It did not include 20,000. Because we didn't get the bill, we didn't record it. So we have to add 20,000 to that, and the purchases will show 1,60,000. 1,60,000. Clear? Now, we already know the gross profit percentage, 33.33%. That time you get 90,000 as a gross profit. So this should be your balancing figure. Closing stock on the date of fire is 1 lakh. No, closing stock on the date of fire is 1 lakh.
But the 40,000 is made.
It's what? That automatically, this is balancing figure, right?
Yes, sir, but what about the 40,000 now?
It is there in this 1 lakh. If I take it as 3 lakh 10, tell me what will be the closing stock. Actual sale was 3 lakh 10, no? Without reducing that, if I take 3 lakh 10, what will be my closing stock?
The GP will be changed to 1,03,330.
GP will be changed. Closing stock will be lower.
Because closing stock is 73,330.
Yes. Can you see? 73,333. That means that stock is missing, that 40,000. Now that 40,000 is at sales. When it comes to closing stock, it will come at cost. That's why you're finding that you're not finding 40,000 difference, you're finding 33 something difference. Yes. So 270, this is automatically 1 lakh. Now when you get the closing stock on the date of fire, you are first supposed to go and check what is the policy amount. Policy amount. Okay. Anyway, they have not given the policy amount only. So no problem. Good.
So
No average class. So you got this thing over here. 1,12,000 is the stock salvage. 88,000 is the stock lost by fire. Yeah, I think, wait. What did they ask? Claim for loss of stock. Okay. They didn't give policy amount. So whatever we lost, everything we'll claim. Insurance company is good for us. Yes, that is the 7th one. Now we'll go into the next one. This is December 24, set 2. Let's check. Yes, insurance claim. Every single paper it is there. Fire occurred in the premises of Sri G. Venkatesh on 1/4/2023 and considerable part of the stock was destroyed. Stock salvaged was 28,000. Now we know stock salvage is 28,000. Sri Venkatesh had taken a fire insurance policy for 17,10,000 to cover the loss of stock by fire. That means loss of stock we are talking. Critically assess the situation and advise the management the insurance claim which company should claim from the insurance company for the loss of stock by fire. The following particulars are available. Now anywhere in the question we are not seeing percentage. Let's say Venkatesh had in June 2022 consigned goods worth of 50,000 but unfortunately lost in the accident. Since there was no insurance cover taken, the loss had to be borne by him full. Stocks at the end of each year for until the calendar year 2021 had been valued at cost plus 10%. For 2022, however, there was a change in the valuation of closing stock, which was ascertained by adding 10% to its cost. Some places they have taken cost less 10%, some places they have taken cost plus 10%. Okay, so now here where are we? 1/4/2023. It happened on 1/4/2023. So they are telling till the calendar year 21, they were taking stock at cost less 10%. Then from calendar year 22, they are taking cost plus 10%. Okay. So now, first thing, obviously they didn't give gross profit percentage. So we have to prepare the trading account. Trading account for the previous year, which ended on 31st December 2022. Now we'll go in the order. See over here, purchases during 2022, 9,38,000. So you can see 9,38,000 over here. Next, after that, what? Sales, 11,60,000. Wait, 1 second. Sales, 11,60,000. We'll go in the order of the question only. Purchases, this we don't require. This is for the affected period. Memorandum, we'll go to memorandum. This also will go to memorandum. Stock on 1/1/2022, that is the opening stock. This was less 10%. So this is 90. How much is 100?
120.
No. It's 160.
That is 160.
See, 1,44,000. Okay, into 100 divided by 90.
That is actually for the 10% less.
Yeah, it is taken at 10% less. Now we are bringing it to cost. This year end stock, no, they have taken it 10% more. We have to bring it to cost. Okay, see, so it becomes 1,60,000. Can you see 1,60,000 here? Yes. After that, stock, see this 242, no, they have taken it as 10% more. So this is 110. How much is 100? 242 divided by 110, 220. So closing stock you will find at 220. Can you see closing stock here 220? Now after that, what have they given? Wages during the period 2022, 1 lakh. Take and put directly the wages over here, 1 lakh. Now, okay, this abnormal loss. During 2022, they had lost some goods worth rupees 50,000. Unfortunately, we didn't get 1 rupee also from insurance company. For abnormal loss, we already know the entry. Abnormal loss account debited to trading account. So you should find that 50,000 over here. Now automatically you will get the gross profit balancing figure 2,32,000. Yes, so 2,32,000 divided by the sales when you do, you will get 20%. 20%. Now after that, straight away you go. This is your purchases. This is your sales. Memorandum trading account. 182, 2,40,000. I think they made a typo error there. It's not 24 lakhs, it's 2,40,000. Because in the solution they took 2,40,000. Okay, 2,40,000. Okay, is a sale. Now 2,40,000 is a sale. Now understand this. Closing stock what we got over here, no? 220. That only will be the opening stock here, 220. Wages also they have given. What is the wages? 1,80,000. Actually 10 extra again. 18,000. See the solution that they have solved. 18,000. Okay, so now on this directly you will take 20%. 48,000 will be a profit. This is your closing stock on the date of fire. First line of the question, they said that there was some stock that is salvaged. Minus 28,000, you will get 2 lakh as your amount of policy. 2 lakh is your policy amount. Now 2 lakh into, see, 228. But if you see the policy amount, no, policy amount is 17 lakh something they said, which is again wrong. It is not 17 lakh 10,000, it is 1 lakh 71,000. They have added 1 zero everywhere, no. 1,71,000. So can you see policy amount is less than this? So there is under insurance. So loss is how much? 2 lakhs. 2 lakhs into 1,71,000 divided by 2,28,000. 1,50,000. Clear? Done. Next. This is again December 2024, set 1. Do they have insurance claim? Yes. This is the question which we solved now, starting. You requested for this question. Same question is there here. Just check once, 10th question. Value is also same. I remember because it was 28,000, nil 24,000.
2023 was 528. 528.
Yes. Only years they have changed, I think. Oh, year also is same. This is same as we solved today itself. Same as question number 10, right? Illustration 10, no? Sure, no? Starting of insurance claim, we solved it. Okay, same question. Done. Copy paste, nicely copy paste they've done. Oh, we'll see June. Yes, there is an insurance claim question. Small question they have asked. Fire occurred on 15th September 2024 in the premises of Sane and Company. From the following figures, evaluate the amount of claim to be lodged for by the insurance company for loss of stock. Now, during the current year, the purchase has risen by 10% above last year's level. Selling prices have gone up by 5%. Salvage value of stock they have given. Now, can you see first you have to prepare trading account of last year because we don't know the gross profit percentage. Now, stock on 1/1/2023. 1/1/23 is last year's opening stock. So directly go and write 40,000. Then stock on 1/1/2024. That means last year's closing stock 60,000. Clear? Then purchases in 2023. This is last year's purchases 80,000. Last year's purchases 80,000. Then sales in 23. We'll check only the last year's information. 1,20,000. Now what you get is 60,000. Gross profit percentage is 60 by 120. That means 50% gross profit percentage. Now closing stock, what you saw over here last year, 1,60,000 closing stock, that should be the opening stock in your memorandum trading account. Can you see memorandum trading account 60,000 here? Now purchases, 1,76,000 current year. Now, so they said during the current year, cost of purchase has risen by 10% above last year's level. It has gone up by 10% above last year's level. So they have done two columns here. Current year, last year. If sale was, now it is 176. If it was last year, how much it would be? 160. It would be why they are doing that is because if the cost changes, gross profit percentage won't be same. We took gross profit percentage, no, over 50%. That was based on last year's figures. This year, if we take the same numbers, same percentage, it won't match because this year purchase value has gone up, cost has gone up. That's why we have to change the gross profit percent. That's why they have done two columns. Last year, current year, last year, current year. So can you see? We'll do like normally, like what we do. So this is 160. How we got 160? 176 is 110. How much is 100? So last year it would have been only 160. Sales price also have gone up by 5%. See the sales. Current year it's 210. If it was last year, it would have been only 2 lakhs. 105. How much is 100? It would have been 2 lakhs. Clear? Now closing stock, we have to find. Now gross profit, what we'll do? 2,10,000. Sorry, current year. Now, 1 second. Yeah. First we'll do this one.
Same 50.4.
50,000. Wait, 1 second. 1 lakh. When you do that 1 lakh, you will get the closing stock 120. So 10% more will be there in your stock. 10% more in your stock. So this becomes 132. So gross profit is 1,06,000. That is how they did. Okay. Close. But by the way, for us, what we have to worry is amount of stock is 132. Now, without doing last year's column, you will not get current year column because this purchase all that we need. But last year's closing stock, if I get 10%, if I add only, I'll get this year's closing stock. Clear? What the stock would have been this year, I'll get to know only when I know what the stock would have been last year. So 132 is the stock, and they said the salvage value is 4,000. So 132 minus 4,000, 128 is the actual value of stock lost. That's it. They have not given again, I think, policy amount, right? No policy amount. That's why we have direct answer over here, 1,28,000. Clear? Let's go into the next one, 2025. 6A, 6B. Insurance claim again. Was destroyed by fire on 1/4/2023. The records of the company revealed the following particulars. 5,000 was written off, whose cost was 48,000. Part of the stock was sold in 2024 at a loss of 400 at 2,400. Stock salvaged is 5,000. The go down and the cost was fully insured. Evaluate the claim to be made. Now, again, they have not given us the percentages. So, stock on 1/1/2023, last year's opening stock, 75,000 directly. Then, last year's closing stock, 80,000. But I can't take that 80,000 directly because in valuing closing stock of 2023, 5,000 was written off, whose cost was 4,800. Unnecessary circus they have done. In valuing closing stock of 2023, 5,000 was written off, whose cost was 4,800. Part of the stock was sold. Okay, now what they have done is, yeah, 5,000 was written off, whose cost was 4,800. That means 200 extra written off. That 200 they have added over here. Okay, they have taken lengthy route, which was not required. Now purchase they have reduced from here itself. Now wait 1 second. Why all that circus? Guys, don't solve like that. Solve it like this only. What we usually do. See, opening stock 75,000. Okay, closing stock 80,000. Don't do all that circus. 5,000 was written off from closing stock, right? So closing stock is how much? 80,000. So closing stock, just like we did in the previous question, 80,000. Add the 5,000. This becomes 85,000. Finished. Okay, then purchase is 310. Sale is 4 lakhs. So put the purchase 310 and put the sale as 4 lakh. You'll automatically get GP of 1 lakh. 1 divided by 4, 25% will be your gross profit percentage. Now your opening stock here will not be 80,000. You'll get the same numbers. Wait, don't worry. You'll put 85,000. 85,000. Now purchases during the affected period 75,000. Sales during the affected period 1 lakh. Okay, 1 lakh. Take 1 lakh only. Okay, take 1 lakh only. I'm taking 1 lakh because we can solve it in our normal methodology. 1 lakh. Okay, sales is 1 lakh. Now after that, what we have? Now we have to calculate. Remember, we did normal sales, abnormal sales. See, alternative approach they have given. Don't worry, we'll do in our method only. We'll get the answer. What is a sale? 1 lakh. 1 lakh. From that, abnormal sale is 2,000. That means normal sale is 98,000. How do we know it is 2,000? Because they said that part of the stock was sold in 2024 at a loss of 400 on 2,400. That means 2,000. 2,000 on 98,000, 25%. 98,000 into 25%, you'll get 24,500. Correct? 24,500 minus loss of 400, 24,100. Don't take this as 24,500, take it as 24,100. Now calculate and see. 85,000 plus 75,000 plus 2,400 minus 1 lakh. 84,100. 1 second. It's 8,400 only. So closing stock will be 8,400. Here they've unnecessarily done normal and abnormal. So it should be 8,400 only. You'll get 8,400. See 8,400. Add the value of stock on the date of fire is 8,400. Stock salvage 5,000. 7,900 is your answer. Unnecessarily alternative solution and all they have given. Not required. Done. Clear? Now we'll go into our current situation. Yes, 6B. December 2025, set 2. December 2025, set 2, 6B. There is an insurance claim question. Let's try to solve that. Okay. X Limited has taken out a policy for 1,60,000 covering its stock. Covering its stock means they are asking for loss of stock policy only. Fire occurred on 31st of March. The following particulars are given. Now, gross profit ratio is 50% on cost. You are required to examine loss of stock, amount of claim to be made against the insurance company, assuming the policy was subject to average loss. Stock salvage amounted to 41,360. Luckily, we don't have to prepare last year's trading account because they have already given you. Now, what is the situation here? Stock on 1/4/2023. They have given no loss.
That is a memorandum, sir. Because it is occurred on 31st March 2024. So last year means it is.
Yeah. This is stock of last year. We don't need. Okay. Purchase to the date of fire. We'll check once. We'll solve this. Memorandum trading, I think we can do directly. Organization of data is little wrong. Memorandum trading account. Oh, okay. Fire occurred on 31st March 2024. But opening stock on 1/4/2023.
That is the 1 year.
Full 1 year. So 60,000. If you take that as 60,000 opening stock. 2 opening stock 60,000. 2 purchases this year. What is the purchases this year? 2,60,000. Clear? Then sales till the date of fire. Full year. Because usually what used to happen, the fire would occur somewhere middle of the year. No, this has happened at the end of the year. 1,80,000. So by sales 1,80,000. Then carriage inwards to carriage 1,800. Sorry, 1,600. Now commission on purchase to be paid 2%. So what you do? Purchase only you add 2,60,000 plus 2%. Make this purchase itself 2,65,200. 2,60,000 plus 2%. If you add 2,65,200 directly. Then gross profit ratio is given. So now what you will do? To gross profit. Now be careful. Gross profit ratio 50% on cost. So 1,80,000 into 50 divided by 150. 50% on cost. So 60,000 will be your gross profit. 60,000 plus 1,600. 60,000 plus 1,600. What is that? 2,06,800 is your closing stock. Immediately when you get closing stock on the date of fire, you have to check your policy amount. What is your policy amount? 1,60,000. So 100% there is a under insurance. So now closing stock on date of fire is 2,06,800 minus stock salvaged. Stock salvaged. How much is the stock salvaged? 41,360. 41,360. 165. 440 is your loss of stock. Now 165 440 into policy amount was what? 1,60,000 policy amount. 1,60,000 divided by 206,800.
1,28,000.
Round figure. Huh?
Yes, sir.
Crazy. 1,28,000 done. Easy question, 7 marks. One more model test paper we have for insurance claim. We have to finish that, and with that we'll be done with insurance claim. Yes, insurance claim 6B again. A fire occurred in the premises of merchant on 15 June and considerable part of stock was destroyed. Value of stock saved was 9,000. Books disclosed that on 1st April stock valued at 73,500. Okay. 6B again. Set 1, huh?
Yes, sir.
So 2 opening stock. Directly they have given the stock was 73,500. Okay. Then purchases to the date of fire amounted to 2,09,980. So 2,09,980. Yeah, memo trading. Sales 3,13,000. 3,13,000 sales. On investigation, it was found that during the past 5 years, average gross profit was 36%. Align a statement showing the amount the merchant should claim from the insurance company in respect of stock destroyed by fire. Oh. On this, calculate 36%. 3,13,000 into 36%. 1,12,680 plus 73,500 plus 209,980 minus 3,13,000. 83,160. Closing stock on date of fire. Directly we got. Now what about stock salvaged? Did they give you stock salvaged was 9,000.
74,160.
So loss of stock will be 83,160 minus 9,000. That will be 74,160. Done. Finished. No policy amount. If policy amount comes only, average clause will be applicable. Done. With that, we are done with insurance claim. Next chapter that we have to go into is, I think we'll go into branch. We'll do hire purchase later. Okay. It's not that consistently asked. Next, we'll go into branch. Okay. Let's go into the next topic, that is branch accounts. Now, when we are talking about branch accounts, you can have two types of branches. One is inland branch, another one is foreign branch. Now, inland branch, we have two types again, dependent branch and independent branch. In dependent branch, okay, two things can happen. Goods can be sent at cost, goods can be sent at invoice price. Independent branch, there are no complications. Foreign branch is actually based on AS11. Okay, so these two things. Goods can be sent at cost and goods can be sent at invoice price. Now, all this, when it is dependent branch means what? They are completely dependent on us. Whatever we tell them, that is what they are doing. They are not doing anything extra. Okay, it is prepared by head office. Books are prepared by head office. We have three methods: debtors method, stock and debtors method, trading and P&L method. Why do we have these methods? Ultimate reason is what? To find the profit of the branch. The reason we have these methods is to find the profit of the branch. Now, when we have debtors method, now understand this. In this method, now just think that Branch is our debtor. Okay, in the books of head office, you will record only transactions between head office and branch. If you have a debtor, if you have sold goods to him and he has paid money, then you'll record things, right? Imagine you have transaction with somebody else or debtor has transaction with somebody else. Will you record the transaction with the debtor in the debtor's books? No. So therefore, tip is record only transactions between head office and branch. Now, first step. See, debtors method is actually the shorter one. Stock and debtors method is the detailed version. Now, in debtors method, first step, goods sent by head office to branch. We have done consignment, so it will be very similar to consignment. Goods sent by head office to branch account debited to goods sent to branch. When it is consignment account, it's consignment account debited to goods sent on consignment. So branch account debited to goods sent to branch. Now goods returned, obviously that entry will be reversed. So goods sent to branch account debited to branch account. Okay, next, this we are discussing when it is sent at cost. When it is at invoice price, we'll discuss that again. Goods sent to branch by head office. If it is at invoice price, branch account debited to goods sent to branch, you will record at what price? Invoice price. But invoice price means what? Cost plus profit. So this profit we will have to reverse. Immediately you will pass the entry. Goods sent to branch account debited to branch account. This is like removal of loading effect which you used to do in consignment. So goods sent to branch account debited to branch account. Reversal of profit. Goods returned by branch, you will pass the same entry. Goods sent to branch account debited to branch account. Okay, at invoice price, immediately the reversal of profit you will do. Branch account debited to goods sent to branch. So whenever goods are sent at invoice price, you record at invoice price, immediately pass the reversal effect. Whenever goods are returned at invoice price, you do the reversal effect. You pass the entry for return of goods and immediately pass the reversal effect. Clear? Now, cash sales at branch, no entry. Why no entry? Cash sale at branch is a transaction between branch and the customer. It's not a transaction between branch and head office. So no entry. Credit sale at branch, again no entry. Why no entry for credit sale at branch? Because it's a transaction between branch and its customer. It's not a transaction between branch and head office. Next, amount received from debtors. Again, it's a transaction between branch and its debtors. Debtor made payment to branch, nothing to do with head office, no entry. Bad debts or discount allowed, again no entry because bad debts or discount allowed is a transaction between branch and its customer. So we have nothing to do with that, again no entry. Sales return no entry because goods are returned by the customer. Goods are returned by the customer to the branch. Who are we? Head office. We are only going to record the transaction between head office and branch in debtors method. Now, amount sent by branch to head office. Amount sent by branch to head office. Now, this is the transaction. Branch sent money to us. So, we got money. Bank account debited to branch account. Bank account debited because we got money. Branch is a debtor. Debtor reduces. Expenses of branch paid by branch. Their expense, they paid, no entry. Not a transaction between head office and branch. Expenses of branch paid by head office. Now we paid their expense, so they have to give us money. Branch account debited. Our money went to bank account. Clear? Next, close GSTB. Goods sent to branch account has to be closed. It will be transferred to trading account. Can you see? GSTB account debited to trading account. We sent goods to branch. For us, it is like a sale. It is like a sale. That is why can you see trading account is credited? Yes. Closing stock. If it is at cost, no problem. But if it is at invoice price, what we have to do? We have to prepare stock reserve. What we did in departmental accounts, that we are doing here also. Stock reserve. So branch account debited to stock reserve account. This is at the profit portion. Okay. If opening stock is at cost, no problem. But if it is at invoice price, again, what we have to do? Last year's stock reserve we have to reverse. Last year's stock reserve is last year's unrealized profit. That is why we have kept it aside. This year it will be realized profit. So stock reserve account debited to branch account. We are going to reverse it. Whatever you created over here, this is getting reversed. Clear? Now stock and debtors method. See, debtors method, what we did? We recorded only transaction between head office and branch. And our goal is to find profit only. Now stock and debtors method, we are going to record all the transactions. Every single transaction between branch and customer, branch and debtor, branch and head office, everything will be recorded. Whatever is happening in branch, it will be recorded, but it is prepared by whom? Head office. Branch is not going to do anything because it is a dependent branch situation. Now, stock and debtors method record all transactions. First, ledgers to be maintained. See what and all ledger has to be maintained. Branch stock account, branch debtors account, branch cash account, branch expenses account, branch asset account, branch P&L account, and branch adjustment account. Branch adjustment account will be there only when goods are sent at invoice price. Otherwise, only the first 6 will be there. Next, totally we have to remember 7 ledgers. Tala for a reason. Clear? Yes. First one, goods sent by head office to branch at cost. Goods sent by head office to branch at cost. Understand each of this journal entry, why it is there. That time we don't have to buy out it. Goods sent by head office to branch at cost. Now branch, what happened? They got stock. Their stock increases. Stock is an asset. Branch stock debited. Branch stock debited. For us, we send the goods. For us, it is like a sale. Goods sent to branch account. Credited. Clear? Goods returned. Goods returned. That means for them, stock reduces. Stock reduces. Stock reduces means asset reduces. Credited. Sales return, what we do? Sales return is always debited. Can you see goods sent to branch debited? Clear? Next, goods sent to branch by head office at invoice price. Now, if it's at invoice price, branch stock account debited at invoice price. Why? What did they receive? They received the goods at invoice price only. So, branch stock account increased by invoice price. Goods sent to branch at cost. Because till now we didn't get the profit. We just gave them the goods. Goods sent to branch at cost. The profit portion which is there, it will go to branch adjustment account. The profit portion will go to branch adjustment account. Clear? Now, branch stock will always be at invoice price. Goods sent to branch will be at cost, and branch adjustment account will be recorded for the profit portion. If goods are returned, branch adjustment debited, profit reduces. Goods sent to branch debited, sales reduces. Branch stock account credited, asset reduces credit. Clear? Next, cash sales at branch. They made sales. So branch cash account debited to branch stock account. Branch cash account debited because cash increases. Branch stock account credited because stock reduces. Credit sales at branch. Branch debtors account debited to branch stock account. Branch debtors debited because branch debtors asset increases. Stock decreases, asset decreases, so credit. Amount received from debtors. They got money. Branch cash account debited to branch debtors. Branch cash increases, money comes in. Debtor decreases, debtor is an asset, asset decreases, credit. Bad debts or discount allowed. Bad debts, discount allowed, all are expenses. So branch expenses account debited to branch debtors. Branch expense increases, branch debtor decreases. Sales return. Sales return means they returned the goods. That means goods are with us now. Branch stock account debited because stock increases. Debtor decreases. So branch debtors account credited. Clear? Amount sent by branch to head office. They are sending us money. So we received money. We means to head office. Everything is recorded in the books of head office. Bank account debited. 2. Our money increased. Their money decreased. So bank account debited. Branch cash credited. Expenses of branch paid by branch. Branch expenses paid by branch itself. Branch expenses account debited to branch cash account because they paid the money, so their cash reduces. Expenses of branch paid by head office. Branch expenses account debited to bank account because we paid the money. Close the GSTB. GSTB will always go to what? Trading account. So GSTB account debited to trading. All sales are shown on the credit side of the trading. So there is trading account credited here. Closing stock. If it is at cost, no problem. If it is at invoice price, then closing balance of branch adjustment account also will be there for the profit portion. Now imagine this is your branch stock account. You have buy balance carried down. And if this is at invoice price, that means profit has to be eliminated. Then you will have branch adjustment account to balance carried down. Opposite impact. Opposite impact will be there in the branch adjustment account. Okay. Now opening stock, same thing. Now if you have branch stock account, You will have to balance brought down. This is opening balance of stock. This is at invoice price. If this is at invoice price, then branch adjustment account will have by balance brought down. This is the profit portion. This is the profit portion. If it was debtors method, inside one ledger it would have been done. If it is stock and debtors method, it is done in two ledgers. So see, cost, no problem. If it is at invoice price, opening balance of branch adjustment account will be the profit portion. Now closing. Every ledger has to be closed. Branch stock is just a stock account, balance carried down. Profit, if it is there, that will be the balance. If there is any profit, okay, you will transfer it to branch P&L. Now prepare branch stock account, balance carried down you will put. After that also, if it's not matching, if there is a difference, it can be profit also, it can be loss also, transfer directly to branch P&L. Branch debtors, balance carried down. Branch cash, transfer the amount to head office. Why transfer the amount to head office? Because these are dependent branches. So they cannot keep any money, they have to give it to us. If they are giving us money, bank account debited because our money increased, to branch cash, their money decreased. Branch assets will be balance carried down. Branch expenses. Expenses are always transferred to P&L. So transfer the branch expense to branch P&L. Not P&L, branch P&L. And from branch P&L, transfer the profit or loss to P&L account. That is our head office P&L. Clear? Branch adjustment account will have a balance carried on. Goods sent to branch will be transferred to trading account. This is our method number 2. That is called as stock and debtors method. Next we go into trading and P&L method. Trading and P&L method is simple. Head office will prepare trading and P&L account for branch. That's all. If branch would prepare trading and P&L account, how they would prepare? Like that only you will prepare trading and P&L account, but it is done by whom? It's done by head office. Is this clear? Yes, in final accounts when you used to do trading and P&L, same methodology we will use and we'll prepare trading and P&L. Next we go into independent branch. Now independent branch, head office will record their transactions in their books. Branch will record their transactions in their books. That means it's independent. They are going to record all the transactions. Head office and branch will record all the transactions. Now, branch account. Head office will have one branch account to tell what are the transactions with the branch, and branch will have one head office account to tell what are the transactions with the head office. Now, usually branch account is a debtor for us. That means for in branch books, head office will be a creditor. Clear? It should be showing the same amount. This cannot be a mismatch. If I am telling that I have to pay you 100 rupees, then you have to tell that you have to receive 100 rupees. There cannot be a mismatch over here. If there is difference, rectify it. If there is a difference, rectify it. End of the year. What will happen at the end of the year? Head office adds branch records to its books. Branch will not prepare trading P&L balance sheet. No, branch will give their records to us. We will add it to our books. And then we will prepare our financial statement for the entire company, entire business. Branch transfers all records to head office. That means they'll close their books. They will do accounting, then trial balance they'll give to head office and close the books. So branch, what they will do? Branch will get, head office, what they will do? Head office will get everything into their books. So branch trading account debited, branch P&L account debited, branch expenses to branch expenses. Transfer everything to branch, okay? And branch income account debited to branch trading to branch P&L. Branch assets and branch liability will be there in the balance sheet itself. Now understand the process, what is happening over here. Add the branch records to its books. So branch trading you will prepare, branch P&L you will prepare, and all the expenses of branch will be transferred to that. And all the incomes of that will be transferred to branch trading and branch P&L. Finally, profit will get added to the branch assets and liabilities, and then finally everything will be shown in the balance sheet. What branch will do? Branch will remove everything from their books. To remove everything, what they should do? Liability has credit balance, so liability is debited. Income has credit balance, so income is debited. Assets have debit balance, so it is credited to remove. Expense have debit balance, so to remove, what we are doing? Crediting it. Reversing everything and removing from their books, and these people are adding to their books. Clear? Next. Head office, imagine they have branch 1 and branch 2. These are called as inter-branch transactions. Inter-branch transactions will never be done between branch. Branch 1 will transfer the goods to, imagine branch 1 sends goods. In reality, branch 1 is sending goods to branch 2. Reality, truck is going like this only. But in books, how it will be treated is branch 1 give the goods to head office and head office give the goods to branch 2. Now, foreign branch. Branch which is not within the country where the head office is situated. If head office is in India, every other country where the branch is there, that is foreign branch. If head office is in some other country, then the branch which is there in India is also considered as foreign branch. Home currency. Home currency means what? Currency where head office is situated. If head office is in India, home currency is rupee. If head office is in USA, then home currency is dollar. Foreign currency. Any currency other than home currency. If head office is in India, then dollar will be foreign currency. If head office is in USA, then rupee will be foreign currency. Now, spot rate. Spot rate means what? Current rate, today's rate. Closing rate. Closing rate means what? On the balance sheet date, what rate is there? That is closing rate. Opening rate. Opening rate means what? At the starting of the year, what rate was there? That is opening rate. That means last year's closing rate will be this year's opening rate. Average rate is opening rate plus closing rate divided by 2. Now, foreign branch, books are maintained in foreign currency. So, what you will do, that branch will give us the trial balance in branch will give us the trial balance. We have to convert that branch trial balance into home currency, because imagine we are Infosys and our branch is there in USA. They will prepare their books of accounts in dollar. Then they will give that trial balance to us. We will convert that dollar trial balance into rupee and add it to our books. Clear? And trial balance in foreign currency, head office has to convert it into home currency. Now, rules to convert, you see, if you know the actual rate, no, you have to take actual rate only. If you know the actual rate, you are going to take actual rate. You are not going to think anything. If you don't know actual rate, then you come and ask AS11. AS11 will tell you the rules. If you know, when I purchased the goods, the rupee rate was this much, then you take that rate itself. Now, balance sheet items. If it is monetary items means what? Items which can be specified in terms of cash. That means which are fixed and determinable. Fixed items. Debtor, creditor, bills receivable, bills payable, cash, bank. We know exactly this is the amount. Such items will be converted at closing rate. Non-monetary items like fixed assets, it will be converted at actual rate. If actual rate is not there, you take average rate. Stock is there, no. Even though it's a non-monetary item, stock is at the end of the year. So take the closing rate. Incomes and expenses, take actual rate. If actual rate is not there, take average rate. Now, difference which is there in trial balance, you transfer it to P&L. Transfer, debit it or credit it to P&L. This is called as Forex difference. Done. This is the concepts of branch accounts. Now we'll solve every single question and we'll discuss the concept again. Yes, let's go into the questions of branch accounts. We'll see the June 2025 paper. So in your June 2025 paper, yes, there was a branch accounts question which was for 3B. 3B was branch accounts. Let's see how they have solved it, by the way. Yes. Now, let's always go to the end of the question and see if they have told anything. No. Someone invoiced goods to its branch at cost plus 33%. Okay, from the following particulars, prepare branch stock account, branch stock adjustment account, and branch P&L account in the books of head office. That means they are asking stock and debtors method. But in stock and debtors method, they want you to prepare branch stock account, branch adjustment account, and branch P&L account. Now, let's go into the question one by one. Stock at commencement of the branch at invoice price. Okay, that means it's the opening balance. Go to branch stock account, you'll write to balance brought down. If this is at invoice price, then branch adjustment account should have a balance brought down. Now, branch, they said the profit will be 33% on cost. 33% on cost, 33.33% on cost is always 25% on sales. So 3,60,000 into 25%, can you see 360 into 25% is 90,000. So because the opening balance of branch stock account was at invoice price, the opening balance of branch adjustment account will also be there, which is balance, okay, of profit, unrealized profit. Next, stock at close of the branch invoice price 2,88,000. So you can see over here 2,88,000 is the branch balance carried on 2,88,000. Okay. Now let's see the items in transit and all that. Transit items we'll see later. 2,88,000. So now what happens? 2,88,000 into 25%. 72,000 will be there as the opening balance. Can you see to stock reserve? 70 in this 84 it's showing, but first we will take 72,000. After that, one more thing will get added. Later we will add that. Okay, stock reserve, stock reserve. Now, next, goods sent to branch during the year at invoice price, including goods invoiced at 48,000 but not yet received by the branch before the close of the year. 24 lakhs. Goods were sent, but it was not received. Not received means what? It's still in transit. If it's still in transit, it's closing stock. 48,000. Can you see 48,000 is added? And on 48,000, if you take 25%, 12,000, so 72 plus 12. Can you see how it became 84,000 stock reserve? See, goods which have reached there and they have not sold, that is closing stock. Goods which have not reached there only, that cannot be sold anyways, so that is also closing stock. On that also you have to calculate stock reserve. Next, you go into return of goods to, first of all, sent goods 24 lakhs. 24 lakhs we have sent. 24 lakhs. Now, see over here, goods sent to branch 24 lakh. 24 lakh. So now what will happen? By goods sent to branch, you have to reverse the profit portion. 24 lakhs. 24 lakhs, right? One second. Let's see, let's try to figure out what they have done. Okay, actually this should have been 6 lakhs. Opposite effect should have been 6 lakhs. I think there is some abnormal loss or something later. We will see that. So 24 lakh, opposite effect will be 6 lakhs. Next, return of goods to head office 1,20,000. Return of goods. So what is entry? Goods sent to branch account debited to stock account. Can you see 1,20,000 over here? 1,20,000. And on that 1,20,000, 1,20,000 into 25%, there will be profit 30,000, right? 25% should have been the profit. Wait, 1 second. What did they tell? At invoice price only. This should have been 30,000. Let's see. Okay, this should be actually to 30,000 branch stock account. Let's see. I think there is some abnormal loss or something. We'll adjust it later. Credit sales at branch. Credit sales at branch. The entry is what? Branch debtors account debited to branch stock. Can you see by branch debtors here? 1,20,000. Next, we have invoice value of goods pilfered. Invoice value of goods pilfered is basically abnormal loss. Abnormal loss, what will happen? Abnormal loss, the value has to be reduced. So now abnormal loss, they are not even showing it. Okay, it's here, 36,000. So see 24,000. See, invoice value of goods pilfered is 24,000, but they have shown 36,000 here. Yeah, 24,000 plus they have added 1/3. 1/3 also won't make it 36,000. So, see, by branch stock directly 36,000 they have put over here. To branch adjustment, this is actually the profit portion. Now, actually, abnormal loss, if you see, abnormal loss is how much? 24,000. Abnormal loss is invoice value of goods. It should have been 24,000. Okay, I would like to do it on my own. Okay, there is a lot of mismatch there. Follow this solution. Question number June, right? June 2025. 3B. Yes, first ledger that we have to prepare is branch stock account. Then we have to prepare branch adjustment account. I think after that they asked you to prepare branch P&L, right? Branch P&L account. Okay, I'm solving this on my own because I feel there is a lot of mismatch. 33.33% is the on cost, so 25% on sales. Yes. Stock at the commencement 3,60,000. So I'm writing over here in branch stock account. To balance brought down 3,60,000, and on that 90,000. So here it is by balance brought down or by stock reserve 90,000. Next we have stock at the close 2,88,000. So I'm writing over here by balance carried down 2,88,000. But for that I'm adding even that goods which are in transit 48,000 plus 48,000. So that will be my closing stocks. 288 plus 48,000. 3,36,000 into 25%. So here I'm writing 2 stock reserve. 84,000. 25% guys. Next, goods sent to branch 24 lakhs. Goods sent to branch 24 lakhs. So I'm writing branch stock account debited to goods sent to branch account. Okay, here what happens is 24 lakhs. GSTB will be only cost. So 24 lakhs divided by 3. So here it should become 18 lakhs, and to branch adjustment account it should be 6 lakhs. Clear? This total is 24 lakhs. But the entry is what? Branch stock account debited to goods sent to branch adjustment. So here I am writing by branch stock 6 lakhs. Clear? Next, goods return of goods to head office, invoice price 1,20,000. So I'm writing over here by GSTB account and by branch adjustment account. So 1,20,000 divided by 3, that means 40,000 is the cost. Sorry, 1,20,000 is already at invoice price, right? 24 lakhs. One second. Goods are at cost plus 25%. So 224 lakh into 25. That's correct. So here it should be 1,20,000. This is basically 1,20,000 into 25%, not 1 by 3. So this will become 30,000, and goods into branch will be 90,000. So here I am writing to branch stock account 30,000. Okay. Next you have credit sales at branch. For credit sales, what is the entry? Branch debtors account debited to branch stock account. So I'll write over here by branch debtors. How much is that? 1,20,000. Invoice value of goods pilfered. Abnormal loss it is. So here I'm going to write by abnormal loss. Okay, invoice value. It should be 24,000, but here by branch adjustment, the profit portion you remove from branch adjustment, 24,000 into 25%, so 6,000, and abnormal loss will only be 18,000. So here I am writing to branch stock 6,000. Next, normal loss at branch at invoice price. Normal loss, what will you do? Reduce it. So by normal loss 36,000. Next, cash sales at branch 21,60,000. So here I am writing by branch cash 21,60,000. Okay, that should be it. Now you can just check 36,000 to branch adjustment account 36,000, and here by branch adjustment account 36,000. What are you getting? 6,06,000. Huh? See, they also got 36,000, but just that it was not in order. So I've changed it. They also got, but the profit that is there is 5,70,000 because this 36,000 is there. No, it should come here also. Normal loss to normal loss 36,000 because normal loss will not give us profit. So ultimately you will get profit over here. That will go to branch P and L 90 plus 6 lakh plus 36,000 minus 30 minus 6,000 minus 36,000 minus 5 lakh 70,000. That's it. Branch P and L, there are hardly any entries are there.
Loss in both the.
Yes. Okay. Now, if you check, first we are removing from the stock, then we are recording the loss over here. First we are removing from stock and the loss is recorded in the adjustment account. And if you see over here, branch P&L, 570 comes over here. 18,000 branch stock account. This 18,000 is what? That loss, abnormal loss. Abnormal loss, remember I made it 18,000 over here. 18,000. 6,000 is the profit portion, so it's not a loss for me. So 18,000 comes over here, remaining is net profit. Clear? I think there's only one question from branch accounts, right? They don't ask multiple. Yes, that's it with June. Now we'll go into December. December also there is a question 6A. 6A. Show Surat branch account in the books of Noida head office to determine the profit or loss. When they tell branch account, that means only one account they have asked. That means it is debtors method. You can see 6A debtors method they have prepared. Now, let's go ahead. Adiraj Limited Noida started a branch in Surat. So if it's if they tell branch account, no, it is debtors method. If they tell branch accounts, then it is stock and debtors method because we have multiple. Okay. To which goods were sent at 20% above cost. 20% above cost. So 20 by 120 on sales. Branch makes both credit and cash sales. It is policy to meet the branch expenses from branch cash and remit the balance money to head office. So whatever thing money is remaining, that they have to send to head office. Branch does not maintain double entry books of accounts and necessary accounts relating to the branch are maintained by head office. One by one. Cost of goods sent to branch. Cost of goods sent to branch. For this, the entry is branch stock, branch account debited to goods sent to branch. But this is cost. We have to take the invoice price. So you can see over here 50,000 plus 20% branch stock, branch account debited to goods sent to branch. Can you see here 60,000? But because it is recorded at invoice price, immediately we have to pass the opposite effect. So can you see 10,000 on the opposite side? Yes. Now, goods received by branch till 31st March, only 54,000. 60,000 we just now sent, they received how much? Only 54,000. That means 6,000 is in transit and 6,000 has to be added to closing stock. Can you see branch stock? 6,000 is added. Yes. Next, credit sales for the year. Credit sales for the year, what should be the entry? No entry because it's a transaction between branch and its customer. Closing debtors 20,800. They have given the closing balance of debtors. So you will write over here balance carried down. Debtors 20,800. Then bad debts 200. Bad debts again no entry because it's a transaction between branch and the customer. Cash remitted to head office. They sent us money. So what should be the entry? Bank account debited to branch account. Bank account debited to branch account. Can you see this 43,000 over here? Yes. Next, cash in hand at the end of the year. Cash in hand. Balance carried down. Cash will be there 2,000. Next, cash remitted by head office to branch during the year. Cash remitted by head office to branch. So what will be the entry? Branch account debited to bank account. Money goes 3,000 to bank account. Next, closing stock at branch at invoice price 6,000. Closing stock is what? 6,000. Can you see closing stock was 6,000, the one which was in transit? Next, expenses incurred by the branch. Expenses incurred by the branch. Goods in transit is here and closing stock is over here. Both are there. 6. Expenses incurred by the branch, no entry because it is incurred by branch. Now understand this. Goods in transit and closing stock both are at invoice price. So 12,000 is the total stock for me into 20 divided by 120 will be 2,000 basically. Can you see goods in transit 1,000 and stock reserve 1,000. Both the 2,000, both the thousands they have shown. Now whatever profit is there, it will get transferred to the general P&L account. This should be a balancing figure. Done. Easy 7-mark question. Only a trick is this 6,000 goods in transit. See how we got goods in transit. Again, I will explain it to you. They said goods sent 50,000 at cost plus 20% when we add, we will get 60,000. This is our invoice price. This is our invoice price. Now this invoice price, how much goods are received? They said only 54,000. So when you remove 54,000 from that, 6,000 is your goods in transit. 6,000 is basically your goods in transit. Is this clear? Yes. Done with that particular question from December 24. Yes. Let's go into the next one, that is June 24. June 24 also there is a branch accounts question 6A. Okay. Now understand this. The Ranu stores of Jaipur has a retail branch at Kota. The goods are invoiced to the branch at selling price, which is obtained by adding 50% on cost. 50% on cost. That means 50 by 150 on sales, invoice price. All expenses are paid by head office. Particulars are given below. Now let's go to the end of the question. You are required to prepare branch stock account, branch debtors account, goods sent to branch account, branch expenses account, branch adjustment account, branch stock reserve account in the books of head office. Basically everything. Stock and debtors method they asked. Now one by one we will discuss. Balance on 1st April. Stock at invoice price 120. 120. This should be the opening balance of branch stock. Go to branch stock. Can you see 120? 120. But this 120 is inclusive of profit. What is the profit portion? They said 50 by 150 on sales. So now in your branch adjustment account, can you see over here 120 into 50 by 150? Are you getting 40,000? And that 40,000 is there in the stock reserve also, branch stock reserve. Entry is what? Branch stock reserve account debited to branch adjustment account. Okay. Now, next. You have to be a little careful. Debtors, 43,200. This is the opening balance. Go to branch debtors. Branch debtors opening balance 43,200. Clear? Next. Goods sent to branch at invoice price 18 lakhs. Goods sent to branch at invoice price. So entry will be branch stock account debited to goods sent to branch, and on 18 lakhs 50 by 150 6 lakhs
6 lakhs.
should be there in your branch adjustment account. I don't know why they do it like this. Yeah, that's what. See, 18 lakhs, right? Now they have shown like this. Branch adjustment 592. So they are showing net effect. Goods sent to branch 592, net effect and all they are doing. Okay. Directly you can put 6 lakhs, you'll get the answer. Yeah. Directly if you put over here 6 lakhs, 50 by 150, you'll get the answer. It'll be simpler for you to go forward. Yes. Next. We'll see the next one. Goods returned by the branch 24,000. Can you see they have put 24,000 here? So 24,000 divided by 3. 8,000 should be there in branch adjustment. Branch adjustment. I think they are taking net amount, no? 24. I think they are doing that. 18 lakh minus 24,000 divided by 3. Oh yeah, they have taken net effect. Okay, I hope you understood. You know how they got this 5 lakh 92? I would have put 6 lakhs over here and I would put 8,000 on the opposite side because of return. Now they took full net figure here and 592. How net figure? 18 lakhs is the goods transferred minus what was the return? Goods return was 24,000. So 18 lakh minus 24,000 into 50 divided by 150. Can you see they are taking net effect directly? Yes, they are not passing every entry. Net effect 592. Okay, I would have put 6 lakhs here and I would have written 8,000 on the opposite side. Clear? Next, after that, over here, cash sales. What is the entry for cash sales? Branch cash account debited to branch debtors account. Branch cash account. Are they preparing branch cash? No, 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 no. Okay. Sorry, my bad. Branch cash account debited to branch stock account. Can you see here 72,000? Next, credit sales. Branch debtors account debited to branch stock. So you are seeing in both the places 16,32,000. Next, goods returned by debtors. So branch stock account debited to branch debtors account. Branch stock account debited to branch debtors account. Next, cash received from debtors. Cash received from debtors. Branch cash account debited to branch debtors account. Can you see here branch cash 15,60,000. Discount allowed to debtor. Discount allowed to debtor is an expense. Branch expenses account debited. We have branch expenses to branch debtors 12,000. 12,000 over here. Next, bad debts. Again, bad debt is also an expense. Branch expenses account debited to branch debtors 2,400. Branch expenses paid by head office. This everything is paid by head office. 19,200 plus 1,01,000 plus 6,000. 1,26,200 is paid by head office. So branch expenses account debited to bank account. Branch expenses account debited to bank account. Can you see 126,200 in their expenses? Next, balances on 31st March. Stock at invoice price 199,200. This is the closing stock. Go to branch stock. 199,200 is the closing stock. 199,200 into 50. 66,400 should be the adjustment here. Can you see 66,400 here? Branch stock reserve 66,400. And can you see 66,400 here? Yes. So branch adjustment to branch stock reserve to branch adjustment, and this will be the balance brought down and balance carried down of branch stock reserve. I hope you know how it works. Basically, it is like remove the profit, keep it aside. Next year, take the kept aside profit and use that. That unrealized profit. Yes. So that should be the 66,400. After that, what do we have? Debtors 88,800. Go to branch debtors and directly write closing balance 88,800. If you see, automatically the branch debtors will close. There is no missing figure over there. That's it. Now what you will do? Here everything is there. Now if you see, you have one shortage over here. The difference 4,800. Either it will be surplus or it will be deficit. Whatever you have, you transfer it to branch adjustment account. Can you see 4,800 is transferred to branch adjustment account? Now, branch expenses, what they have done, they have transferred branch expense also to branch adjustment. Usually branch expenses gets transferred to branch P&L. No need to transfer to branch adjustment. From here, whatever is there, transfer to branch P&L, expense directly transfer to branch P&L, and they are getting 420,200 as a profit. Okay, goods into branch we already discussed, 24,592. This is going to trading account. Actually, it should not be like this. They should prepare branch P&L. Okay. Now, branch P&L, what will happen? Expenses, what is there? It will come over here, 140,600. Okay. Then, that time, if you remove this 140,600, you will get over here 40,000 plus 592 minus 4,800 minus 66,400. You will get 5,60,800. 5,60,800 should come to branch P&L. And from that you remove 140,600, you will get the profit that time 420,200. It should go to P&L, head office P&L. Now, yeah, this is how it should be done. Because they did not ask branch P&L in the question, they directly put the expense here itself, which is not right actually, but they have done it. In exam, best what you know, even if they don't ask branch P&L, prepare branch P&L so that the profit is calculated here itself. Yes, with that we are done with June.
December 6A.
December also 6A, yes. Now, 6A, December. X Limited as the retail branch at Puri, goods are sold at 60% profit on cost. The wholesale price is cost plus 40%. Goods are invoiced from Delhi to head office at branch at Puri at wholesale price. From the following particulars, ascertain the profit made at head office and branch for the year ended. Now, head office they have given, branch they have given. Sales at head office are made only on wholesale basis, and that at branch only to customer at retail basis. Stock at head office is valued at invoice price. Stock at head office is valued at invoice price. They only asked you to calculate the profit made. Now, they have not given the question, solution for this. They have just given the answer, one word answer. Now, we need to calculate profit. This was December 2023. Now, if I prepare head office, trading and P&L account, and this will be the branch trading and P&L account. Now, we'll do it for head office. Stock is there, opening stock 7 lakhs. To opening stock 7 lakhs. Next, you have purchases 42 lakhs. To purchases 42 lakhs. Then you have goods sent to branch at invoice price. Goods sent to branch. So you will write for head office it is like sale. So by GSTB 15 lakh 12,000. For branch it is like a purchase. So to GSTB 15 lakh 12,000. For 1% it is sale, 1% is purchase. Sales 42 lakh 84,000 by head office. So by sales 42 lakh 84,000. Closing stock 16 lakh 80,000. So by closing stock 16 lakh 80,000. Next, expenses. To expenses, because expense will be in the P&L, not in the trading account, 80,000. Now, here you have to understand, X Limited has a retail branch at Puri. Goods are sold at 60% profit on cost. Wholesale price is cost plus 40%. So if I take cost as 100 plus I'll add one profit of 40, it becomes 140. This is the wholesale price. This is the wholesale price. Okay, then goods are invoiced from Delhi to branch at Puri at wholesale price. We are sending it to the branch at wholesale price. But goods are sold at what? 60% profit on cost. So 60% means the selling price is actually 160. So to this you will add another profit of 20. So branch will make this 20 profit, head office will make this 40 profit. Okay, so selling price will be 160. So now you can see over here, again they have told stock at head office is valued at invoice price. It is at invoice price. So now what will happen? Closing stock and opening stock. Now opening stock, whatever is there, on that there will be stock reserve. So 7 lakh. Now how much is the profit? 40 divided by 140. We are making a profit. So I am writing over here by stock reserve. Seven lakhs into 40 divided by 140. 2 lakhs. And to stock reserve. Which one? Wait. 16 lakh 80,000 into 40 divided by 140. You will get 4 lakh 80,000. This is the stock reserve creation. Now, we have to understand one thing, that is to gross profit. 25 lakh 76,000. So by gross profit 25 lakh 76,000. 22 lakh 16,000. Okay, right now we have this profit, net profit. Will match. Because there will be one more stock reserve that has to be calculated. Now 22 lakh 16,000. This is on our stock, whatever is there we have calculated. Now if you look at the branch, sales is, there is no opening stock, purchase and all that. Sales is 14 lakh 40,000. So if I write over here by sales 14 lakh 40,000, and here stock, this is closing stock 2 lakh 52,000. by closing stock 2,52,000, and they also have their expenses. So two expenses 40,000. 40,000. Two expenses, it is 40,000. Now you have to understand one thing. Opening stock is not given. Okay. 14 lakh 40 plus 2 lakh 52,000 minus 15 lakh 12,000 minus 40,000. 1 lakh 40,000 is the profit. Correct? Can you see branch profit 1 lakh 40,000? So branch made a profit of 1 lakh 40,000. This will go to P&L. 1 lakh 40,000. Whose P&L? Head office P&L. 1 lakh 40,000. But here closing stock is there, no 252. Now see the head office profit. Head office profit, what we calculated was 22 lakh 16,000. But in this, again there is stock reserve minus stock reserve because the branch closing stock is at invoice price. Okay, retail price. So 2,52,000 into, it will be 60. See, 40 plus 20, 60 is the profit involved in this. 60 divided by 160. 94,500. 21 lakh 21,500. 21 lakh 44,000. Wait. I think we only missed something. Wait 1 second. 1 second. Yeah, correct. Not 60 by 160. It should be 40 by 140. Because it is still there at invoice price only. They will sell it at retail price. So 40 by 140, 2,52,000 into 40 divided by 140, you have 72,000 stock reserve.
It is 21 lakh 44,000.
21 lakh 44,000. I think that should be the answer, right? Yes, 21 lakh 44,000. Yes, because goods are sitting at 140 on that 40 rupees profit. It is sitting in head office also at 140. It is sitting in branch also at 140. This is your December 2023 question. I think after this we have only model test papers, right? December 23. Now model test paper, almost every model test paper there is branch accounts. Yes, branch 6A. Yes, let's go into the branch accounts question, guys. Here, 6A, prepare branch account in the books of head office and also debtors account from the following information given below for the year ended 2022. Okay, 6A. See, you can see that they have prepared branch account and they also prepared debtors account. Now, first we'll start with the first thing. Unique Shoe Stores has an old branch at Kanpur. Goods are invoiced at to the branch at 25% profit on cost price. 25% on cost there is goods are invoiced. The branch has been instructed to send all cash daily to the head office. All expenses are paid by head office except petty expenses which are made by branch manager. Okay. So now stock on 1/1/2022 invoice price 15,000. Now can you see the branch here? 15,000 will be there. Okay, but what will happen now if this is at 15,000? 15,000 into 25 divided by 125. Opposite effect 3,000 you have to put reversal of loading effect. Can you see 3,000 here? Yes. Next, after that we go into the next one. Sundry debtors opening balance 9,000. Go and put the opening balance there 9,000. Then you have cash in hand opening balance 400. Go and write 400 opening balance. Then you have branch office furniture 1,200. Put 1,200. Done. Then you have goods supplied by head office for the year. Goods supplied by head office for the year. So branch account debited to goods sent to branch. Branch account debited to goods sent to branch. You are writing 80,000. But what they have done is returns there only they have subtracted 1,000. So it's like net. Instead of putting opposite side, there only they have put. Now 79,000 into 25 divided by 125. 79,000 into 25 divided by 125. You will get 15,000. 800. Can you see 15,800 reversal here? Yes. Next, goods returned by debtors at the end of the year. Goods returned by debtors usually doesn't come into branch account. That's why they asked you to prepare a separate debtors account. 480. You can see in the debtors account 480 sales return. Clear? This is separately done just to find the debtors over here. Next, they have told debtors at the end of the year. Debtors at the end of the year 8220 will be there in your branch account also. Can you see closing balance of debtors 8220? And it will be the closing balance in your debtors account also 8220 because separately you are preparing debtors account as well. Next, after that you have cash sales for the year. Cash sales for the year, what is the entry? Branch cash account debited to sales. So here we are not going to have any impact, but they will send us that money because they told whatever money they get immediately they have to send to head office. So bank account debited to branch account. Can you see 50,000 here? Yes. Next, after that, credit sales for the year. Credit sales for the year, no entry, but in the debtors account there will be entry. Debtor account debited to sales, 30,000. Opening balance also debtors will be there here, 9,000. Then after that, you can see over here, discount allowed for the year. Discount allowed, what is entry? Discount allowed account debited to debtors. Debtor will reduce, it will not impact our branch account, 300. It's a transaction between branch and customer. So expenses for the year paid by head office. So 3,900 paid by head office. So the entry should be branch account debited to bank account 3,900. 3,900. Next, after that you have stock on 31st of December 2000. Petty expenses paid by branch manager during the year. Who paid it? Branch manager only paid the petty expenses. So it doesn't matter to us. 280. We are not going to pass any entry for that. Can you see no entry is passed? Okay. Now after that, stock on 31st of December, 14,000. So what will you do? Closing balance. Can you see? Stock of 14,000 is there. 14,000 stock. And 14,000 into 25 divided by 125. There should be stock reserve on that. 2,800 is the stock reserve. Now, all the things that are given in the question till here are done. Provide depreciation on furniture at 10%. They said. Now see the opening balance over here. Can you see furniture is there 1,200? So this furniture, when it goes to closing balance, it will become 1,200 minus 10%, 1080. This is 1,200 minus 10%. And one more thing is, we had some branch cash in hand 400. Branch had 400 rupees cash. Some expense was paid by them only 280. So 400 minus 280. Now their closing balance is only 120. Okay, 120. Now everything is done. In the debtors account, you have to find how much cash we got from debtors. Can you see opening balance is there, credit sale is there, sales return is there, discount is there, closing balance is there. That time you will get a balancing figure of 30,000. They got 30,000 from their debtors. They told in the starting of the question that not a single rupee they are going to keep with them. So that's why they'll send it to head office, bank account debited to branch account. Can you see that 30,000 came into the branch account? And now your total amount that you received is 80,000. Everything is done. Now you will get the balancing figure. This is your profit that will go to P&L. 10,920. Clear? Yes, this was your model test paper. We'll go to the next model test paper now. Same question. Yeah. That is same. I came to June. Do we have branch in June? They had departmental in June. So I am guessing there is no branch, I guess. No branch. Because they asked, that was one question, one paper no, where we found departmental accounts. Because 6A was departmental accounts, they did not ask any branch question. So that should be it. Yeah, that should be it, yes. Next, we go into December 24, set 2. Yeah, there is branch, right? 3B, yeah. 3B is not higher purchase. Again, here also, wherever you found departmental accounts, right? You won't find branch accounts. See, 6A was departmental accounts again, no branch accounts. I'm just checking at the end if there is any branch accounts. AS only, no. Everything is AS. No, that's it. If you have departmental accounts, there is no branch accounts. So that is also done. 5. This time there is branch accounts. Because in this, there was no departmental accounts. 6A, they have reserved for departmental or branch. Now, SS Textiles have a branch in Auckland, New Zealand. The trial balance of the branch is given. Okay. Now, can you see this is a foreign branch question? It's in foreign currency. Everything is in foreign currency. The branch in the head office books showed a debit balance of 13,20,000 and goods sent to branch a credit balance of 80 lakhs. Office furniture acquired in 2007 when New Zealand dollar was 80 rupees. Exchange rate were New Zealand dollar at the starting of the year 88 and end of the year 92. Average rate is also given. Stock at the branch on 31st December was valued at 9,000. Convert the branch trial balance into rupees. Prepare the branch trading and P&L account and branch account in the head office books. Depreciation is to be written off at the rate of 10%. Now you have to convert. Correct? One by one we have to convert. Now what did I tell you that time? What you know actual, don't convert it. You take the actual amount. If you don't know, go and take the rates which are prescribed by AS11. Now head office account is showing 18,000. But they already told head office value in rupees is 13,20,000. So directly you are going and writing 13,20,000. No rate is taken. Can you see no rate is taken over here? When you know the actual, take the actual. Now, next one is sales, 1,20,000. Sales, what we are going to take? Income and expense, I told you to take average rate of 90. Can you see average rate is used for sales? To convert the sales, they have used average rate. 120 will be converted, becomes whatever, it's just multiplication. See, monetary items, closing rate. Non-monetary items, actual rate. If actual rate is not there, average rate. Closing stock, closing rate. Incomes and expenses, actual rate. Actual rate is not there, average rate. Now, after that, you have goods sent from head office, 90,000. But this one, in rupees only, they have told it is 80 lakhs. So, directly you will go and write 80 lakhs. Clear? Now, after that, there is opening stock. Opening stock is last year's closing stock. So, you will take the opening rate. What is the opening rate? 88. Can you see the opening rate? 88. So, directly you will take 88 for opening stock. Now, office furniture. 20,000. You know the rate. They are told when we purchased the office furniture, that day rate was 80. So you will take directly 80 for office furniture and multiply. It's just multiplication. I'm not doing the calculation there. Cash 100. Cash is a monetary item. For monetary item, you have to take closing rate. Closing rate is 92. Can you see 92 is used for cash? Yes. Next, bank is also a monetary item. For monetary item, you have to use closing rate. 92 is used for bank also. Next. Expenses outstanding. Expenses outstanding is what? Monetary item. Again, you will use monetary item 92 for closing rate. Are you getting this? Yes. Next, after that, you have salary. Salary is an expense. Expense you are going to use average rate. Average rate was 90. Can you see expense 90 was used? Next, after that, taxes, rent. Both are expense. For both, there should be average rate of 90 and 90. Then finally you go to debtor. Debtor is a monetary item, and for monetary item you should use closing rate, which is 92. Debtor also it is used 92. Now when you see, you are getting a difference. Difference is what? Exchange difference. Exchange difference. Now with this, they ask you to prepare branch trading and P&L account. Now see, one by one. If you have to prepare branch trading and P&L account, tell me one thing. Where will this head office account go? It will go to the balance sheet. Can you see have they prepared no, they did not ask you to prepare branch balance sheet. They didn't prepare any trading and P&L they have prepared. See, already opening balance was there, 13,20,000. 13,20,000 is there in head office. Now sales, where will it go? Sales 1,08,000 will go to trading account. Sales done in trading account. Now goods sent from head office. Okay, goods we received from, it's an expense for us, 80 lakhs. Can you see expense here, 80 lakhs? Next, opening stock trading account, you will see opening balance 13,20,000. Next, office furniture will go to balance sheet, but there is depreciation they asked you to take on office furniture, 10%, 1,60,000 office furniture. Okay. Next, cash and bank will go to, it will not go to trading or P&L. You can see directly in balance sheet. Okay, no, balance sheet is not there. No balance sheet, guys. So next, after that, expenses outstanding also balance sheet item. Salary, tax, rent, everything you will find in P&L. Can you see salary, tax, rent, difference in exchange? When we prepared the trial balance, we got 21,000 difference there. That is also there in the P&L. Done. Closing stock, they gave outside the trial balance. Can you see outside trial balance? Closing stock was given. Closing stock was valued at $9,000. You will use the closing rate 92. 9,000 into 92, you should get 8,28,000. Yes, that's your closing stock done. You'll get your gross profit, and finally you'll get your net profit also. Net profit 13,62,000 is your net profit. Branch trading account, opening stock, goods from head office. You are putting into the branch. You are registering it with the branch, and then again sales and stock, everything you are registering. Basically same thing what is there in P&L you transferred over here. This is not even necessary. Directly it's there in branch P&L. Yes, that should be it with the fifth one. Now 4. 6 yes. There is no departmental, so there will be branch. Now, a Delhi head office passes one entry at the end of each month to adjust the position arising from inter-branch transactions during the month. Okay, from the following inter-branch transactions in March, make entries in the books of Delhi head office. Now here, Kolkata branch has made some transfers. See, can you see that they have given us only one entry? They told pass only one entry. Don't pass every single entry for every single transaction. Just pass an entry so that we can understand who has to give and who has to take. Now, one by one, see, Kolkata branch received goods from Patna branch 9,000. So now, see this working note here, inter-branch transaction. Kolkata branch received goods. So they have to pay money 15,000. Kolkata branch received goods. That's why can you see debit over here 15,000. Okay. And you can see and Ahmedabad branch received 6,000. So they have to pay money now. So Ahmedabad branch, you can see 6,000. One second, where is Ahmedabad branch? One second. Kolkata branch received goods from Patna and Ahmedabad branch 6,000. So 15,000. Okay, my bad. Kolkata branch received goods from Patna branch 9,000 and Ahmedabad branch 6,000. Okay guys, yeah. See, actually received goods from Patna 9,000 and Ahmedabad 6,000. So 9 plus 6 for Kolkata, how much is it? 15,000. So 9 plus 6 for Kolkata, they have to pay 15,000. And for Patna, okay, can you see Patna, 9,000 is there as credit and 6,000 is there as credit over here. Goods received, purchase. Goods sold, sale. So for Kolkata, it is like purchase. For Patna and Ahmedabad, it is like sale. For Patna and Ahmedabad, it is like sale. Clear? Sent goods to Ahmedabad branch 15,000. Who sent goods? Kolkata branch sent goods. So for them, it is sale 15,000. And also to Patna 12,000. So 15 plus 12, they sent how much? 27,000. So can you see 27,000 credit to Kolkata? Then who received it? Ahmedabad 15. So can you see Ahmedabad purchased 15 and they sent another 12,000 to Patna. So Patna 12,000 debit. Are you following this calculation? Whoever purchased debit, whoever sold credit. Okay, next you can see over here sent acceptances to Patna branch 6,000 and Ahmedabad branch 9,000. Acceptance means bills payable. So credit, bills payable, credit. And for them it is bills receivable. So 6,000 and 3,000 debit for them. Next, Kanpur branch, apart from 1A above, sent goods to Ahmedabad 9,000. Kanpur sent goods. So for Kanpur 9,000 sales. For Ahmedabad 9,000 purchase. And received bills receivable from Ahmedabad. Received bills receivable. So for us 9,000 debit. For Ahmedabad 9,000 credit. Received cash from Ahmedabad. Received cash. So for us 5,000 debit. Okay, and Ahmedabad gave cash. So 5,000 credit. Clear? When we do all this, we will get a net situation. Okay, that's it. See, total all the debits, total all the credits. Here credit is more, so 21,000 debit. So Kolkata 21,000 debit, credit balance is there 21,000. Here 14,000, 9,000. That means 5,000 debit balance. Okay, 5,000. Here 18,000, 9,000. 9,000 debit balance, 9,000. 27,000, 20,000. 7,000 debit balance, debited. So basically here if you see end situation, if you see Kolkata credit balance is more. That means Kolkata has to get money. Okay, these everybody debit balance is more. That means they have to give money. All these people are going to give money to Kolkata. Clear? This is the question that they have asked in 4. Next, let's go into the next one. 6A, 6A, 6A. Yes. Branch accounts. See what they asked. Prepare branch stock account and branch stock adjustment account. Only 2 things. Branch stock account and branch stock adjustment account. Green Limited with their head office at Kolkata invoiced goods to their Patna branch at 20% less than their list price, which is cost plus 100% with instruction that cash sales are made at invoice price, credit sales at list price. Oh. See, they are sending it at 20% less than list price. Now this is their cost, okay. Imagine cost is 100. Their list price is what, which is 100% cost plus 100%. So add 100%. Now 200 is your list price. 200 is what? Your list price. They are sending it at 20% less than their list price. So invoice price is what? Invoice price will be 200 minus 20%, 160. So from head office to branch, we are giving it at 160 and sales are made at 200. From the cost is 160. So now stock at cost. These are the things that are there. 4,800. Can you see 4,800 here at invoice price? So 4,800 at invoice price into 1,800 should be there in the branch adjustment account. Can you see 1,800 in the branch adjustment account? 60 by 160 because 60 only profit no in the branch. Next, debtors 1/4/2023. We are not preparing branch debtors at all. We don't need to worry about branch debtors. Okay, they are preparing branch debtors just to find out the sales, I think. Okay, because we don't know the sales rate. Otherwise, we will not know the sales. Branch debtors, can you see opening balance here 4,000? Otherwise, they didn't ask us to prepare branch debtors. Next, goods received from head office at invoice price. Goods received from head office at invoice price. Can you see goods sent to branch 52,800? Goods returned. Can you see goods returned 400? So 52,800 minus 400. 52,800 minus 400. 52,400 into 60 divided by 160. Net 19,650 should be there. Some places they are doing net, some places they are doing gross. So see here they did gross, like what we were doing. Can you see this? 19,800 and 150. 19,650. Actually, this is the way to do it. In earlier model test papers we saw, no, they were taking net and calculating. Okay, this is the way to do it. Goods sent, reverse. Goods returned, reverse.
The 5,000 they were doing it in the right side.
They were doing net amount only, they were doing it. Next, after that you have sales. Credit sales will not impact anything. Now you are just going to write credit sales, branch debtors account debited, branch debtors to branch stock. Can you see in branch stock 40,000 here? Yes. Next, cash sales, branch cash account debited to branch stock, 18,400. Done. Cash received from debtors, branch cash to branch debtors, branch cash to branch debtors, 34,254. Next, expenses at branch. Expenses at branch will be just branch expenses account debited to branch cash. It will not impact both of us. Remitted to head office. Remitted to head office is what? Bank account debited to branch cash. We don't have to worry. Debtors closing balance 9746. Debtors closing balance 9746. There is no use of preparing debtors account. I don't know why they prepared. Next, stock closing balance 7040. Can you see 7040 here? So therefore 7040 into 60 divided by 160, 2640 will be the stock reserve. 2640 will be the stock reserve. Clear? Then now when you close your branch stock account, you are getting a difference of 8,000. 8,000 surplus. 8,000 should be transferred to branch adjustment or directly to branch P&L also fine. 8,000 is transferred over here. No, that's it. 8,000. Okay, now, yeah, 8,000, right? They got another 240 difference. Basically, they could have just taken balancing figure as 8,240. This and this both are balancing figure only, no? No need to waste time, guys. Total you take 8,240. 8,240 is your balancing figure difference. Just go and put it over here in branch adjustment account. Branch adjustment account 8,240. Clear? Now, sorry. 8,000. But in this 240 into 60 by 100, why all this circus? Stock surplus. I don't know why all this circus. Okay, now branch adjustment. How we got this 6,000, 8,000 over here? This is the 8,000 that we were talking about, no, that time. Guys, we can do it in a we can avoid all this confusion and directly do 8,240 over here and transfer the difference to branch P&L. Abnormal loss, whatever it is there, it will get calculated over there itself automatically. You don't have to do all this circus. Okay, I hope you are getting it. 8,000, see over here, everything you put, branch adjustment account, you are transferring the balancing figure. See, excess contribution to gross profit itself. All that is not required. Directly you do 8,240, transfer it to branch adjustment account, and from there you transfer it to branch P&L. Clear? Yes. See, unnecessary calculations they have done. 40,000 into 4, 40 divided by 200, all these things. Next. We're done, no? So now we have to solve this, right? Yes. Here, let's see what they have asked. Prepare a branch account in the books of head office from the following particulars for the year end date, assuming head office sold goods at cost price plus 25%. They said prepare branch account. That means they are asking which method? Debtors method. So here we go. December 2025. Question number 6A. Okay, and here we are preparing the branch account under debtors method. Whenever they tell branch account, that means it is always prepared under debtors method. Now, stock at invoice price 12,500. So I'm going to write over here to balance brought down under that stock, and stock is at invoice price 12,500. Immediately I have to write by stock reserve, opposite effect by stock reserve 12,500. They are sending goods at what cost price plus sold goods at cost price plus 25%. They have not written 25% there. So it's going to be 12,500 into 25 divided by 125. 2,500. Then next you have debtors opening balance 5,000. Debtors opening balance 5,000. Petty cash 1,000. Petty cash 1,000. Next, goods sent to branch 40,000. Goods sent to branch. So you're going to write to goods sent to branch account 40,000. But immediately what will you write? By goods sent to branch account 40,000 into 25 divided by 125. 8,000. Clear? Opposite effect. Goods returned to head office. So you will write by goods sent to branch account. How much is that? And here you are going to write 2 goods sent to branch account reversal 5,000 into 25 by 125, that is 1,000. Next, cash sales, nothing to worry about, you don't have to worry. Cash sales is a transaction between branch and its customer. Cash received from debtors, ignore. Bad debts, ignore. Allowance to customer, ignore. Returns inward, sales return, ignore. Charges sent to bank, all this is paid by the bank. Rates and taxes, salary, miscellaneous expenses. 11 plus 1, 12. 12,000. So what will you do? Branch account debited to bank account. No. Branch account debited to bank account 12,000. Yes, paid by head office. Stock, closing balance. So you'll write over here by balance carried down stock. How much is the stock? 15,000. So here you'll write to stock reserve 15,000 into 25 by 125. 3,000. Next you have debtors 4,000. Just write closing balance of debtors 4,000. Then you have petty cash 1,000. Closing balance of petty cash 1,000. Done. That should be it, guys. Now whatever you get, it will be transferred to P&L. This is the profit. One second. You have not received any money from head office, right? I mean from branch, right? They have not told anything. What is this? Okay, we'll need a working note for that. Amount received from branch. Amount received from branch. Whatever cash sales is there, they will give us that money. The cash sale money is how much? 12,000. And then whatever amount is received from debtors, that money also they will give it to us only. Now here, amount received from debtors, they have not given us any information. But what is the opening balance of debtor? 5,000. Clear? Oh, sorry, my bad. Cash received from debtor directly they have given, no, 30,000. So now what will happen? This 30,000, you don't have to do any calculation. So 42,000 will be the amount that is sent. So here you will write by bank 42,000. You have to get that money. So 2,500 plus 8,000 plus 5,000 plus 42,000 plus 15,000 plus 4,000 plus 1,000. 5,000, huh? Are you sure? 2,500 plus 8,000 plus 5,000 plus 42,000 plus 15,000 plus 4,000 plus 1,000. 77,500 it is. Minus 12,500 minus 5,000 minus 1,000 minus 40 minus 1,000 minus 12,000 minus 3,000. Isn't it 3,000? So check. Are you getting 3,000? It should be 3,000. 3,000. Yes, this should be your December 2025 done. Now we'll go into December 2025. One more question is there. 6A, branch account, small one for 7 marks. HP Private Limited opened a new branch at Delhi. HP Private Limited sent goods costing 50,000 to Delhi branch. Delhi branch sold entire goods at 80,000. Branch paid expenses 7,000. No other transaction occurred at the branch. Prepare branch account in head office books and find out the profit. Look at it. 7 marks. Model test. Just for the sake of giving a question, they gave a question. Now see how big the question will be, okay? You have to prepare branch account. Now, they opened a new branch. So there will be no opening balances. They sent goods costing 50,000 to Delhi branch. So, to goods sent to branch account 50,000. Next, branch sold entire goods in cash for 80,000. They sold it, they'll give us money. So by bank 80,000. Next, branch paid expenses of 7,000. Who will give them money to pay the expenses? We only have to give money, right? So to bank account 7,000. Or directly you can write 80,000 minus 7,000, 73,000 over here, telling that net amount is given to us after the expenses. Next, no other transaction occurred at the branch. What a huge question. 73 minus 50, 23,000 profit to P&L. They asked this for 7 marks in the exam. I mean, not in the exam, but in the model test paper. So with that, we are done with our branch accounts discussion.
Okay, students, let's go into the accounting standards. So we'll discuss the concepts in detail so that if direct conceptual question comes, you can easily score. Usually they ask a lot of direct conceptual questions. So 4 marks, 5 marks, whatever it is, you can score. First we'll go into AS1. Disclosure of accounting policies. Now, this standard doesn't deal with accounting policy to follow. They are not telling us in this standard what accounting policy to follow. They are just telling that whatever accounting policy you follow, disclose it. Just disclose it. All significant accounting policies adopted in preparation and presentation of financial statement should be disclosed. It should be disclosed in one place, whatever it is. The disclosure of significant accounting policies should form part of financial statement and should normally be disclosed at one place, notes to accounts. So end of the financial statement, if you see any company's financial statement, after the financial statement is done, there will be notes to the financial statement. Okay, you will study this in corporate accounting. There will be notes to financial statement, 1, 2, 3, 4 notes for the balance sheet and P&L. After that, there is one part called as notes to accounts. In notes to accounts, you will have full information about all the accounting policies that have been followed. The story about that, disclosure about that will be there. Now, this can be directly asked. Fundamental accounting assumptions. Now, fundamental accounting assumptions, if you ask me, there are 3. Okay. Going concern, consistency and accrual. Going concern, consistency and accrual. Now, what is going concern? If you ask me, what is going concern? Going concern means basically in normal words, business will not shut down. It will continue. That means entity does not have intention nor any indication of shutting the business in foreseeable future. That means anytime in the near future, business does not have any intention or indication of shutting down. What is intention? Intention means I only want to close the business. Business is going good, but I want to close the business. What is indication? What is indication? Business I want to continue, but there is heavy loss and nobody is buying our product, so we are forced to shut down. Clear? Next, consistency. Consistency means what? Whatever accounting policies we are following, we should consistently apply it over a period of time. So accounting policies chosen must be consistently applied from one period to another period. 3. Accrual. Accrual means what? Transactions to be recorded as and when they occur and not necessarily when the amount is paid or received. So transactions, that's why even if it is outstanding salary, we record it. We didn't pay, but still we record it because transactions have to be recorded as and when they happen. Yes, these are 3 things that they can ask directly, fundamental accounting assumptions. Now, conditions about fundamental accounting assumptions. Now, if you give me a financial statement, I will always assume that this assumption is followed. That means they are always following consistency, they are always following accrual, and they are always following going concern. Now, it is assumed by the reader that it is always followed. Disclosure to be made if fundamental accounting assumption is not followed. Disclosure you have to make. Now, selection of an accounting policy. This also can be asked. Points to be considered in selecting an accounting policy. What are the points that we have to consider in selecting an accounting policy? Substance over form. Substance over form means what? Don't worry about the legal reality. Focus on the economic reality. Imagine the land belongs to your father, but the building is constructed by you and you are using this using this building for your business. You are using this building for your business. That time what will happen? Still this land will be considered as your building only. It will be taken as property, plant and equipment in your books only. And that land will be depreciated in your books only. The land will be depreciated in your books only. So this is what you have to remember. Substance over form. That means truth over legal form. Don't worry about the legal reality. See the economic reality. In future you will study one standard called as leases. In leases, same thing. In finance lease, owner is actually lesser, depreciation is charged by lessee. Now forget about lease. Lease is not there in financial accounting syllabus. What about hire purchase? What happens in hire purchase?
The last installment, the ownership.
Last installment, the legal ownership will be transferred. Till then, the owner will be lesser only, but depreciation will be happening in the books of lessee. It will be happening in the books of lessee. Substance over form. Materiality means whatever information helps the reader in decision making, provide it. Don't stuff all the information. What information is necessary for the reader to understand the financial statement, that you provide. Clear? Prudence. What about prudence? provide for foreseeable losses, not for future profits. That means if you see loss in the future, okay, provide it. If you see profit in the future, ignore, don't provide it. Conservatism, that is basically. Now next, changes in accounting policy. Changes in accounting policy. Now enterprise can change its accounting policy only in the following if the following three conditions are satisfied. First one, if it is required by statute or law, if it is required for the compliance of some other accounting standard, then it is for better presentation of financial statement. Note, such changes affect the financial statement of either current period or later years. That means if it is affecting current year or future year, whatever it is, it must be disclosed in the current period. Now, see, you change one accounting policy that has impact on the current period. Amount is ascertainable. Okay, amount must be disclosed. You changed an accounting policy because of that 50,000 extra profit. Tell 50,000 extra profit. Amount is not ascertainable. Changed an accounting policy, but because of that, right now no profit or loss has happened. Fact to be disclosed, that you are unable to quantify the effect. Okay. Not material in current period, but affects the future period. That means imagine you have changed an accounting policy for pension payment. It is not affecting your current period, but it will affect your future period. Still, fact of such change affecting the future period must be disclosed in the current period. So you change an accounting policy today, impacting you today, profit or loss, tell. Change an accounting policy today, impacting you today, but you don't know whether profit or loss is there or not, tell. Fact you tell. Change an accounting policy today, it will affect the future, still tell. Okay, this is your AS1. All the standards concepts will finish, then we will go into all the standards questions. Okay guys, let's go further into the next accounting standard, AS10. AS10 is the next accounting standard that has been told in your particular material. Okay, it's very important standard. I see almost every time they ask one question from AS10. Now, I'll share this material across, don't worry. Okay. AS10, property, plant and equipment. Now, meaning of property, plant and equipment. Property, plant and equipment means what? Tangible items. Tangible means it can be seen, touched, felt and all that. Basically, it is something that has physical substance. Now, because it is tangible item, it is AS10. If it was intangible, okay, it would have been AS26. It wouldn't be AS10, it would have been AS26. Now, held for. Now, just because it is tangible item, it will not be considered as property, plant and equipment. Held for use in production and supply of goods or services. Now, held for use in production and supply of goods and services means what? Now, you are having one truck. Are you going to produce anything with this truck? Can you produce anything with this truck? No. You can only supply, transport goods, correct? So, it is for the supply of goods. Supply of goods. Now, imagine you have, like for example, you have this camera. Correct? Are you going to supply goods with that camera?
Service.
No, you are going to supply services with that camera. Now imagine you have one machine. Are you going to supply goods or supply services? No, you are actually going to produce goods with that. Okay, so either you should be able to produce goods or supply goods or supply services. Then only it will be considered as property, plant and equipment. Now imagine you purchase a small machine. You can't produce goods also with that. You cannot supply goods also with that. You cannot supply service also with that. In such case, what will happen is, whatever amount you spent, okay, that will not be considered as property, plant and equipment. It will be considered as expense. Now, see, any expense has debit balance. Correct? Now, an expense which is there, it can have two impacts. Either it can be taken as revenue or it can be taken as capital. Now, if it is taken as revenue, it will go to P&L. If it is taken as capital, it will come here and it will be sitting as property, plant and equipment. So, either it is P&L or it is asset. If it is asset here, it will be shown as property, plant and equipment. Now, when we prepare financial statements or final accounts for sole proprietor, we don't call it as property, plant and equipment. We just write fixed assets. Because AS is not applicable to that sole proprietor. But AS is applicable to companies. Companies, they will not write fixed asset. They will write the heading as property, plant and equipment. Now, administration purpose. It is not used for production, supply, all these things. But imagine at the entrance of the building, there is one small machine, okay, to scan your fingerprint and enter. This fingerprint scanner, are you going to produce goods with that, supply goods with that, supply service with that? No. Now with this fingerprint machine, what you can do actually, only for administration, just to check whether the employees are coming on time or not, okay, and to calculate their bonus, all those things, you can use that machine. So even if it is used for administration, still it will be considered as property, plant and equipment. Rental to others. I have one car. I am not producing any goods with that. I am not producing any services with that. I am not using it for administration purpose also. Imagine this car I am giving to my MD to go from office to home and home to office. Then it will be considered as used for administration purpose. I am not using for that also. I am just giving this car on rent. Still this car will be considered as asset. That is property, plant and equipment. So either you should use it for production, or you should use it for administration, or you should be giving it on rent. Now expected to be used for more than one accounting period. That means after doing all this, if you can use this, imagine I have a crazy machinery. I can manufacture goods 24 hours with that machinery. But if I can't use it for more than one accounting period, that means if I can't use it for more than 12 months, gone. I have a machine, but I can't use it for more than 12 months, then it will not be taken as property, plant and equipment. It will go to P&L as expense. Clear? Next. Now we know what is property, plant and equipment. Next we'll go into recognition of property, plant and equipment. When will you recognize property, plant and equipment as property, plant and equipment? Now, property, plant and equipment should be recognized only if both the conditions are satisfied. If these two conditions are satisfied, then property, plant and equipment will be considered as property, plant and equipment. First one, cost can be measured reliably. Cost can be measured reliably. That means there should be cost. Imagine you got a car on gift. Somebody gave that car to you for free. That means there is no cost involved. You cannot recognize it as property, plant and equipment. It is probable that future economic benefit will flow to the enterprise. You purchased a machinery and you decided that you will use it for more than 12 months. And you thought actually you can use that machinery for 5 years. And you thought, okay, with this machinery I will produce goods. So if you are going to produce goods with this machinery, this is obviously going to be considered as property, plant and equipment, because it is expected to give you benefit for more than one accounting period. But if it is probable that future economic benefit will be flowing, that's it. Now, for example, as soon as you purchase the machinery, government banned that machinery itself. Now, can you use that machinery for more than one accounting period? No. Will it give you future economic benefit for more than one accounting period? Will future economic benefit flow to the enterprise? No, you will not get any future economic benefit because that machine itself is banned. That time what will happen? Whatever value is there for that machine, that will be transferred to P&L. It will be transferred to P&L. Clear? Next, initial measurement of property, plant and equipment. How to calculate the cost of property, plant and equipment? They can ask you this question as well. Now, purchase price. What amount you have paid? So basically when you purchase a machinery, just remember this. When you purchase a machinery, whatever amount you have spent to bring that machinery from there till here, everything will be added. Now, purchase price added. Trade discount. You got discount. Obviously, you have to subtract. The price has gone down. So it is subtracted. Ignore cash discount. Cash discount we are not going to bother now because cash discount is a discount which is there at the time of payment or receipt. So when you pay money or receive money, that time cash discount will come into picture. So it will not going to be considered now. Non-refundable import duty and taxes. You have one subject called as indirect tax. In that you have a subject called as GST. Now in GST what happens? There is a topic called as ITC, input tax credit. That means you have made a payment and later on you will get refund of that payment. Refund means you will not get directly, it will get adjusted with your output. So they said that non-refundable import duty and taxes. If you pay some import duty, when the machinery comes to the port, you have to pay one import duty. If that import duty you are going to get refund in the form of ITC, then you don't add it because you paid now, it will get adjusted later. But if at all no refund, then you add it because it's your expense. Next, transportation cost. To bring that machinery from there till here, whatever you have spent, add it. Handling, loading, unloading cost. In the port, someone has to unload it. Again, they have to load it into a truck. Whatever cost is there for loading, labor charges, everything will be added. Insurance on purchase. It is coming through a ship. When it is coming through a ship, we have taken one marine insurance policy so that if it sinks, we are safe. So that insurance policy also, insurance premium also will be added. Brokerage to buying agent. I didn't know only where I can buy this asset. I have paid money to one agent. That fellow is giving me the asset, and for that he is charging one commission. That also will be added. Basically, whatever expense we have spent to bring that property, plant and equipment to the present location and condition, everything will be added. Now, self-constructed asset. What is self-constructed asset? We only manufactured the asset. Maybe we manufactured the machinery or we constructed the building. Now, direct material, direct labor and other direct cost. This is basically your 3 chapters of costing. Correct? Prime cost it becomes. So whatever material we have spent, whatever labor we have spent and whatever other expenses we have spent on the construction or production will be added. Production overhead. Okay, production overhead. Electricity is required. That is production overhead. Or one supervisor is there. Production overhead. Whatever we have spent, everything will be added. Architect and consultants fees. Some person has actually drawn the diagram and given. He has not constructed. He has just drawn the diagram that building should be like this. Okay, that fellow's cost also will be added. Site preparation cost. The land was like this. I wanted to construct the building. So I made it level. After I make it level, then only I can construct the building. So that also will be added. Installation cost. If it is not building, if it is a machinery, after preparing the machinery, I called one specialist. That fellow has installed the machinery. That also will be added. Now, cost of trial run. What is cost of trial run? Machinery is ready. Okay, machinery is ready. You can start using the machine. But you want to check whether it is working to the best effective manner or not. So what you have done, some 2-3 days you have run it on free. Okay, and supplied the goods to everyone to check their feedback. So that is called as cost of trial run. Trial run. Clear? It's basically like if when you go to the vehicle showroom, they'll give you one bike or car, no, to just go for a test drive. That petrol they don't collect from you, right? That maintenance is not collected. That is the trial run expense for them. Now, minus sale proceeds from units produced during trial run. Imagine machine was there. This machine for me, I'm using it to manufacture chips. With this machinery, what I'm going to do, I'm going to manufacture chips, but 2-3 days I want to see how is the effect. So I manufacture chips and I'm selling it for 5 kgs. 5 kgs packet, I'm selling it for 10 rupees. Just to see the feedback of people, I'm keeping it and selling it. So during the trial run, whatever you get, that is a benefit for you. So that will be subtracted. Whatever you spend, that will be an expense for you, that will be added. Cost of trial run will be added, and whatever sale proceeds you get, that will be subtracted. Next, present value of dismantling or decommissioning. After 5 years, you know that you have to dismantle this machine, but you already know you have to dismantle this machine. What you will do, you will take present value of that and add that also. And present value of restoration cost. After 5 years, you know this machine is useless. That time I have to remove this machine and then restore the land to its original situation. Usually what happens, machine and all, no, they'll fix it to the ground itself. They'll make one foundation and fix it. So after 5 years, if machine is useless, they have to remove the machine. That time land will still be uneven. So they have to level the land. So after 5 years, what they are going to spend on restoring, that also will be added. Clear? Next. Any other directly attributable cost. That means this is etc. Anything else. Anything else is there added. That's all. Items ignored while calculating cost. Now, when you get a question where they tell you calculate the cost of the machinery or cost of the asset as per AS10, what should not be added, you should be more careful. Tax if credit is available. What they told over there, only if it is refundable. Okay, oh sorry, only if it is non-refundable. So if it is refundable, that means if credit is available, don't add. Then office and admin overhead. Some person is sitting in the office and passing all journal entries. That fellow has no connection with purchasing this machinery. That fellow's expense and all, you don't add. Yeah, selling and distribution, don't add. After you get this machinery, from that you will manufacture goods. Then you will sell those goods. When you are selling those goods, you need some agent. That commission and all, you don't go to add to the machinery. Abnormal loss. Abnormal loss is what? Loss which could not be, loss could be avoided, but we did not avoid it. That will go straight to P&L. It will not be added to the property, plant and equipment. Advertising cost of new product. One new product is manufactured. Okay, now you don't tell that product was manufactured from this machine. So advertisement I made for that product, that also will add to the machine. Don't do it. Interest cost, unless it is allowed by AS16. We are going to study AS16 later. It's there, part of our syllabus. Okay, if interest cost, AS16 is telling capitalize. AS16 is telling add. Then you add. Otherwise, do not add. Next, relocation of staff cost. That means because you brought one machinery over here, you shifted staff from one more factory of yours and you brought them over here. That will not be added. Clear? Next, operating losses. This is like you constructed one building, big factory building. This factory building is property, plant and equipment. And in this factory building, first 2 years, full loss. Now you can't tell that loss also I'll add it to the property, plant and equipment. Loss should be shown in P&L itself. Training of staff cost. Imagine you have a machinery, your staff don't know how to operate it. You bought a new machinery paying 2 crore rupees. Okay, your staff don't know how to operate it at all. So now what will you do? You have to train the staff. Now training the staff, you are going to spend some time. That is not going to be considered as property, plant and equipment. Inauguration cost. You constructed one beautiful building and you constructed one beautiful building and you called Dhoni for inauguration. Okay, now Dhoni is called for inauguration. Now, whatever you are paying him, let's say you are paying him 2 crores just for inauguration, you are calling him and you know that if he comes for inauguration, everybody will come and visit your factory and they'll buy your products. Now, what you paid Dhoni is not necessary for the product to start working because product is already ready. This is just your marketing expense or advertisement expense. So whatever you spend for inauguration, don't add it to the property, plant and equipment. Now, income during construction of PPE. Income during construction of PPE. Simple. Your building is getting constructed. Let's assume your building is getting constructed over here. Okay. Now, that time you can't start manufacturing. No, your factory can't start working. Now, not directly attributable, transfer to P&L. What does it mean? Now, imagine outside there was some space. There, that outside space, okay, outside space you have given to one Pani Puri vendor. You told Pani Puri guy, you use this space now. Now I don't require this place. You stand here, you sell your Pani Puri. Okay, now is it directly related to the construction of the building? No. Transfer it to P&L. But when you're constructing it over here, okay, if at all you got some, let's say, when you're constructing the building, ground floor is completed. Now you told the Pani Puri guy, you can make your chart shop inside. Till my first floor is ready, you can make your chart shop inside and sell. Now is it directly attributable? Yes. Now you reduce it from the cost of the PP. So if it is not directly related to the construction, don't. If it is directly related to the construction, then subtract. Next, PP acquired on deferred payment. Deferred payment means what? Payment beyond normal credit period. That means usually I have to pay within 3 months. But suddenly they gave me 9 months time to pay. That means they are giving you extra time. When they are giving you extra time, obviously there will be interest. There will be this EMI option, no? When you go and purchase electronics and all. Some of the EMI options they will tell 0 interest. Some of the EMI options actually there will be interest in that. If they give you 12 months, 18 months and all. So now recognition of PP. PP is recorded at normal purchase price. How much you paid, that only. That extra price what you are paying, that is basically your interest. Okay, if normal purchase price is not given, then take present value of future cash flows. Now you don't know the normal purchase price. They are only telling that take this computer and every month pay 5,000. They are not telling you what is the value of the computer today. That time every month you are paying 5,000, right? Whatever 5,000 you are going to pay in future, take the present value of that 5,000, you will get the cost of the PPE. Clear? Interest. Total cash outflow minus normal purchase price. The difference whichever is there, no, whatever you are paying minus normal purchase price, interest to be transferred to P&L over the credit period. Now understand this. Imagine I purchased one property, plant and equipment for 1 lakh. Clear? And what I am supposed to pay is, if I add all the EMIs, when I add total, it's coming to 1,20,000. It is coming to 1,20,000. Now, can you see the difference between 1 lakh and 1,20,000? 20,000. This difference of 20,000, what is there? That is interest. Okay, asset will be shown at 1 lakh only. Even though you are paying 1,20,000, asset will be shown at 1 lakh. 20,000 will go to property plant as 20,000 will go to P&L as expense. Clear? Now, property plant equipment acquired in exchange of asset. Okay, you are giving old asset and you are purchasing new asset. Now, this is the important part. Transaction has commercial substance. What does transaction has commercial substance mean? That means recognize PP acquired at. See, first you have to understand what is this commercial substance. Commercial substance means it is going to give you benefit in the future. Now, if you notice, we have discussed commercial substance here. Has commercial substance means PP acquisition affects the cash flows of the entity. Lacks commercial substance means property plant equipment acquisition does not affect the cash flow of the entity. That means I have one machinery over here and I am going to give this machinery and take this machinery. Now this machinery was giving me 5 units per hour and the new machinery also will give me 5 units per hour. That means, is there any impact on my cash flow? Extra will I get benefit? No extra benefit. I gave this machine also is giving me 5 units, new machine also is giving me 5 units. But in case this new machine is giving me 8 units, if this new machine is giving me 8 units, that time is it going to impact my cash flow? Am I going to get future benefit? Yes. That is called as has commercial substance. If it has commercial substance, recognize the PPE acquired. Now new machine is coming in, right? The new machine you acquire at first preference, fair value of asset given up. That means fair value of old asset. I think we have written in notes on this one. Fair value of old asset. The exchange offer. Fair value of old asset. If that is not there, second option is fair value of asset acquired. That is fair value of new asset. If that is also not there, then you take carrying amount of old asset. Carrying amount is nothing but WDV. So first preference what I am exchanging. Okay. I don't know the fair value of I don't know the value of this asset only. When I'm exchanging, I'm getting new asset. Okay. Which asset I give, the market value of that asset, that will be taken as the market value of new asset. I don't know the market value of this asset. What will I do? The market value of the new asset I'll take. I don't know that also. Then what will I do? WDV which is there in the books, no, that only will become the value of the new asset. Clear? If it lacks commercial substance, means what? There is no use only. There is no use only of this asset. I mean, use means it is not going to give me extra benefit. It's giving me same. What old asset was giving, that only. So that time recognize the property plant equipment at carrying amount of asset given up, no loss or gain. That means what WDV was there for old asset, that only will become the WDV of the new asset. Now, property plant equipment exchange of asset, journal entry. Now, understand this, property plant equipment acquired in exchange and cash given. Now, if you go and give vehicle and have an exchange offer in vehicle, do you think you give old vehicle, you will get new vehicle, done, finished? No, right? Some amount they will ask you to pay, right? Now, imagine you have a bike. Okay, you have a bike. You are giving this bike and you are buying one BMW bike. Now, do you think they will just take this bike and give new BMW bike to you? No, they will ask you differential amount, they will ask you. So, property plant equipment acquired in exchange and cash given. That means property plant and equipment debited. Why? New asset is coming in. But amount above amount plus cash given. Whatever you decided no above. That is fair value of asset given up, fair value of asset acquired, okay, or WDV, whichever you have taken, that one. Plus you have paid extra 50,000. So that will be added. To cash, because cash is going out. And then to asset, the old asset is going out. Clear? Now profit or loss obviously will be there, that will be transferred to P&L. Now if at all you are getting cash, can you get cash? Imagine you have a bike which is very popular. Now you are giving that bike and taking one little cheaper bike. So now you don't have to give money, that fellow has to give you money. Okay, that time property plant equipment debited, whatever above amount we calculated, that is fair value, market value of the asset given up, market value of the asset acquired, or WDV, whichever we chose over there, above amount minus cash received. Because cash you are going to subtract and cash you are going to show it separately. Okay, cash received to asset carrying amount. Okay, here also you can get profit or loss. Now depreciation on PP. This is a very, very important topic, but we have done it like plenty of times. Now, simple. When to start depreciation? When the asset is ready for use. Put to use is irrelevant. When you study DT, direct tax, there is a depreciation section over there. There, the depreciation will be from the day asset is put to use. Not ready for use. In accounts what we do, depreciation will start only when asset is ready for use. Now component wise depreciation. Component wise depreciation means what? Now you have one car, you can actually tell, oh, tire 2 years depreciation. Engine 10 years depreciation. Body 5 years depreciation. The option is given, they are not telling you should do this only. Option is given. Now if you want you can do it. Land obviously no depreciation. Building there is depreciation. End means what? When will depreciation end? Property plant equipment sold. Obviously depreciation has to stop. Remember in chapter number 1 when we were discussing depreciation, we always calculate depreciation till the date of sale of the asset. Next, or property plant and equipment held for sale, whichever is earlier. I want to sell this calculator. As soon as the calculator is sold, depreciation will stop. Or I stopped using this calculator. Remember, first point of property, plant, equipment was it should give you future economic benefit. Now I stopped using this calculator. I kept the calculator in the side. I am waiting for buyer to buy this calculator. That time also depreciation will stop. Whichever happens first. Method of depreciation, SLM WDV, units of production method. Okay. Change in the method of depreciation. Prospective effect. What does it mean? If you change the method of depreciation, you give effect only from the date of change. Don't give effect from the beginning of time. From when you change the method, from that day the effect will be given. So consider as change in accounting estimate. Component accounting. Component means part of property, plant, equipment which has significant cost. I told you of that example of this car. Component, part by part. Depreciation to be charged for each component. Now, subsequent measurement of PPE. Cost model or revaluation model. Now, what you can do? You can follow cost model. That means it will always be shown at cost and you will subtract the depreciation. Revaluation model is if you want, you can revalue the asset. If you feel that asset value has gone up or gone down, you can revalue the asset. Now, treatment of revaluation. If asset value goes up, what is the treatment of revaluation? Not the revaluation which we do in partnership. Partnership revaluation is separate. That is only for getting the partner in, sending the partner out, nothing. Okay, that is not the revaluation which is done when regular business is going on. Now, here, whenever there is increase, if there is increase, asset has to be debited. Asset has to be debited. Asset value increased, asset has to be debited. Credit to revaluation reserve. If asset value goes down, asset has to be credited. So debited to P&L. Loss. Increase, credit to revaluation reserve. Subsequent decrease. That means in future it decreased. That time what you will do? You will not debit P&L directly. You will debit revaluation reserve first and then you will debit P&L. That means when the asset value went up, the profit you put into revaluation reserve. Now asset value went down. Don't take the loss from P&L. Take this from revaluation reserve. If there is extra loss, take it from P&L. Same way when asset value first time decreased, you have debited to P&L and subsequent increase. If there is an increase, that time credit P&L and credit revaluation reserve. Yeah, that is, imagine first time you had 40 rupees loss. You have debited P&L. Now when the asset value goes up, you have 90 rupees profit you have. So 40 rupees you put it back to P&L and extra profit that you made, that you put it to revaluation reserve. Now revaluation to be made for entire class of assets. That means you have one group of assets. Entire group you have to do the revaluation. You can't do revaluation for 1-2 assets in the group. That's it guys. This is AS10. Yes. Let's go into AS11 guys. So after this we'll have AS11, AS16 and I think AS22, right?
22. AS12 also. Government.
AS12 and then AS22. Yes. Now AS11. Okay. Understand AS11. Effect of changes in foreign exchange rate. Effect of changes in foreign exchange rate. Actually there are 3 parts. Focus is only on part 1. Part 2 they are not asking at all. You will study part 2 in your CMA final. In a subject, part 3 you will study in CMA final in a subject called as Strategic Financial Management. See, part 3 is about foreign exchange contracts, that is forward contracts. Okay, here only the explanation of what is forward contract is there, but problems related to that you will study over there. Part 1, accounting for foreign exchange transactions. Okay, so if you have a foreign exchange transaction, you brought goods from USA or you sold goods to USA, you have to record that. Part 2 is there. Converting financial statement of foreign operations that we already studied in branch accounts. Remember, foreign branch was given in dollars. We have to convert that into rupees. Remember, I told you that if it is a monetary item, you will take closing rate. Non-monetary item, you will take actual rate. If actual rate is not there, you will take average rate. Income or expenses, you will take average rate. All these things is already covered in branch. So here we are going to study only about foreign exchange transactions. Now, some important terminologies you have to understand. Reporting currency. Reporting currency means what? Imagine you have, you are preparing financial statement in India. Then India means financial statement will be prepared in rupees. So reporting currency will be rupees. Foreign currency means what? Anything other than rupees for me right now will be foreign currency. Now, if at all you are preparing financial statement in London, then it will be pounds. Clear? Exchange rate. Exchange rate means what? At what rate you can convert one currency into another currency. Forward rate. Forward rate means what? Today only I enter into deal with you that after 3 months I want dollars. That time you should give me dollars at this rate only. You agreed. Okay, that is called as forward rate.
That is the current rate.
No, that is a forward rate. Today I saw that dollar is 80 rupees. Okay. $1 is 80 rupees. Now after 3 months, I have to pay somebody some money in dollars. So because I have to pay somebody some money in dollars, I feel that rate will go to 90 rupees. That is very bad for me. Okay, so I came to you and told, can we get into a deal? Can you give me dollars at 82 rupees after 3 months? You agreed.
Okay.
Now the thing is, why did you agree? If you're thinking, why did you agree? Because you don't think the same thing. In the Forex market and in the stock market, people don't have the same opinions. One person feels it will go up, other person will feel that it's going down. That is why trade happens. If everybody feels that price is going to go up, then whom will you buy and sell with? Are you getting this? Okay, so that is, I entered into a contract with you telling that after 3 months you have to give me dollars. You said okay. Now, closing rate. Closing rate is what? End of the financial statement date. That means balance sheet date, what rate is there? That is called as closing rate. Monetary item, we already discussed in for this thing, branch accounts. Monetary item means what? What is monetary item? Anything that is fixed and determinable. Example for it is debtors, creditors, bills receivable, bills payable, loan given, loan taken, cash, bank. Non-monetary item is like your fixed assets. It's not fixed. It keeps changing the value. Now, accounting treatment we'll see for foreign currency transactions. Now, see, foreign exchange transactions are there. Imagine one person is called Shreyas. Okay, he sold goods to Navin. Sold goods to Navin. How much? $5,000 he sold, and it is payable. Now, with this example, we'll cover full foreign exchange transaction. Understand this. Payable on what date? 1/5/2024. Payable on 1/5/2024. Now, 1/2/2024 is when they sold the goods. 1/5/2024 is when you have to pay the money. Clear? Now, there are 3 steps here. In foreign exchange transaction, there are 3 steps. One is called as initial recognition. Second one is called as balance sheet date restatement. Third one is settlement. Now, I have actually sold. Shreyas has sold goods on what date? 1/2/2024. So, he has to pass the sale entry. But to pass the sale entry is not a problem. Sale entry, what entry will he pass? Debtor account debited to sale. But the amount is in what? Dollars. Now this dollar amount, he has to convert it into rupees. That's why we came to AS11. Clear? Now initial recognition, recognize the transaction on the date of transaction. At what rate? Convert it at the rate on the date of transaction. When did the transaction happen? 1/2/2024. On that day, what was the rate? 80 rupees. So 5,000 into 80 rupees, just convert it and record it in rupees. Okay, debtor account debited to sales. Clear? Entry is normal accounting entry. Only thing is, for that entry we need amount. That amount how to convert, that AS11 is telling. Now next date actually for us is 1/5, right? 1/5. But what has happened over here? Between 1/2 and 1/5 there is a balance sheet date. On balance sheet date, see, restatement on balance sheet date. Monetary items. Any monetary item is there which is receivable or payable, restated. That means on balance sheet date there is one debtor who has to pay me money in foreign currency, or I have a creditor where I have to pay in foreign currency. There is one loan where I have to repay the loan in foreign currency. There is one loan where I have to get the money in foreign currency. If you have some receivable or payable like this, restate it. Restate it means what? Adjust it and bring it to that day's rate. Now, non-monetary items, ignore. Now, for us, in our this transaction, debtor is a monetary item, which is receivable. Now, on the balance sheet date, the rate has gone to what? 84. From 80, the rate has already gone to 84. Now they are telling, first you recorded your debtor at the rate of 80, right? Now they are telling, record your debtor at the rate of 84. It is already recorded at the rate of 80. Record your debtor at the rate of 84. So now from 80, I have to increase it to what? 84. So $5,000 into 80 minus 84 minus 80, 4 rupees increase. If 4 rupees increase is there, 20,000 rupees. Debtor increases, debtor is an asset. Asset increases, it is good for us. So Forex difference will go to P&L as credit. Now in the same case, instead of debtor, if it was creditor, then it was not going to be this way. Creditor, if rate increases bad, then P&L would have been debited. Here P&L is going to be credited. Clear? Next, settlement date. On settlement date, what happened? The rate has gone even more higher. It has become 85. When you get money from your debtor, what is the entry actually? Bank account debited to debtor. Clear? Now, you will pass the entry, settlement date, record at the rate on the date of settlement. Bank account debited, you have written. Bank account debited. $5,000 into 85, because that is what you got. You got 85. But your debtor in the books is sitting at 84. Remember, debtor was at 80. Then on balance sheet date, you made it 84. So debtor is sitting at 84. You got profit of 1 rupee. That is again going to go into Forex difference P&L. Clear? Now here addition to that, you have to remember one thing, that is MCA notification. There is one MCA notification. They said, simple boss, you borrowed loan in foreign currency. No problem. Difference if it is there when you are paying money, it will go to P&L. But if you borrowed loan for the purpose of depreciable asset, then I'm giving you option. The difference which is there, instead of putting to P&L, you can adjust with your asset itself. So understand this, loan borrowed $5,000 for the purchase of depreciable asset. If it is purchase of land, it is not applicable. Depreciable asset. And that day the rate was 82. Now date of repayment, rate has gone to 84. Now there is a Forex loss of 5,000 into 2 rupees, 10,000 rupees Forex loss is there. As per AS11, actually what you are supposed to do is debit it to P&L. But because of MCA notification, you can debit it to property, plant and equipment. This is an option that is given. It is an option given to the company. If they want, they can debit it to P&L, or they can debit it to, they can add it to property, plant and equipment itself. Is this clear? This is your concept of AS11. Yes. Let's go into the next accounting standard. The next accounting standard talks about AS12, that is government grants. Government grant means what? Government giving you money, government helping you, correct? Now, when we are talking about government grant, okay, what is not applicable, you have to understand. One thing that is not applicable is government participation. Now, imagine there is one guy called Akash. Okay, he's starting business. Now, if government gives him money for doing the business without expecting anything in return, then it will be considered as government grant. But here, government is giving him 1 crore and taking 30% shares in his company. If they are taking 30% shares in his company, that becomes government participation. Okay, so when they become government it becomes government participation. That means government is also one of the owner in the company. Then it's no longer a grant. Now, first grant that we have is bailout grant. Now, bailout grant means what? See, someone is in trouble inside the well. Okay, that means they are in trouble. Government is giving 1 crore to pull you out of trouble. Okay, when you are in loss, government is giving you money to pull you out of loss. Now, loss will be there in the P&L. So, bank account debited to P&L. So, you credit the P&L, your loss got set off over there. Next grant that we have is income grant. Now, when we are talking about income grant, that means you are successful, you are at the top of the mountain. Because you are doing good things, government gives you money, and that money, okay, it will also go to your P&L. It's like a reward. Income grant can also be called as a reward grant. Reward grant because you are doing good things, so they are giving you like boost your confidence. Okay, expense grant. Expense grant is what? Now, not like income grant, not like bailout grant. Expense grant is given specifically for particular expense. Imagine you have to pay salary over here, and 1 crore is given to you just to pay the salary. So now you can use that 1 crore only to pay the salary. In this case, directly you will not put it to P&L. Yes, when you get the money, bank account debited 1 crore, you will keep it aside called as deferred government grant. Okay, in the balance sheet it will be shown as a liability, deferred government grant. When you pay the salary, you will pass the entry, salary account debited to bank. Once you pay the salary, after that what you will do? Okay, salary will go to P&L, P&L account debited to salary. Now, did the expense go to P&L? But that expense was not paid from your pocket at all. So what will you do? Deferred government grant to P&L. Can you see this P&L got adjusted with each other. It should get adjusted because we didn't spend even 1 rupee from pocket. Next we have is non-monetary grant. What is non-monetary grant? They gave you one machinery, market value is 80 lakhs. They gave it to you for free. Okay, they gave it to you for free. You will pass an entry, plant and machinery account debited to capital reserve. Plant and machinery account debited to capital reserve. Now this will be recorded at nominal value of 110 or 100. It will be recorded at what? Nominal value of 110 or 100. Why nominal value? Because we got it for free. Actually we didn't spend even 1 rupee. But to bring it into the books, you will show it at either 1 rupee, 100 rupees or 1000 rupees or so on. Clear? Next, was given at 1 lakh. If they tell, here we told that the machinery was given for free. Here if I tell you that if at all the machinery was given at 1 lakh. At 1 lakh means what? at a concessional rate. If it is given at a concessional rate, then plant and machinery account debited to bank. Doesn't matter. If the machinery is worth 80 lakhs also, no problem. You purchased it at what price? At 1 lakh. So plant and machinery account debited to bank. Now, promoters contribution. Promoters contribution means what? They gave money to start the business. They have given money to you to start the business. So, but they are not the owner. They are not owner. They gave it to you as a promoter, but they are not becoming owner or shareholder. So, bank account debited to capital reserve. It's an extra profit for you which you did not expect, which you don't have to give back. It goes into capital reserve. Next, this is a very important one. Government grant related to depreciable asset. We'll take this example and understand. We have an asset. Cost is 5 lakhs. Scrap value is 1 lakh. Useful life is 5 years. Government grant received is 1,50,000. When you have a government grant which is related to depreciable asset, there are two things that can happen. Method one, government grant is reduced from the cost of the asset. You got government grant, you will reduce it directly from the cost of the asset. Now, when you purchase asset, what should be the entry? Asset account debited to bank account. Government grant received. For government grant received, what should be the entry? Bank account debited to asset account. Now, end of each year, what will you do? End of each year, depreciation will be there. Okay, now can you see asset was 5 lakh. Now 5 lakhs minus 1,50,000, 3,50,000. Now asset is sitting at 3,50,000. Okay, now what will you do each year? Cost minus government grant received minus scrap value divided by 5 years. That time you will get the depreciation per year. And depreciation is an expense which will go to P&L. Now method 2. Salvage value will be given in the question. Now, method 2 will be government grant is treated as deferred government grant. That means you are not going to touch the asset account. You will keep that separately. So, asset account debited to bank, same entry when you purchase the asset. Government grant received, instead of writing bank account debited to asset account, here we are writing bank account debited to deferred government grant. Bank account debited to deferred government grant, which will be a liability. This will be shown separately. Clear? Now, can you see your asset is still sitting at 5 lakhs only in the balance sheet. End of each year, depreciation is there. Depreciation account debited to asset. Can you see depreciation 80,000 over here? It's much higher than the depreciation of 50,000 over here. Okay, because we did not reduce the asset. Government grant was kept separate. So, 80,000 will go to P&L. Now, what will you do with that 1,50,000 government grant which you have kept separately? You will transfer to P&L every year. For 5 years. If it is 5 years asset, 5 years. See, deferred government grant account debited to P&L. So asset gets, depreciation goes to P&L debit. Deferred government grant goes to P&L credit. So 80 debit, 30 credit. Net still 50,000 only. Net is 50,000. So therefore, here also 50,000 only was debited ultimately to P&L. Here also it is 50,000. But what happens is, depreciation goes for higher value and deferred government grant also goes to P&L. Now, balance sheet. If it is method 1, see, asset will look like this, 3,50,000. If it is method 2, balance sheet, asset will look like this, asset 5 lakhs. But opposite side you will find deferred government grant 1,50,000. Now, P&L, method 1, what will happen? You will write 2 depreciation, 50,000. But in method 2, what will happen? You will write 2 depreciation, 80,000. But on the other side, you will have by deferred government grant, 30,000. Now, refund of government grant. Refund of government grant. Now, whatever we have discussed till now, any of these situations can end up in refund. Refund means what? Government will give you, but with some conditions. They'll tell that you have to fulfill these conditions, preconditions. If you don't follow these conditions, then I will ask you the money back. Conditions doesn't mean that you have to give me profit. Condition means utilize for business only, utilize for this purpose only. Now, if at all here, it becomes refund. Now, what will be this entry if at all there is a refund here? You will pass the entry P&L account debited to bank account. It just got reversed. Here if at all it is there, here also P&L account debited to bank account. Here if it gets reversed, okay, it ultimately everything went to P&L. It went to P&L only. So here also you'll pass the entry P&L account debited to, bank account. Yes, non-monetary grant. Here you got it. Okay, it's sitting at this situation. So you'll reverse it. Capital reserve account debited to plant and machinery. If at all you had purchase the plant and machinery at a concessional rate and they ask you to give the money back. If they ask you money back over here, you will pass the entry P&L account debited to bank account. If they ask you the asset back, you will pass the entry P&L account debited to asset account. Now, promoter's contribution, it is bank account debited to capital reserve. So you will write capital reserve account debited to bank account. Now, government grant related to depreciable asset. Here we have to see. Now see, if there is a refund of grant, if at the beginning of third year government grant is refundable, beginning of third year means 2 years have gone smoothly. Now, if it is method 1, asset account, when you got the government grant, what you did, you have reduced the asset value. Now when you are refunding it, you will increase the asset value. So you will pass the entry asset account debited to bank account. Earlier when you got the money, you wrote bank account debited to asset account. Now you will write asset account debited to bank account. Now depreciation, third year, fourth year and fifth year. 3 years depreciation. Now what will you do? 5 lakh was the cost. First year what did you do? Government grant you received, so you reduced it. Minus government grant. Then first year's depreciation 50,000, second year's depreciation 50,000, gone. Now what happened to government grant? Refund. So it is added back to the asset. So plus 1 lakh 50,000 minus scrap value. Scrap value is 1 lakh. Okay. Divided by how many years are remaining now? Only 3 years. So that time you will get new depreciation of 1 lakh per year. Every year now the depreciation is 1 lakh. If you followed method 2, when you followed method 2, you did not reduce the government grant from the asset value. You have kept the government grant separately as deferred government grant. Now what will you do? Deferred government grant account debited 90,000. Why 90,000? Because out of 1,50,000, first year you transferred 30,000 to the P&L. Second year you transferred 30,000 to the P&L. So what is there in your deferred government grant is only 90,000. So deferred government grant debited 90,000. P&L debited 60,000. P&L debited 60,000. To bank 1,50,000. To bank 1,50,000. In method 2, during refund of government grant, there is no impact on depreciation. Because asset was not reduced, asset is not increased. So therefore depreciation won't change in method 2. Yes, that should be it with the AS12 concept, guys. Yes, the next one is AS16, borrowing cost. Okay, now simple, you have to understand one thing. Borrowing costs are what? Interest and other costs incurred in borrowing the funds. Clear? Now, for example, if I take this example, see over here, this person wants to borrow money. Okay. Sorry, this person wants to borrow money. She doesn't know how to borrow money. So what she will do, she will go to an agent. Okay. And agent, she'll ask agent, boss, can you get the money for me from the bank? Agent knows the complete procedure. She will get the loan sanctioned. Loan will go to that person. Now, because you borrowed loan, what is there? Interest on loan. Borrowing cost. Agent's commission for getting the loan sanctioned, that is also borrowing cost. Because you borrowed loan, you paid the EMI late, because of that you had to pay penalty, borrowing cost. Now you have money now, you want to close the loan early, borrowing cost. Processing charges are there of the loan, borrowing cost. Whatever is there, the cost which came because of the borrowing, that is considered as borrowing cost. Clear? Now, one rule is there. Borrowing cost related to qualifying asset to be capitalized till the asset is ready for use. Now, qualifying asset means what?
Time to ready.
Yeah, it will take some time for it to be ready. Any asset which takes time. Construction of building, qualifying asset. Manufacture of machine, qualifying asset. Purchase of machine, not a qualifying asset, because it's already ready-made machine you're buying. Okay, so an asset that necessarily takes substantial period of time to get ready for its intended use or sale. Borrowing costs are capitalized as a part of cost of qualifying asset when it is probable that they will result in future economic benefit for the enterprise and the cost can be measured. What are they telling? Borrowing cost will be capitalized, yes. But imagine you are constructing a building and on this you have incurred borrowing cost. That borrowing cost will be capitalized to the building. If at all building will give me benefit in the future. If building is not going to give me benefit in the future, we saw in AS10, if building doesn't give future economic benefit, building only will not be building. Building will not be taken as property, plant and equipment. When asset only is not there, you can't capitalize the borrowing cost. Clear? Other borrowing costs are recognized as an expense in the period in which they are incurred. Any other borrowing cost is there, it will be debited to P&L, it will be taken as expense. Now, borrowing cost eligible for capitalization. Borrowing cost eligible for capitalization. Now, if it is on qualifying asset to be capitalized, that means you will add it to the property, plant and equipment. If it is other than qualifying asset, it will be debited to P&L. Now, let's see some examples. Now, see over here. You want to construct one asset, so you got one loan. Okay, loan is 10 lakhs, interest is 10%. Now, try to understand these timelines. It will clear most of the concepts. Now, construction started over here. Construction started over here. Loan is borrowed on 1/7. Okay. And year ends on 31st March. Loan is borrowed on 1/7. Now, construction started on 1st April. That doesn't mean that borrowing cost will be there from 1st April. Yeah, it will be only for 9 months. So, those 9 months interest will be capitalized, added to the cost of the building. Now, see the next situation. Loan is borrowed on 1/4. Loan is borrowed on 1/4. Construction started on 1/7. Construction started on 1/7. So now what happens? When loan is borrowed, construction did not start. So 3 months interest which is there, it will be debited to P&L. After construction started, till the year end, whatever interest is there, 9 months, it is capitalized. So basically what you have to understand, loan also should be, interest also should be paid. Construction also should be going on. Then only borrowing cost can be capitalized. Here in the first case, only construction started, interest was not there, so it is debited to P&L. Okay, here construction is also going on, interest is also being incurred, both so capitalized. Now next one, loan is borrowed on 1/4. Okay, construction started on 1/7. These 3 months interest will go to P&L, and construction ended on 1/2. Construction ended on 1/2. Now what happens? From 1/7 till 1/2, whatever interest is there, that will be capitalized, because only during this time interest also was incurred, construction also was going on. Okay, now after 1/2, interest will be incurred because loan interest will be there till you repay the loan, but construction has already stopped. So when both are going parallelly, only that time period interest can be capitalized. Next, okay, imagine loan is borrowed on 1/4. Construction started on 1/7. Construction did not complete, okay, till the year end. But what we did over here, amount that is spent is only 6 lakhs. How much did we spend? Only 6 lakhs we spent. So when we spent only 6 lakhs, the borrowing cost on 6 lakhs only will be capitalized. Borrowing cost on remaining 4 lakh, which you have not utilized for the construction, will be debited to P&L. So borrowing cost not recorded, not related to construction or manufacture of qualifying asset, can't be capitalized. Clear? Now imagine during construction started very late. We got the loan very early. Okay, construction started very late. Now what will you do? 9 months are there, that interest, 9 months are there, that interest, okay, you have to simply pay, no? So what they have done, 9 months will go and invest this money in bonds. Okay, temporarily they put the money into bonds. That bonds gave you interest. So that interest will be adjusted with the interest payment, and net only will be debited to P&L. Okay, and remaining after construction starting, whatever is there, it will be capitalized. Yes. So now if you go back to the concepts, see, commencement of capitalization. Commencement of capitalization means what? When will you start capitalizing? First, expenditure for acquisition, construction of qualifying asset is being incurred. That means construction expense is going on. First condition. Borrowing costs are being incurred. Interest is being paid. Construction should be going on. Borrowing costs should be incurred. And last, activities that are necessary for making the asset ready are in progress. That means interest, you should be paying interest, or interest is being incurred. Construction work is going on. Construction expense is being incurred. And activity is going on. The work didn't stop. If the work stops, then you can't capitalize. Now, suspension of capitalization. Suspension of capitalization means what? Temporary stop. When will you temporarily stop? Imagine, okay, over here, now there is work. Because of COVID lockdown, no? Because of COVID lockdown, work stopped. When work stopped, capitalization also should stop because activities are not going on. But imagine you utilize that time to do the interior work. You're like, okay, you can't do the outside work, but we'll do the inside work. So technical work is going on inside, then you will not stop the capitalization. But sometimes when you construct an asset, right? Imagine this thing is done, slab is done. Once the slab is done, from 40 days, 45 days, you can't do anything. You will just store water like this and leave. Every day you will put water. You would have seen, people will be spraying water to the wall and all. That is for curing. Okay, if you don't do curing, you can't go to the next stage. So here I am stopping my work for 40 days because it is part of the process. Okay. If it's qualifying asset, yes. If it is part of the process and I stop, then borrowing cost capitalization will not stop. Okay, if it is not part of the process and somebody files a case or something and you stop, then borrowing cost capitalization also will stop. Clear? So suspension of capitalization, okay, will be may be incurred during an extended period in which activities necessary to prepare the asset for its intended use or sale are interrupted. Such costs are cost of holding partially completed asset and do not qualify for capitalization. So what is this? It is cost of holding one half completed building. It is not cost of constructing the building. So if you stop the construction, borrowing cost capitalization also stops. Now, capitalization of borrowing cost is not normally suspended during a period when substantial technical and administrative work is being carried out. That means inside, government put lockdown, but inside you are doing all your technical work. Okay, you are designing the wall, you are designing the ceiling, you are putting the electrical wiring, all that you are doing, then fine. Capitalization of borrowing cost is also not suspended when temporary delay is a necessary part of the process of getting the asset ready for its intended use. Temporary delay is part of the process, okay, which cannot be avoided. Cessation of capitalization. Cessation of capitalization means what? Permanent stop. When will you permanently stop capitalizing? When the asset is ready. When asset is ready for its use, that time you will not capitalize. After that, what? See, asset construction is going on, asset construction is completed. In this time period, whatever interest is there, it will be capitalized. Before asset construction starting, debit to P&L. After construction completion, whatever interest you have, everything will be debited to P&L. Now, type of borrowing. You have two types of borrowing, specific borrowing and general borrowing. Specific borrowing means what? Money was borrowed for the purpose of construction only, so directly capitalized. General borrowing means what? Money was borrowed for business, you are using for many things, in that one of the item is qualifying asset. So now understand this example. Example, you have a loan of 10 lakhs borrowed at the rate of 10% for construction. It's a specific borrowing. Directly what will you do? 10 lakh into 10%, 1 lakh capitalized. Okay, other conditions should be fulfilled, date and all should be fulfilled. Now imagine you have 3 loans, 50, 20 and 10. General borrowing. You have borrowed it for multiple purposes. We don't know for what you have borrowed. Now, amount spent on qualifying asset is 60 lakhs. 50, 20 and 10 is basically 80 lakhs. But amount you have spent is 60 lakhs. Now you don't know from which loan you have spent. It's general borrowing. So what you will do first? 3 rates are there. You will take one weighted average interest rate. Weighted average rate, how will you do? Total interest from general borrowing divided by total general borrowing into 100. That time, now see, 50 lakh loan, 8% is the interest. 20 lakh loan, 9% is the interest. 10 lakh loan, 10% is the interest. Take all the interest and total it. Divided by the loan, you will get a new percentage of 8.5%. How much you spend? 60 lakhs, 60 lakhs into 8.5% capitalized. How much you spend? 20 lakhs, 20 lakh into 8.5% capitalized. Imagine you spent, the third example actually, you spend 90 lakhs. If you spend 90 lakhs, loan is how much? 80 lakh only. So that extra 10 lakh you have spent from your pocket, for that there is no interest. So 80 lakhs you will calculate and it will be capitalized. Therefore, amount of borrowing cost to be capitalized cannot exceed the borrowing cost actually incurred. What you have spent, that only you can capitalize. With that, we are done with the discussion of borrowing cost. Okay, this is your last accounting standard, AS22. Let's go in detail into AS22, understanding what is it actually. Now, AS22 is basically accounting for taxes on income. They are telling you how to calculate the taxes. Now, you have accounts, you have IT, Income Tax Act. Now, in taxation, the method of computing profit is different. Okay, in accounts, the method of computing profit is different. Now, this difference between accounts and taxation, okay, happens because of two situations. One is called as timing difference, one is called as permanent difference. Timing difference means what? Now see, for example, depreciation. In taxation, something else is done, account, something else is done. But both the places, depreciation is there. That means difference originates in one period. There will be difference that is created, but it will reverse in another period. It will reverse, ultimately it will be same. If you take 5 years time period, both are same. But it is allowed in different time periods. Permanent difference means what? Difference originates in one period and it's never reversed. Permanent difference and timing difference, both will try to understand. First example, see, depreciation in accounts, we follow SLM, WDV, production units method and all that. In taxation, only WDV. Only if it is power generation company and all, SLM is allowed. Otherwise, 99% only WDV. Can you see? Asset value is same, no 100 if it is 100. Here they follow different method, here they follow different method. Ultimately, asset 100 only will depreciate. So, both the places depreciation is there, but under different method. This is called as timing difference. Okay. Now, accounts, WDV only we follow, let's assume. But the rates are as per Companies Act. In taxation, WDV rates are as per Income Tax Act. So again, there will be a timing difference. Okay. Clear? Now, asset is purchased. 1 second. Yes. Asset is purchased for cash. Okay. More than 10,000 rupees you have paid in cash and you have purchased one asset. Now, in accounts, there is no such situation. No. You pay 1 crore in cash also. Who cares? You will still show that asset as asset only in the books. But in taxation, asset is not recorded because it is disallowed. If you pay more than 10,000 in cash, that asset cannot be shown as asset. So therefore, asset only not there in taxation. So no depreciation. Here asset is there, depreciation will be there. This is a permanent difference. Tax, they are not telling today I will not allow you, tomorrow I will allow you. They are telling you cannot take only, forget about it. So this is a permanent difference. Is it clear? Now, depreciation, okay, in taxation, you have this provision called as if you have purchased the asset for manufacture or production of any article or thing, then you will get additional depreciation. Okay, additional depreciation of 20% in the first year. Now, as per accounts, not allowed. As per taxation, allowed. Now, preliminary expenses. Preliminary expenses, as per accounts also, as per taxation also allowed. Okay. Now, see, now this time, this additional depreciation as per accounts, it is not allowed, but it's causing only timing difference. It's not permanent difference. Why? First year in taxation, you will have more depreciation. Accounts also depreciation will be there. Slowly. Ultimately, both will have same depreciation. Now, preliminary expense in taxation, they said that as per 35D, you can claim depreciation over a period of 5 years. 5 years you can claim it. So if I spend 100 rupees in accounts in 1 year only, that 100 rupees will be taken as expense. In taxation, that 100 rupees every year, 20 will be taken as expense. Can you see both the places it's allowed? This is called as timing difference. Clear? Donation to private trust. In taxation, if you give donation to private trust and all, it's not allowed. You should give it to recognized trusts only. So, taxation disallowed. Accounts it is allowed. Permanent difference. Okay. Donation to recognized organization. Accounts also allowed. Tax also allowed. No difference. Donation to recognized organization. More than 5,000 in cash. Okay. In section 80G, they have told that if you give donation in cash more than 5,000, taxation it's disallowed. But in accounts it is allowed. Permanent difference. Permanently there will be a difference. TDS. Okay. There is a section in PGBP where they tell you payment without deducting tax if you make to a resident, then 30% will be disallowed. When you pay the TDS next year, that time it will be allowed. In accounts, there is no such rule. Full amount will be allowed as expense. But in taxation, 70% will be allowed. 30% will be allowed in the next year. So that creates a timing difference. Clear? Now, section 43B of IT Act. Section 43B of IT Act tells you that if there are some expenses like taxes, cess and all that, interest on loan and all that. If you pay within the due date, I will allow you as expense. So any expense paid within due date, allowed in current year. Which due date? Due date for return filing. Due date for filing return of income. If you pay within due date, it is allowed. Else, allowed in the next year. Correct. Accounts, allowed in current year only. Taxation also allowed in current year only if it is paid within due date. Now, let's look at this timeline. See, 31st of March 2024. That means my year is what? 23-24. Now, expense not paid over here, but expense not paid also. In accounts, you will take it as expense only. Because accounts you follow accrual concept, you don't care only whether expense is paid or not. Now, if at all expense is paid here within the before the due date, even though it is paid here, taxation tells you in section 43B, if you pay within the due date, no problem, I will allow you to take it as expense over here itself. So both the places allowed, no difference. But in case you pay over here after due date, taxation will allow you, but they will allow you in the next year, that is 24-25. So this creates a timing difference. Clear? Now tax expense. AS22 tells us about tax expense. Tax expense means what? Current tax and deferred tax. What is current tax? Current tax means normal. Go back to your DT subject. There what tax you compute now as per IT provisions, that is current tax. That is what you're supposed to pay to government. Correct? Deferred tax is the tax effect. It is the tax effect on timing difference. It's the tax effect on timing difference. Now, we'll see this expense point of view. Now, imagine expense as per accounts is more, tax as per accounts is less. Now, we are talking only the things because of timing difference. Permanent difference, ignore. Permanent difference will not cause any deferred tax or something. It is ignored. Now, you focus on tax. Okay, expense as per tax is what? Lesser. Expense as per tax is less. That means income is more. If income is more, tax is more. If tax is more today, in future when the timing difference reverses, tax will be less. If it is going to be less in the future, good for you. Deferred tax asset. Now, what entry will you pass? Deferred tax asset account debited, because asset creation always asset has to be debited to P&L. To P&L. Creation. But when the timing difference reverses, that time P&L account debited to deferred tax asset. Clear? Now, expense. Now, next situation you see, expense as per taxation is more. That means income is less. If income is less, tax is less. Today, if you pay less tax, in future you will have to pay more tax. That means deferred tax liability. So, P&L account debited to deferred tax liability creation. Clear? In future, when it reverses, deferred tax liability debited to P&L. Income point of view, if you see income point of view, income as per taxation is more. If income as per taxation is more, that means income as per taxation is less. So tax is less. Income is less, you pay less tax. Today, if you pay less tax, in future you will have to pay more tax. That means deferred tax liability. Now, income as per income tax is more. If income is more, tax is more. Today, if you pay more tax, in future you will have to pay less tax, deferred tax asset. Now, this can be asked even in MCQ, this part. Now, see, Nirmalante is there over here. Okay, 31st of March 2024. 23-24 is the financial year. Correct? But Nirmalante will come somewhere in February and give the budget. The budget is given for the next year. Correct? She is giving budget for the 24-25 year. Now, again, next February when she comes for budget, she'll give it for 25-26. Correct? Now, current tax when you're calculating. Current tax means what? Tax as per Income Tax Act. Normal provisions. That time when you're calculating, understand one thing. Okay, the budget which is given over here, it is applicable to this year. So you will look at the rates announced in February 2024 for this financial year. But deferred tax means what? Future I have to pay more tax or future I have to pay less tax. So that time what will you do? The rates which are applicable over here, are for future. So when you're calculating deferred tax in this year, if you have the future rate, you will take that rate because that is relevant to future years. But when you're calculating current tax during the year, you will take this year's rate because it's applicable to this year. Clear? Done. That is AS22 for you briefly. Yes. Now we'll look into the previous year questions of all AS. Okay. First one in previous question paper, that is June 2025. Okay. 2A only they asked. Question number 2A. As per AS10, amount of depreciation charged to the statement of P&L depends on certain factors. List out those factors. Directly they have asked what is the factors that is involved in calculating the depreciation. Now see, as per AS10, the amount of depreciation to be charged to statement of P&L will depend upon the following factors. One, cost of the asset. Obviously, without the cost, you can't calculate depreciation. Estimated useful life of the asset. Okay, estimated residual value, scrap value, cost minus scrap value, and depreciation methodology. Obviously, whether you're following straight line method or WDV or production units method. Now, cost of the fixed asset is determined after adding all expenses incurred for bringing the asset to the usable condition. Remember, we discussed that all the assets all the expenses which are there, what you pay for travel, insurance, everything will be added to the asset. Okay, estimated useful life of the asset is estimated in terms of years. It can be effectively utilized for the business. Now, the actual life of the asset might be 50 years also. But if you are going to use it for the business for 5 years, then useful life will be 5 years only. Now, estimated sales value of the asset at the end of the useful life. What value you can sell it at the end of the useful life, that is only called as the scrap value, which will be given in the question. Now, method chosen, straight line method, WDV method, etc. affects the annual depreciation charge. It should reflect the pattern in which asset's future economic benefit is expected to be consumed. In what pattern asset is going to be used, in that pattern only depreciation is also calculated. If it is same, we follow straight line method. If it is in a decreasing order, we follow written down value method. Clear? That was the question which they asked for 2A. 2A for 7 marks. Now there is one more. Sub question is there over there. Now see over here. ABC purchased a motor vehicle costing 70 lakhs on 1st April. Major components of the motor vehicle consists of main body. The example which you took also was this only, right? Remember component accounting, I told you that car is there, tire 2 years depreciation, engine 5 years depreciation. Now see, that same question they have asked here. Body is costing 20 lakhs, seating arrangement and furnishing is costing 30 lakhs, and engine is costing 20 lakhs. Engine is costing 20 lakhs. Expected useful life of these component is main body 5 years, seating unit 6 years, and engine 10 years. Compute the depreciation for the year ending 31st March 2025. Now what will you do? Component wise depreciation you will do. Simple. Body is for how many years? 5 years. Seating unit how many years? 6 years. Engine how many years? 10 years. Now see this. Depreciation. Body 4 lakh. Okay, because 20 lakh divided by 5 years. 30 lakh divided by 6 years. Engine, this divided by 10 years. This will be your total depreciation. These two combined, they ask for 7 marks. Actually, it's easy. Scoring. Okay, after that, we don't have anything over here. After partnership, consignment, then hire purchase. Okay, 7. Now, what is the basic difference of Ind AS and Indian accounting standards? These kind of direct questions, right? Okay, you have to go to your material, just memorize it. Direct questions. What is the difference between accounting standards and Indian accounting standards? Now, 7A, right? See, major difference between accounting standards and Indian accounting standards. Okay, this if you memorize once, and if they ask like this direct questions, easily you can score marks. Accounting standards were based on international accounting standard, whereas India's are based on IFRS. There was earlier one thing called as international accounting standards. Accounting standards we created in India based on that. Now IFRS, international financial regulation system. Now based on regulatory standards, not system, regulatory standards. Based on that they created Ind AS. Clear? Accounting standards are rule based, whereas Ind AS are principle based. Okay. Accounting standards are drafted in technical language, whereas Ind AS are drafted in simple language. Obviously, first one is technical, then people could not understand. They want to make it simpler, no. So the next one which comes will be in simple language. Accounting standards follows historical cost, whereas Ind AS follows fair value on fixed assets. Accounting standards are not reliable to international investors because it's based over here, whereas Ind AS are reliable to international investors also. Because international investors are from different countries, they follow IFRS in those countries. So now when Ind AS and IFRS is almost same, it becomes easy for them. Now, accounting standards do not ensure uniformity in financial reporting, whereas Ind AS ensures uniformity in financial reporting. Accounting standards require multiple reporting for companies located in different countries, whereas such reporting is not required by Ind AS. Why? Because Ind AS IFRS based. Here I am following Ind AS, there I will follow IFRS, so it's almost same. Okay, see, such direct questions if they ask, you should study. There is one part of AS which I am not touching on, that is this part. List out the comparative provisions between AS23 and AS16. Like this, every standard. We studied what? AS1, we studied AS10, we studied AS12, AS16, AS22, AS11. All these standards, they can ask you what is the difference between AS and Ind AS. Any of these standards. And if you go to your study material, it's given in one box. After every standard, that comparative differences are there. 5 points. Just study, because if they ask, no, easy. See, comparative difference between AS23 and AS16. Just write the difference, copy paste from the material. I'm not discussing that over here. Now, next 8A also they asked AS. Explain in short the relevant disclosure of accounting policy as per AS1. Disclosure of accounting policies as per AS1. Remember yesterday we had studied. Everything will be disclosed in one place. Okay, whatever has material effect in current period should be recorded in current period. If it has effect on future period also, fact should be disclosed, amount should be disclosed, fundamental accounting assumptions, which we wrote also, all this direct question they have asked. Okay, next. Kannan Limited has provided the following information. Depreciation as per accounting records, depreciation as per taxation records. Okay, now focus. Which depreciation is more as per tax? Tax you have to focus. Tax depreciation is an expense. Expense is more. Income is less. Tax is less. Today you paid less tax. In future you will pay more tax. What is the difference over here? Timing difference is 3 lakhs and 50% is the rate of taxation. Huh?
Expense is more.
If expense is more, income will be less. Income is less, tax is less. If you pay less tax today, in future you will pay more tax. This becomes deferred tax liability, 1,50,000. Now, unamortized preliminary expense as per tax record. Unamortized preliminary expense, that means in tax, they did not allow you to take the expense. They will allow you in future years. So, if they have not allowed you today, that means expense is less today, income is more today. If income is more, tax is more. If tax is more, in future you will pay less tax. That means 40,000 into 50%, 20,000 will be your deferred tax asset. Now, 8B, no. Let's see what they have done. See, deferred tax liability, deferred tax asset, net 1,30,000. Next, after that, B. Profit and loss is a point statement, whereas balance sheet is a parent statement. Do you agree? Give reasons. Direct theory questions I'm not discussing, guys. Just go and write the theory for this. NPO it was. After that, do we have one more AS question? No, that's it. Huh? There 7 marks. 7, 20, 14, 21.
And 5, 26.
And 5 marks, 26 marks. That's what. You have to just go and study those direct questions which are there. Okay, and it's absolute scoring. So with that we are done with June. We'll go into December, guys. December 2024. We'll see from starting. Okay, and see, you're telling 26, right? It can be even more. We have not seen MCQs. We are seeing in 70.
So totally around 30.
MCQs if they ask 2 also, or no? Here starting they didn't ask AS in the previous paper. AS comes only at the end, 7th question. Now, in context of AS11, what do you mean by integral foreign operation? Remember foreign branch we discussed. State how the following items of integral foreign operation should be translated. Salary and wages in expense. Expense, what did we write? We wrote actual rate. Actual rate is not there. Then what will use? Average rate. Depreciation on furniture. Now all this, remember in one table we had discussed yesterday. 7A. Direct question again. Yeah, see, actual rate, average rate may also be applied. Depreciation on furniture should be translated using the exchange rate existing on the date of purchase of furniture. Actual rate, again actual rate is not their average rate. Machinery carried at fair value. It's carried at fair value. So what will you do? Existed on the date of valuation, end of the year, closing rate.
Date of settlement.
Yeah, date of settlement, end of the year, balance sheet date basically. Now integral foreign operation. It's a foreign operation which is carried as if it was the extension of, remember in a branch you have dependent branch. Integral foreign operation is like a dependent branch but it's in some other country. Okay, that should be it. Now after that what do you have? 7A. While clarifying the scope of AS22, explain the meaning of the following items. Accounting income. In AS22, accounting income means what? What is as per books of accounts? Taxable income means what? As per Income Tax Act. Tax expense means what? Tax expense is total of current tax and deferred tax. That they have asked for 3 marks. 111. See. Accounting income is net profit or loss for the period as reported in the P&L before deducting income tax expense or adding income tax savings. Taxable income is the amount of income or loss for a period determined in accordance with tax laws based upon which income tax payable is determined.
Tax expense is the aggregate. Aggregate means sum of current tax and deferred tax charged to or credited to the statement of P&L. Direct 3 marks. These kind of standard questions they are asking, guys. Standards are very vast, I agree, but the questions that they are asking is not vast. Okay, direct questions they are asking. Now 7b, as per AS12, explain the treatment in the following cases. Again 3 marks. A firm acquired a fixed asset for 850 lakhs on which government grant received was 40%. Either reduced from the asset or you show it as deferred government grant. Now 7b. Cost of the asset is 850 lakhs, grant is 340 lakhs. In the balance sheet, asset will be shown net of grant. This will be depreciated over the life of the asset. Theory question, they didn't ask journal entries. So, remember method 1 you can follow, reduce it from the asset itself. Next, capital subsidy received from central government for setting up a plant in notified backward region. 900, subsidy received is 250. Okay, 250 should be added to capital reserve. Why? It is in the nature of promoter's contribution. You are setting up in one backward area, so they are giving you money, 250 lakhs. Next, 225 lakhs received from local authority for providing medical facility to employees, expense grant. In case of revenue grant, it should be shown as profit and loss, shown in the profit and loss account. However, if the medical facilities are to be provided over a period of more than 1 year, it may be treated as deferred income and taken to P&L on systematic basis. They are telling you that if at all you are spending the money today only, put it to P&L. But if you are spending over a period of time, then don't put it to P&L today, put it as deferred government grant and transfer to P&L equal amount. Done. List out the comparative provisions between AS11 and AS21. Direct question again. Every attempt, one difference is there, guys, for 4 marks. One difference is there. If you study those 4-5 differences which are there, no. See, briefly explain the merits of Indias. What is the use of Indias? Okay, all these direct questions you have to study. Yes, done. It's December 2024. June 2024. We'll see at the starting if there is anything. I don't think so. All this we have solved already. So there is no accounting standards at the starting. Directly, 7th question. Here we go. Now, see here. Rukmini Limited had made rights issue of shares in 2022. In the offer document to its members, it has projected a surplus of 60 crores during the accounting year ended 31st March 2023. They said that we will give you 60 crores of profit. Okay. Draft results for 1 year prepared hitherto followed accounting policies and presented for perusal of board of directors showed a deficit of 15 crores. We expected 60 crores, but there is a deficit of 15 crores. Board in consultation with the managing director decided on the following. Now see, as a chief accountant of the company, you are asked to draft the notes to accounts. Nothing to do. You have to just write notes to accounts. You know what you have to do? Whatever they tell over here, in a beautiful language, you have to just write like an explanation. Value year-end inventory at works cost of 75 crores instead of followed method of valuation of inventory at prime cost. So instead of prime cost, they have shown it as works cost. So because of that, inventory has gone up. Because of that, profit will go up. Now see over here. During the year, inventory has been valued at factory cost against the practice of valuing it at prime cost, as was the practice till last year. This has been done to take cognizance of the more capital intensive method of production because of heavy capital expenditure during the year. As a result, year-end inventory has been valued at 75 crores in place of 45 crores. Thereby, the profit is increased by 30 crores. That's it. You're just explaining what is there in the question only. Okay, by writing notes. See, not to provide for after sale expenses during the warranty period. Till the last year, provision of 2% of the sale used to be made under the concept of matching cost against revenue, and actual expense used to be charged against the provision. The board now decided to account for the expenses as and when actually incurred. Sales during the year is 900 crores. Earlier they should create provision. Now they are not going to create provision. Because they are not going to create provision, if provision is going to be reversed, it's an income for us. Profit will increase. See over here. So far, the company has been providing 2% sales meeting after selling expenditure during the warranty period, the improved method of production and probability. This they didn't tell. Just bakwas. You are going to write. That's all. Okay. Why you are not creating provision? Because your product is better. Okay. Occurring in the product has been reduced considerably. Hence, the company has decided not to make provision for such expense, but to account for the same as and when expenses are incurred. Due to this change, the profit for the year is increased by rupees 18 crores, 900 into 2%, 18 crores. Then we would have a CAD in the old policy. So basically, whatever is given in the question, right? In a simple way, you're explaining. Next, see, provide for permanent fall in the value of investment. Investment has gone down. This you can't avoid. Now you have to make a provision. If you make a provision, what will happen? It will create a loss. So see here, company has decided to provide 15 crores of permanent fall in the value of investment, which has taken place over a period of 5 years. And provision so made reduce the profit disclosure in the accounts by 15 crores. Are you getting this? Next. What are the objectives of AS10 as per AS10, which included in the bearer plan, which are included in which bearer plant and which are not? That's a direct question from the study material, copy paste. Now, state the provisions of accounting standard 12 relating to the presentation of government grants in financial statement. Again, direct question. AS12, you're going to explain. B. Okay, this is chapter 1, guys. This is about provision for doubtful debt and all. We have discussed that in detail. With that, we are done with June also. We have one more PYP to discuss. That is December 23. We'll see if they asked anything at the starting. At the starting, there was BRS and other things, which we already discussed. We go straight into, I think, 7 only, right?
Yes, sir.
Yes. ABC setting up a new factory outside the city limits in order to facilitate the construction of the refinery and its operation. ABC Limited is required to incur expenditure on the construction or development of railway siding, road, bridge. Though ABC Limited incurs or contributes to the expenditure on the construction and development, it will not have ownership rights of these items and they are available for use to other entities and public at large. Whether ABC Limited can capitalize expenditure incurred on these items of property, plant and equipment? If yes, how these items should be depreciated? They just asked you whether we should capitalize or not. In fact, it's not even AS10, no, it's capital and revenue expenditure, which is there at the starting. See, it is probable that future economic benefit will flow to the entity. Cost of the item can be measured reliably. Remember the 2 points when we can take PPE as PPE recognition criteria. Okay. Then this much big answer. Obviously, anybody cannot write in the exam. Okay. You are going to give a conclusion based on the limited provisions that we can write. So always write these kind of answers in 3 parts. First part, second part, third part. First part, what will you write? What is there in the AS, you write that. Second part, you will write the facts of the case. In the question what they have given, that only in simple words. Now, then you are going to give the conclusion. Now, let's go to the conclusion. Can you see item should be allocated and capitalized as a part of item of property, plant and equipment. Obviously, it will be capitalized. Now, what did they do? They constructed fixed asset over there. Okay, railway sidings and all they have constructed. Railway line, if you construct, isn't it fixed asset and it will give you benefit for more than 12 months? Okay. Now, ABC Limited has received the following government grants. Again, government grant related questions. See, 20 lakh received for immediate startup of business without any condition. Is it in the nature of promoter's contribution? Yes.
Oh, for this day, okay, sorry.
See, recognize the grants in the following manner. Where is it? They just whatever is in study material as theory, right? Copy paste it into the suggested answers. That's it. Such grant may be confined to individual enterprise. No. Okay. Therefore, 20 lakhs has been received for immediate startup business. That should be recognized in the P&L. Okay. They are not taking it as promoter's contribution. It's in the P&L. They are like 20 lakhs taken, start the business, right? When you start the business, a lot of expenses will be there, which will go to P&L. So they are telling this also you put it to P&L itself. Now, 50 lakhs received for research and development of drugs required for treatment of cardiovascular diseases with the following condition. Drugs should be available to the public at 20% cheaper than the current market price and drugs should be in accordance with the quality prescribed by the World Health Organization. Now, see over here. Second one. See, 50 lakhs should be recognized in P&L over a systematic basis. So, when you are manufacturing drugs, you will use it for manufacturing the drugs. You will put it to the P&L as and when you manufacture. This is like an expense grant which is given. But conditions are there. If you don't fulfill the conditions, what will happen? It will become refund of government grant. Now, next. 2 acres of land received for setup of plant. See. Non-monetary grants given free of cost are recorded at nominal value. Remember I told you 1, 10, 100. You got for free. Accordingly, land should be recognized at a nominal value in the balance sheet. Next. 2 lakh received for purchase of machinery, 10 lakhs. Useful life is 5 years. Depreciation over this machinery is 5 years. For how many years? A straight line basis. So what will you do? 2 lakh which you received. You will just reduce it from the cost of the asset itself. Can you see? It became 8 lakh divided by 5, 1.6. Machinery will be recognized in the books at 10 lakhs minus 2 lakhs is equal to 8 lakhs and depreciation will be charged as follows. The method 1 which we used for government grant which we received for depreciable asset. How should ABC Limited recognize? Then after that it's partnership and chapter 1. One more AS. Explain the methods criteria for selection and application of accounting policy. Remember yesterday we discussed some points. Prudence, substance over form and materiality. Prudence, substance over form and materiality. Where is it? See, prudence, substance over form, materiality. Direct questions they are asking. These are the questions. At least 20 marks minimum it is there from accounting standards. Now next we have to go and see the model test papers of accounting standards. Yes, let's go into the model test papers of accounting standards now. First we start with December 2023. At the starting there is nothing. They are following a pattern. Till 5 it is partnership. Then we have seen its branch accounts and insurance claim and all that. Starts from 7. Okay, 7. Pushkar Limited obtained a loan from RBC Bank for 65 lakhs to be utilized as under purchase of equipment 19 lakh 50,000, purchase of factory shed 26 lakhs, advance. Now purchase of equipment is not a qualifying asset. Factory shed is a qualifying asset. Advance for delivery of vehicle, that is also not a qualifying asset. Working capital is also not a qualifying asset. In March 2023, installation of the machinery was completed and also construction of factory shed was completed and the machinery installed. However, the truck was not delivered within the time. Total interest charged is 11.7 lakhs. Discuss how the interest should be calculated. Now see 11.7, no. 11.7 is the interest. In this, check how much is the qualifying asset. Qualifying asset is only 26. So 26 divided by, what is the total? 26 lakhs plus 19.5 plus 6.5 plus 13. Total is 65 lakhs. So, yeah, 26 divided by 65 into 11.7. 4.68 will be the interest that has to be capitalized. Interest is capitalized. Balance whatever interest is there, it will go to P&L. You can see their solutions here. 4,68,000 capitalized because only one is qualifying asset. Others are all non-qualifying assets. So all the balance interest will go to P&L. Clear? Only on qualifying asset what they spend, that amount should be capitalized. Remaining everything should be transferred to P&L. Now you have one more here is, okay, Big Box, a startup purchased machinery on 1st April 2019. Machinery worth rupees 44,85,000 in relation to which it received 7,35,000 as grant from Government of India. Now you are required to examine how amount of depreciation that is to be charged in the statement of P&L for 21-22 and 22-23. 2 years they are asking, straight line method. Now the company decided to treat this grant as a capital receipt. Now see over here what they have done. Cost of the machine is 4485. Directly we are subtracting. We have two methods now for government grant. One, we treat it as, reduce it from asset. Okay, other one we show directly in the balance sheet as, in the P&L as deferred government grant, every year will transfer. Now directly they have subtracted this. Okay, 4485 minus 735. So what is the balance now? 3750. Now it is estimated that the realizable value of the machinery at the end of its useful life will be 15,36,000. That is the scrap value. Okay. During financial year 21-22, this happened in what? 1920. This happened in 1920. 21-22, the grant becomes refundable. That means you have to give the money back and company failed to comply with the necessary terms and conditions. So now 1920 is done. 2021 is done. 21-22 we are going to refund. So see over here, 4 years depreciation, right?
Yes, sir.
So remember the scrap value. They said that 15,36,000. So in rupees in thousands they have taken. So 3750 minus 1536 divided by 4 years. For per year you will get depreciation of 5,53,500. 553.5. 2 years have gone normally. 1920 and 2021 has gone normally. No problem at all. Okay, so now what happens? Yeah, so into 2 it's gone normally. So 3750 minus this is the WDV now. Now they are telling it is going to be refunded. it has to be refunded. Refunded means when you got the grant, you have reduced it from the asset value. Now when you are refunding it, you will add it back to the asset value. When you add this 735 which you got, you are adding it back. So 1107, okay, revised book value, sorry, 2643 was your book value, 2643 plus 735. So the new value is 3378 divided by 2 years, because you have 2 years depreciation. That is going to be 3378 minus scrap value 1536 divided by 2 years, 921 per year. Again, I'm running through this. Listen. Okay, this was the cost of the machine. We got a government grant of 735 reduced. This is the reduced value of the asset. That reduced value of the asset minus scrap value divided by 4 years, you'll get per year depreciation. 2 years have gone normally. So now you get, after removing depreciation for 2 years, you get 2643. That is the value of the asset after 2 years. Now they are telling you have to refund the grant. So you add 735 to that. Add 735. Now you got the new value of the asset. New value of the asset divided minus scrap value divided by useful life. How much useful life you have? You only 2 years. Out of 4 years, 2 years done. So this will be the value. 921. Clear? Eighth question. Again, there is AS. Infer with reason how the following will be classified as timing difference and permanent difference, and also state whether they would result in deferred tax asset or liability. Unabsorbed depreciation. Okay. See, unabsorbed depreciation is today it's not allowed, but in future it's allowed. Timing difference. It will lead to deferred tax asset. Why it will lead to deferred tax asset? In future they will allow you depreciation. Today they are not allowing you depreciation. So today you will pay more tax. In future you will pay less tax. Deferred tax asset. Okay. Income tax penalty. Income tax penalty is permanent difference, because in income in DT they don't allow you penalty as expense. Imagine you pay late and that only is allowed as expense. So that is neither a deferred tax asset or deferred tax liability, because it is permanent difference. Now interest on loan taken from scheduled bank, accounted in the books but not paid till the date of return filing. Remember section 43B, I told you you should pay before the due date. You didn't pay only, so it becomes a permanent difference. Not paid at all, permanent difference. They didn't pay. If they would pay at least next year, they would get in next year. It would become timing difference. They didn't pay only. So that is one more question that they have asked. If it is before, after due date, it's a timing difference. That means this year it's not allowed, next year it is allowed. Yes, that is chapter 1. Yes, with that we are done with that one. We'll go into the next June 2024. From 7th question we'll start, because till then it's all other things. See this. Startup purchased a machinery worth rupees 44,85,000, in relation to which it received 7,35,000. Same question just now we saw. Same question just now we had seen of AS12. Repeat. Next. During the financial year 22-23, Zeds Limited, an e-commerce firm, entered into a foreign currency transaction relating to fees for technical service paid to Lucas Limited, an Atlanta-based organization. This is AS11. Now, you are required to ascertain the amount at which the transaction would get recognized in the books. Transaction should get recognized at what? On the date of transaction, what is there? That value. Transaction was for 24,000, which was entered into on 7/12. On 7/12, can you see what is the rate? 78.8. So you have to record it that at that value only. See over here. 7B. Yes. Where is it? Wait, 7B should be.
So they messed up. Same answer they have given it again.
Yeah, 7B. They have given the AS16 answer of previous time. Okay, I will show it over here. So $24,000 into 78.8. 18,91,200. That will be the amount at which their transaction will be recognized. Okay, the payment for the same was made on 25. Now calculate the amount of foreign exchange gain or loss. Now, fees for technical services. Now, e-commerce was entered into foreign currency transaction relating to fees for technical services paid to Lucas Limited. That means you have to pay. Now, when you have to pay, if the rate goes up, it is very bad. See, on 25, on 81.5 it became. So, $24,000 into 81.5. Wait. Minus 78.8. 81.5 minus 78.8 into 24,000. 64,800 is the loss. Exchange difference. They asked exchange gain or exchange loss to be recorded in the financial statement. This will be the loss. Clear? Only that they have asked. Then we'll see 8th one. AS. Write a note on scope of AS11, effects of changes in foreign exchange rate. Okay. Direct theory question from the material. You are going to write that. Then NPO and partnership. We don't have anything else. That's it. Now, we'll go to December 24, set 2. 7. They don't have any other questions, I think. See here, Big Box Limited, a startup purchased a machine worth rupees 44,85,000, which received 7,35,000 grant. Can you see calculate depreciation for 2 years? Same question. Same question they have thrown again.
The difference or the difference.
A depreciation calculation. But best part is what you know. They asked one small question here. Make a comparative study between AS12 and India AS20. Every time in the exam they are asking one question. Comparative study. 5, 6 are there. Do that comparative study, by heart it, and go and write it in the exam. Yes, 7B is same thing, guys. Depreciation calculation. See, 921 we had received. Now, 8. Parashuram Limited, which commenced its operations in 1920, provides the following details. Now, you can see over here, profit before tax, timing difference, permanent difference, corporate tax rate, remarks, reversible in 2022-23, all that they have given. Now, analyze and evaluate the amount of current tax for the 4 financial years. Current tax for 4 financial years, they said. Now, PBT is 28 lakhs. Now, let's see how they have calculated it. See, PBT 28 lakhs. Okay, timing difference. Now, timing difference plus 315. Now, when you're calculating current tax, it doesn't matter, right? When you're calculating current tax, does it matter for you what is books of accounts, what is not books of accounts? Timing difference, permanent difference. Everything is as per taxation. Add the two, you will get the value. Taxable income. On that you apply 40%. Done. 13.86. That is current tax. They asked only current tax. They have not asked deferred tax. Now, see the next one. 31,50,000 plus timing difference, permanent difference. Both add it. When you add, you will get this number. 38% is the tax rate. Apply the tax rate of the particular year. See the next year. 35. But here be careful. It is minus 70,000 plus 315. So minus 70 plus 315 and apply the tax rate which is applicable on that in that particular year, that is 35%. And here nil and 420, add that, you will get the value. On that 30% you will get the current tax. Current tax means what? Tax that is calculated as per income tax. So there, take the PBT, timing difference you add, permanent difference you add, that time, or add or minus, that time you will get the taxable income. From taxable income, you remove all the differences. That time you will get your PBT, right, as per books. So books and taxation has only 2 differences, timing or permanent. When you add those differences, you will get the taxable income. On taxable income, apply the tax rate. That is your current tax. Clear? Then you have B is something else. So we are done with set 2. So now we'll go to set 1. December 2024. There we have 7A. Describe the disclosure requirement under AS11. Okay. Just read that. It's a theoretical question. Okay. Same thing they had asked in one of the earlier questions. And see here, Pushkar Limited obtained a loan from RBC Bank, 65 lakhs. Okay. Same question. I think 2 times they repeated it, right? Yes. Now see over here, what are the factors governing the selection of applicable accounting policies? Remember, applicable accounting policy selection, prudence, substance over form, and materiality. 3 things. See, materiality, substance over form, and prudence. And this question came also in the exam. Yes. Now 4. That is, this one is June 2025, set 2. 7A. MML Limited obtained a loan for 200 lakhs. It is like that Pushkar question, but not the same thing. To be utilized as under construction of a shed. This is a qualifying asset. Purchase of a machinery, not a qualifying asset. Working capital, not a qualifying asset. Advance for purchase of truck, not a qualifying asset. In March, same thing, 36 lakhs. So now what will you do? 36 lakhs into how much you spent for qualifying asset? 80. 80 divided by 200. 14.4, right? 14.4 will be capitalized. Can you see? 14.4 lakhs capitalized. That means remaining interest, whatever is there, it will be debited to P&L. 36 minus 14.4, whatever interest is there, it will go to P&L. Clear? Yes. Done. 7B. Calculate, evaluate the loss or gain for the financial year 21-22 and 22-23. Goods purchased. Okay. Okay, goods purchased $10,000. That time the rate was 76.6. Okay. So if it is 76.6, it will be recorded at that transaction rate only. Now, this is purchased on 24/2/2022. Exchange rate on 31st of March 2022. Rate has gone up. When you purchase, you have to pay money. If rate has gone up, what happens? 77 minus 76.6 into $10,000. 4,000 rupees will be the exchange difference. Can you see 4,000 should be debited to P&L? Can you see 4,000 should be debited to P&L here? Rate went up, loss will be debited to P&L. After that, again rate went up. So 0.5 will be the difference now into 10,000. That means $5,000. I mean 5,000 rupees will be debited to P&L. Are you following this? In AS11 we discussed that there are three things. One is initial recognition. On that day what rate is there, record it. Then if at all there are payables or receivables, on balance sheet date, increase the rate or decrease the rate if it happens. Then on settlement date, if a higher rate or a lower rate is there, take it. So here the rate went from 76.6 to 77 and from 77 to 77.5. So here when it went 40 paise more, that is a loss. Here when it went again 50 paise more, that is a loss for us. Clear? That was it. And again they have asked one question here. Evaluate the amount of borrowing cost to be capitalized. Expenditure incurred till 31st of March 2023, 5 lakhs. Interest cost capitalized for the financial year 22-23, 26,000. Okay, they have capitalized. Amount borrowed till 31st of March 2022-23 is 2 lakhs. And asset transferred to construction during 2023-24, 1 lakh. Cash payment during 23-24, 75,000. Progress payment received, 3,70,000. Net borrowing 23-24, 13%, 2 lakhs. Now, understand this. Total borrowing cost is 4 lakh is the borrowing into 13 by 100, 52,000. How they got 4 lakhs? 2 lakhs plus 2 lakhs. One they had borrowed last year, another they borrowed this year. So, total 4 lakhs, 52,000. Now, expenditure included previously capitalized borrowing cost. 5 lakh plus 26,000. Last year already it had become 5 lakh 26,000. Again, how much they spent this year? Cash payment. See here, cash payment they spent is 75,000. Again, one more asset also. So total amount that they have spent is 7 lakh 1,000. But out of that 7 lakh 1,000, they got money. Progress payment they have received. So 370. So how much is the net amount? 3 lakh 31,000. So understand this, money borrowed included, including previously capitalized amount is 4 lakh 26,000. Last time we had capitalized 26,000 of interest. So total borrowing is 4 lakh 26,000. Now what happened? Out of that, how much we spent? We spent only 3 lakh 31,000. So 3 lakh 31 we spent out of the 426 into the interest. Only 40,404 will be capitalized. How much you spent out of the borrowing into interest? When you do it, that time you will get the borrowing cost to be capitalized. Clear? Then we have NPO done. That's it. Now we'll see this one as well. June 2025 set 1. 7A. Now no, this is not PP. Set 1, 7A. It's AS11. Yeah. Set 2 done, no. This is not December. This is June. June 25 set 1. June 25 set 1 we didn't finish. Just now we finished set 2 of June 25. During the financial year, Zeds Limited, an e-commerce firm, entered into a foreign currency transaction relating to fees for technical service to be paid to Lucas and Atlanta-based company. Same question, values are different. We had seen this some time back, right? Yes. I think some 3-4 model test papers ago we had seen this. Yes, you can take that as practice, guys. We'll see about this one. 7B. Z Limited has set up its business in designated backward area which entitled to receive as per public scheme announced by the Government of India subsidy of 25% of the cost of investment. If you have set up in backward area, it is like a promoter's contribution. Having fulfilled the conditions laid down under the scheme, the company on its investment of 100 lakhs in capital assets during the accounting year received a subsidy of 25 lakhs. In January, from Government of India, the accountant of the company would like to record the receipt as a item of revenue and reduce the loss of P&L. Can you do that? No, you cannot do that. It is received as a promoter's contribution. It should go to capital. It should go to balance sheet. See, government grants related to depreciable fixed assets should be treated as deferred income, which should be recognized in P&L on a systematic and rational basis. Okay, such grant should be allocated to income. The company has received 25 lakhs as an investment in capital asset which are depreciable in nature. In view of provisions of AS12, the subsidy amount of 25 lakhs received should not be credited to P&L. The subsidy should be recognized and credited to P&L in the proportion of depreciation. So basically it should be kept aside. It will be taken as deferred government grant, or you can also transfer it to capital reserve, telling that it is for promoter's contribution. It looks like it is promoter's contribution, but they gave it for what? Buying assets. Now first day only we can't put it to P&L. Little by little we can transfer it to P&L. This is also a nice question which they can ask in the exam. 8A. Pushkar is back. How many times they have asked this Pushkar? Same values also. See, 468, 702 we were getting that time also. Yes, done. Now we have the model test paper which is applicable to your exam, for which there is no solution. We have to solve that. Now 7A. J Limited, a chemical producing company. 1 second. Yeah. J Limited, a chemical producing company, changed a semi-automatic component in an existing machine with a fully automatic component incurring 85,000. This new component would result in an increasing the output by 150%. Okay, it's going to give you extra benefit. The component changing exercise required the company to dismantle a part of the machine and also re-erect the same, for which the company incurred 38,000. Analyze how these costs should be treated as per AS11. AS10. So now let me give you the answer. Model test paper MTP December 25 set 2. Question number 7A. Okay. How much they have spent on the component? 85,000 they have spent on the component. Amount spent on component is 85,000. Increase is 150%, no problem. Okay, then they have spent again 38,000 for re-erecting. Okay, re-erecting charges 38,000. So 85,000 plus 38,000, you get 1,23,000. This is the amount to be capitalized. This is the amount to be capitalized. Why it is to be capitalized? As it gives you future economic benefit. Can you see? If it was 100%, right, we would not take it because it's not giving me any extra benefit. Now earlier I was getting 100%, now I'm getting 150%. So it is giving you future economic benefit. So it has to be capitalized as per AS10. Also you can write the points of AS10 that for anything to be capitalized or to be recognized as a PPE, cost should be measured reliably and there should be future economic benefit. Next we'll see 7B. SDF Limited obtained a loan of 100 lakhs. It was utilized as under construction of shed, qualifying asset, purchase of machinery, not a qualifying asset, working capital, not a qualifying asset, advance paid for purchase of truck, not a qualifying asset. These kind of questions are repeating. That means they can put it in the exam. Easy it is, scoring. Okay. Now machinery was installed, all that okay, 36 lakhs. So 36 lakhs into how much they spent for the machinery? Construction of shed 100. 100 divided by 180, 220, 240. 36 into 100 divided by 240. 15 will be capitalized. 15 will be capitalized. 36 minus 15 which is there, that is 21, will be debited to P&L. Will be debited to P&L. (8A). Lokesh Limited has set up its business in a designated backward area which entitles the company to receive from Government of India subsidy of 20% on the cost of investment for which no repayment was ordinarily expected. Moreover, there was no condition that the company should purchase any specific asset for this subsidy. Having fulfilled all the conditions under the scheme, company on its investment of 100 crores in capital asset received 20 crores from Government of India. Okay, the company wants to treat this receipt as revenue and thereby reduce the losses of P&L. Just now we saw this. You cannot reduce it from the losses from the P&L. What you should do, you should treat it as deferred income, or you should transfer it to capital reserve, and periodically, little by little, you can transfer it to P&L. Like I think the previous model test paper or before that, we saw this exact question. After that, it's partnership, guys. Done. We have one more model test paper to see, the AS7A. On December 1st, Arjun company purchased 2 lakh worth of land for a factory site. Arjun raised the old building on the factory property and sold the material it salvaged from the demolition. Arjun incurred additional cost and realized salvage proceeds during the year. Demolition of old building, 25,000. What will you do? Capitalize. If you demolish the old building only, you can construct the new building. Legal fees for purchase contract and recording ownership, that also capitalize. Title guarantee insurance, that also capitalize. Proceeds from sale of salvage material, that you don't capitalize, that you minus. So 25,000 plus 5,000 plus 6,000 minus 33,000. This will be capitalized and this will be written as asset or PPE. See, in its December 31st balance sheet, what should be PP Limited should align a balance in the land account. 33,000 will be capitalized. Yes, land account will be same, but this and all will be taken as building. So it will become land and building in your balance sheet. Now, what?
Some is not done.
No, this is next one.
Asking the first.
Oh, first one. This is the amount to be capitalized. You have to write the points of AS10. Now what happens is they purchase land for 2 lakhs. No, 2 lakh is land. Okay. 33,000 will be the value of the building. So if you ask land and building, it will be 2,33,000. But they told what is the balance in the land account. Land account will be 2 lakh only. Where?
Come, you go.
This cannot have answers, no. It's there. Guys, this is 32,000. 25 plus 5, 30, 30 plus 6, 36, 36 minus 4, 32,000. So that's what land and building will become 2,32,000. Clear? Now, goods purchased 10,000, 76.6, then it goes to 77, then it goes to 77.5. Just now we had the same question. Guys, at any cost, don't skip these questions. The questions which are repeating so many times, right? If they don't give same number also in the exam, 100% they can just change the numbers. So now you know what pattern of questions they are asking. Okay, AS, they also looks like they don't have too many questions on AS. So they'll just repeat those questions only. Yes, that is it with AS. Yes, let's go into leases. Lease. Lease is a long-term rental contract. Lease is long-term rental contract. Okay, you have two types of lease. Finance lease and operating lease. Any of the questions can come directly. It's a very small chapter in your material. It can come direct question also. So, finance lease, operating lease. Okay, in that, first of all, you have two parties, lessor and lessee. Lessor means who gave the asset on lease. Lessee means who took the asset on lease. So, finance lease means you're not the owner, but substantial risk and reward of ownership. It's like you are not the owner, but full benefit of ownership you are only enjoying. That is called as finance lease. See, these words you have to write. When substantial risk and reward of ownership is transferred to lessee, that is finance lease. Anything other than finance lease is operating lease. And for finance lease, there are some indicators. First indicator is at the end of the lease term, lessee becomes owner. So end of the lease term, you use the asset for 5 years. After 5 years, you only become the owner. Second, at the end of lease term, lessee has option to buy. That means they have the option to purchase the asset. Third one, major portion of economic life is covered by lease.
So if let's say major, when they tell major portion, it's majority. Imagine the useful life is 5 years. If at all it's given on lease for 2 years, then no problem. But if it's given for 3 years, majority of the term is covered by lease only, no? Yes. Present value of minimum lease payment is almost equal to fair value. Asset is of specialized nature. That means what? Present value of minimum lease payment is almost equal to fair value means what? Today the asset is costing 10 lakhs. I am paying lease rent 1, 2, 3, 4 years. When I'm paying 1, 2, 3, 4 years, if I take the present value of that, okay, you know how to calculate present value. Take the present value and calculate the present value. That time, imagine it came to 9,80,000. That means almost it's like you're buying the asset only. Imagine you're staying in a PG. Okay, let's say you're staying in a PG. Or you take a 1 BHK flat. 1 BHK flat, let's say 10,000 is the rent. 10,000 rent. If you pay for 4 years, let's say 4 years you want to stay in that house only. Into 12 becomes 1,20,000. Into 4 years if you do, 4,80,000. 4,80,000, let's say you have to calculate present value of that. Today's value of that 4,80,000 when you see, let's say you got 4 lakhs. Is this 4 lakh equal to the cost of the asset today? 1 BHK will you get for 4 lakh? It might be some 20 lakhs or something. So this is operating lease. But imagine when I calculated this value, I got 19 lakhs and the cost of the asset is 20 lakhs. That means almost it's like you're buying the asset only. This is called as finance lease. Last indicator is asset is of specialized nature. That means asset has time of 10 years, but you took it on lease for 2 years. But that asset only you can use it. Customized asset they have given you. Others can't use that asset. This becomes asset is of specialized nature. Clear? Finance lease. You have lessor, you have lessee. Okay. What will lessee do? Lessee will make the payment. Lease rent. Plus what he will give? Guaranteed residual value. What is this guaranteed residual value? See over here. Srihari is there and Vishalakshi is there. Srihari is there and Vishalakshi is there. And imagine lease is for 5 years. Okay. Now imagine Vishalakshi. Okay. Let's say Vishalakshi has given the asset on lease to Srihari. Now Srihari tells, boss, after 5 years is over. Okay. I want one building. One building I want. That means lessee has promised guaranteed residual value by lessee. Okay. There is one guy called Santosh. He is not lessor also. He is not lessee also. He is like after 3 years, after your lease term, 5 years is over, old building will be there. No, I will take it. So he has promised to take one building. So this is guaranteed residual value by others, outsider. Okay. This third building is there. No, nobody has guaranteed it. Nobody has guaranteed. But what will happen is somebody will take it. That is unguaranteed residual value. That is unguaranteed residual value. Clear? So if you see from lessee's point of view, lessee doesn't know about somebody else's guarantee and unguaranteed residual value. Lessee knows that I have promised to take something. So lease rent plus guaranteed residual value by lessee. Clear? This is the minimum lease payment for lessee. But for lessor, you know what is the minimum lease payment? Lease rent he will get plus guaranteed residual value he will get from lessee. Then guaranteed residual value by others also you'll get. Now you have to understand this because to do the accounting you need these terminologies. Now understand, lessee cash outflow, lessor cash inflow, lessee what and all lessee has to pay, lease rent lessee has to pay, lease rent, correct? And the guaranteed residual value which lessee told will pay, that also lessee has to pay. Next, lessor, lease rent lessor has to get, guaranteed residual value lessor has to get, guaranteed residual value by others also lessor has to get. This is the minimum lease payment. Clear? Now accounting in the books of lessee, in the books of lessor. In the books of lessee what happens? Lessee gets the asset. Lessee is getting the asset. So asset account debited. To lease account. Didn't make the payment. No. Payment will be made in future. So lease account credited. Liability is created. Lessor's books you see. Lessee account debited. Why lessee account debited? Because lessee has to give money. Receivable to asset account. Asset went. Receivable created. Now this is always recorded at fair value of the asset. Fair value of the asset means what? Today's market value or present value of minimum lease payment from lessee's point of view. Whichever is less, no, in this you take it. So take the fair value, calculate minimum lease payment. Minimum lease payment you will calculate like this. Okay, and you will take present value of that. Lessor what they will do? They will record it at present value of gross investment. Now you will be like, sir, what is gross investment? Gross investment is nothing but minimum lease payment from lessor's point of view, what we calculated, plus lessor will get other than this one extra thing,
unguaranteed residual value. Take present value of that. That is the value at which you will record. Clear? Now, at the end of each year, what will happen? Now, when you're paying late, it's like paying installment. In this, interest is also included. So, interest for lessee, it is expense. So, interest account debited to lease payable. For lesser, it is income. Lessee account debited to interest. Clear? Now, other side, if you see, lease account debited to bank, and here bank account debited to lease. Here you are making payment. Here you are getting receipt. Clear? Then depreciation. Who is using the asset? Lessee is using the asset. So depreciation account debited to asset account. Lesser is not using the asset. That's why you can see that there is no depreciation entry over here. And P&L account debited. Transfer, depreciation, interest, both are expenses. It's transferred to P&L. And here interest is income for this guy. So it is transferred to P&L. Clear? Now, sale and leaseback. Sale and leaseback. What happens over here? Sale and leaseback means you sell the asset and you take that same asset back on lease. Okay. Why you do that? See, imagine you are having some loss and all. Oh, you have a building where your factory is there. You are having loss. Now you don't know what to do. You will sell the building. But if you sell the building and recover your loss, then where will you do the business? You will be on the road. No. So you sell the building with the condition that I will give you the building. You give me money. Then you have to give me the same building back on lease. I'll pay lease rent. So now for you what happened? It became like an investment. You will get lease rent. So here they told profit or loss on sale. How to record the profit or loss on sale if this happens, that you have to understand. If the lease back is finance lease. If the lease back is finance lease, what you will do? Amortize over the lease term. Amortize over lease term. See example, WDV is 50. Sale value is 80. That means you made 30 rupees profit. And lease term, let's assume it's 3 years. So what you will do? 30 divided by 3. 10 per year you will credit to P&L. 10 per year you will credit to P&L. But if it is operating lease, you have to be little careful. If sale value is equal to fair value, that means see market value is here. You sold at market value only. Nothing abnormal about it. Okay. Recognize now. Recognize now. Sale value 80, WDV 50. Fair value is 80. That means you sold at fair value only. Okay. Profit 30. Credit to P&L. If sale value is less than fair value, market value is there. Negotiation is normal when you're selling. You sold at little less than fair value. That is also fine. That is also normal. Recognize now. Imagine sale value is 80. Market value is 90. You sold at lesser than market value. Okay. That time WDV is 50. Can you see the 30 rupees profit credited to P&L? But the difference happens over here. If sale value is greater than fair value, is it possible that I have a land of 50 and somebody came and asked, I told, no, I am giving 6, I can sell only at 60. And that fellow is like, okay, I'll take it at 60. It's not possible, right? If my land is selling at a higher value than market, what he will do? He will go to the nearby land and he will take that because he's selling at market price. So they said, if sale value is greater than fair value, now it's a deal. I told boss, I need more money. You buy it at higher value. When I'm paying lease rent, no, I'll give you higher lease rent. That's a deal. So they said in leases, sale value greater than fair value. If sale value is greater than fair value, the difference between sale value and fair value, this is an abnormal profit. Market value 50, you sold at 70. This is an abnormal profit. This profit happened just because of lease. So what they said, amortize. So amortize. Fair value minus WDV. That what you do? Recognize now. See, fair value is 80. I sold for 90. WDV is 50. So this extra 10 profit which I made, no, amortize. See, 90 minus 80, amortize. 3.33 per year, credit to P&L. This normal profit what you made, no, 80 minus 50. This you credit to P&L today only. So your asset value is 50. Okay. Market value is 80. You sold for 90. So this extra profit which you got, that you amortize. This normal profit which you got anyways, that you transfer it to P&L. Yes, that's it with leases, guys. Hire purchase we have to see, right? Okay, the last topic that I'm discussing, guys, in this marathon is hire purchase. Okay, it's not asked that frequently, so I'm discussing only the concepts. In detail, I'll explain the concepts. 1 or 2 questions which are there, please solve it on your own. Yes, hire purchase. Okay, it's a simple transaction. Now, hire purchase, you have to understand one thing. There is one guy called Rakesh. He is called as hire purchaser.
There is one guy called Dinesh. That fellow is called as higher seller. Okay, higher seller. Now this car is there. Car is there. This car, the price of this car is 10 lakhs. I have an option to go and buy the car. Today I can buy the car. Option 1, just go and buy the car. That time I have to pay 10 lakhs. Today if I buy the car, what amount I have to pay? That is called as cash price. That is called as cash price. Clear? Now, option 2, what I can do? Buy it on installments. Option 2 is buy it on installments. Installment if I buy, when I buy the car only, it's like going to any car showroom, taking vehicle loan and buying the car. Okay, ownership transfers at the beginning. I become the owner on the first installment only. Forget first. Without paying any installment, if I just go and take the car on loan, I become the owner at the beginning itself. And on non-payment of installment, asset can't be taken. If you don't pay the loan, they can't take the asset because it is on installment basis. Like for example, you take mobile from the mobile showroom, you buy one Apple phone for EMI basis. If you don't pay the EMI, do you think they can come and take your Apple phone? No, they can legally send you notice. That's all. Now the option 3 is what we are discussing. That is buy it through hire purchase. In hire purchase, what happens? Ownership transfers on payment of only the last installment. Pay all your installments on time, then you will get the ownership. Otherwise, the higher seller can any day walk into your house and take the car and go away. Clear? On non-payment, higher seller has a right to take the asset back. Now, cash price means what? Price in the market today. Today's price. They will give it in the question. Higher purchase, if they don't give, you have to prepare that repayment schedule table and you have to calculate. Higher purchase price, cash price plus interest. Today's price plus what you are going to pay extra in the future, that is called as higher purchase price. Or the other way to calculate, down payment what you are paying today plus the installments that you are going to pay in future, all that totals up to higher purchase price. Down payment is initial payment to be made by higher purchaser. Now repayment schedule. This is a very important table that you have to prepare in every. They asked a repayment schedule. Only repayment schedule. Now repayment schedule. Very important thing that you have to understand is how to calculate this. Year 1, okay, year 1 on and every year basically opening balance will be cash price minus down payment. Cash price, you know, subtract the down payment, you will get the opening balance. Installment will be either given in the question or what you have to do, principal plus interest. What principal payment you are doing, this plus this if you do, you will get the installment. Either installment will be given in the question or you have to do principal plus interest, you will get the installment amount. Correct? Interest will be whatever opening balance is there, multiply into interest rate, you will get the interest. Now principal amount, whatever installment you have paid, in that this much is interest. Remove the interest, you will get the principal amount. Now whatever principal amount you have paid, that gets subtracted from your loan opening balance. Now you will get your closing balance. Clear? This is the table. Almost every hire purchase question, this is there. Now we go into accounting in the books of hire purchaser. In accounting, you have two types of accounting. One is called as cash price method. One is called as interest suspense method. Interest suspense method means nothing. Recording all the interest starting only. Now, first we will see the cash price method. Asset taken on hire purchase. When you take the asset on hire purchase, what will you get? You will get the asset. Hire purchase asset account debited. 2. Did you make payment? No, you have to make payment to higher seller. So it becomes a liability. At cash price. At cash price. That is today's price. Then down payment. What will you do down payment? You pay the money. When you pay money, higher seller account debited to bank account. At the end of each year, every year what will happen? Interest will become due. Interest is due. Interest account debited to higher seller. Interest account debited to higher seller. Installment. Higher seller account debited to bank. Higher seller account debited to bank. Now, depreciation will be what? Asset goes down. Depreciation account debited to asset account. Finally, transfer to P&L. What will you transfer to P&L? Interest and depreciation both will be transferred to P&L. P&L account debited to this. Interest suspense method, only one small change. Okay. Higher purchase asset account debited at cash price only. Like how we did earlier. See here also we wrote higher purchase asset account debited to higher seller. But here higher purchase account debited at cash price and one suspense account called as interest suspense account is debited and total amount is put to higher seller. That means full amount you are transferring to higher seller today itself. Transferring means we are not paying, you are crediting the liability, you are creating the liability today itself. So now what happens?
Down payment is same. Hire seller account debited to bank account. At the end of each year, interest will be due. No. Now, last time you wrote interest account debited to hire seller. Now you can't do that because full interest amount you already transferred to hire seller here. So now you will write interest account debited to interest suspense. Keep removing the interest suspense. That time interest will be recorded over here. Now installment, same thing, hire seller to bank. Depreciation, same thing, depreciation account debited to hire purchase. And interest and depreciation should be transferred to P&L. Now in the books of hire seller, there is a method called as normal sale method, and the other method is interest suspense method again. Now assets sold on hire purchase system. Hire purchaser account debited because hire purchaser has to give me money now to hire purchase sale account. Down payment, you are getting down payment. So bank account debited to hire purchaser. At the end of the year, interest is income for you. But who has to give you this interest? Hire purchaser has to give you the interest. Hire purchaser account debited to interest account. Now installment, you are getting installment. Bank account debited to hire purchaser. Transfer to P&L. Interest, what will you do? Interest is an income. Income will be transferred to P&L credit. Now, if you are following interest suspense method, same like that time, full interest will be created. But their interest suspense was debit. Here, interest suspense is credit. See, hire purchaser account debited to hire purchase sale to interest suspense account. That is the total interest. Clear? Down payment, bank to hire purchaser. At the end of each year, interest due. Okay, what will you do? Now you can't tell interest due. I cannot write hire purchaser account debited because full amount already I have written hire purchaser here. So now what will happen? Interest suspense account debited to interest account. Clear? Installment, same thing. You're getting money, bank account debited to hire purchaser, transfer to P&L. Now, default in payment. If at all the hire purchaser misses a payment. Now what will you do? Two things you can do. Complete repossession or partial repossession. Complete repossession means what? You take all the assets, you take it back. Or partial repossession means what? Some you take it back and adjust it. All assets are taken back or some assets are taken back. Asset value to be adjusted with the payable amount. Now if I give you one mobile and keep paying the money. Now what will I do? If I take the mobile back, I will adjust it with the payment. No. So now after adjustment, whatever balance is there, that is to be paid. Imagine I adjusted. After adjusting, still there is 5,000 pending. 5,000 has to be paid. Clear? Now profit or loss on repossession has to be calculated. How will you calculate profit or loss on repossession? Simple. WDV on the date of repossession. Let's assume asset was purchased at 100 2 years ago. First year depreciation 10, second year depreciation 10. Now it is sitting at 80. This will be the WDV. What value you adjusted? Now that fellow will not agree. No, boss, you took depreciation 10, but I feel that asset has depreciated more. So he is telling no, 100. I will take 20 and 20. So for me it is showing 60. So now what happens? This 20 which is there, that is your profit or loss. Okay, usually it is loss only on repossession because when you default, the other party will take it at a lesser value. You can't tell also don't take it at lesser value because you are the person who has defaulted. Is it clear? Yes, with that we are done with the discussion of hire purchase. With that we are done with all the parts, guys. So wish you all the best. Lot of questions are repeated. I'm telling you, a lot of questions are repeated. Just refer all these questions only, properly you understand and study and go to the exam. You will still be able to clear the exam. Okay. Wish you all the best. See you. Bye-bye.